morning, everyone, and welcome to Breakpoint 2025. We're so excited to have you here today with us. This year, on day one, we wanted to create something a little different, a curated closed-door experience for the top asset allocators in the world, a place where you can ask honest questions, learn from your peers, connect with them, and hopefully walk away with long-term relationships that turn into long-term allocations into the Solana ecosystem. And we've packed day one with exactly just that. You're going to hear product keynotes, debates, manager spotlights, case studies, fireside chats, and workshops all day, all designed to help you understand how digital assets fit into an allocator's portfolio today. So here's a quick look at what's happening this morning. So we will have XBAM kick us off with an opening keynote, a macro teaching from the one and only Raoul Pal, followed by a practical session on how to allocate into the digital assets portfolio and the menu of options for institutional LPs. Then we'll have a deep dive into how to generate alpha across different digital asset hedge fund landscape. And finally, we'll wrap up the morning sessions with some real-world examples of income-generating strategies on Solana. After lunch, we'll switch gears into the Bitwise section, which dives deep into the Solana's strategic role in today's portfolios. First, we'll hear an overview of Solana's unique role within a diversified portfolio, asset allocation perspective from multi-coin co-founder and forward industry chairman Kyle Samani. And then we'll take a look at how Solana is positioned to power the global financial infrastructure, from tokenized equities to DPINs to the next generation payment systems. Building on that momentum, our friends at Blockworks and Artemis will walk us through how they're making on-chain data available and accessible for allocators. Finally, we'll wrap up with a headline fireside chat with Solana co-founder Anatoly and Bitwise co-founder and CTO Hong on Solana's future roadmap and what that means for investors like you. So buckle up. We designed today's programming to challenge assumptions, spark new ideas, and give you all the information you will need to allocate into the Solana ecosystem with conviction. Welcome again to day one Breakpoint Allocator Day, and I wanted to introduce our friend and one and only Raoul Pal to the stage. Thank you.
Good morning. I don't know if this is working out. Good morning, everyone. So it should be an interesting day today where we're going to go through a whole lot of things about how to asset allocate in the space, how to think about the space, and also how to think about markets and the macro overlay. And what I'm going to go through is what we use at Exponential Age Asset Management, XPAM, to overlay our kind of fund of hedge fund portfolio, to think about the macro and how to use it. And I know a lot of you a little bit bored of price action right now because it does nothing but go down every day or chop around. Yeah. But over time, as always I say, is we just need to zoom out. So let's go to it. This is the work that we do at Global Macro Investor, my research service. And the idea, the whole game that we're playing at the top level of crypto itself is this debasement of currency, the 8% annualized growth rate of total liquidity, which is the debasement of currency. That becomes our hurdle rate for investing. And on top of that, we then built the crypto rails to do all the other things that we can do with it. But this was where we all started, and it's still the main driver of what we do today. So I use something called the Everything Code. I think most of you will be familiar with the Everything Code right now. And it's my understanding of how this all fits together from a very big picture to how it fits together into the business cycle, to asset allocation, where we are, all of that. And this has been very, very helpful for me. I based it upon the magic formula, which is GDP growth equals population growth, productivity growth, and debt growth. So that's how we understand what drives economies. Once we understand that, we can understand the messes we're starting to get into. Trend rate of GDP has been declining for decades now, for 50 years basically. As the population starts aging out, trend rate has been going down. The population is aging, and you can see from the chart here, it's the same trend. Older populations tend to produce less growth. Productivity, older people are less productive. So we have a decline in productivity over time as well. So this is driving this slower economy across the whole Western world, whether it's Europe, the US, or elsewhere. Then we start to see debt growth. Debt growth is the big problem that we've been facing for decades now. It blew up in 2008. So total debt to GDP in the US has been roughly stable, but that hides the story of what's really been going on. The private sector's been deleveraging over time. So they've been taking on less debts, and that's been a good thing. But that is entirely offset by the government that's been increasing its debt. And so this debt burden is the real issue that we're facing today. That is all driven by demographics. So I said we're going to zoom out. This is the really important story of why this is happening and why it matters to us, and we'll come down to how it makes us asset allocate into crypto as a sector. So that's the birth rate of the total population. The trend growth has been declining forever after the baby boomers came into the labor force. They've been slowly aging out. That whole trend rate has been also prevalent in the labor force participation rate, which is the working labor force in the United States. And we've seen the working labor force has been declining and follows exactly the births-deaths rate. So what we've got is ahead of us, out to 2040, nothing but an aging population. So that, if you think about it, means slow growth for economies, difficulty raising taxes, more expenditure for governments, and this is the mess that we're facing. This chart is the most important chart in all of macro, and most people don't understand it yet. And I keep bringing it up, saying, I know when people don't get it because it's not been copied and sent on Twitter all day. This is the labor force participation rate, and against it is government debt as a percentage of GDP, inverted. Basically, all debt has been accumulated to offset the working age population decline. So they're trying to bolster growth by adding debts. And right now, they kind of have broken, from 2008 onwards, they've broken debt growth. Debt growth is now just servicing of old debts, and interest payments keep accumulating. So this is the whole game we're in. This is why it's happening. Why we've got this indebted world is not because of government overspend based on whatever political party you like or don't like. It's none of that. It's just because we've got an old population. And that's the same in Japan, which has an older population, so they have more debt. Europe has older populations, so they have even more debt. And the US has a slightly younger population, but it's exactly all the same process. And you've got these mega trends. So the labor force participation rate just continues in this nice secular downtrend, and government debt to GDP keeps going up. When you look at it in a log channel like this, you can kind of project where we're going to go, which is what Japan did. If we continue as we go now, we will end up by the, let's say, 2030 at 160% of GDP in debt. So it just keeps going. And you can't really stop it because we've got this aging population. So how do we get GDP growth up? Well, that's a story for another day, the story of AI and robots replacing the demographics. But right now, we're in this everything code cycle. And that is the cycle of using liquidity to offset debt. So basically, what they're doing is printing money to pay the debt. That's like using a credit card to pay a credit card. That's the whole game we're in. This is the debasement of currency. This is the game why the rich get richer because they own assets, the poor don't because they have incomes. Incomes only grow with GDP, and assets go up by the rate of debasement, which is at least 8% a year, plus maybe an inflation rate. So that's the whole game that is being played at every government level right now. And we're seeing it again yesterday as the Federal Reserve go back to using the balance sheet again. It's all the same story. We've got $10 trillion of debt to roll in the US alone in the next 12 months. So, and I'll come on to the business cycle and how that all interacts, but this is the story. This is what drives number go up and drives adoption of the industry that we all know and love, or maybe not right now because it keeps chopping around too much, but generally we do. And here's another way of looking at it, is here's the interest payments. The interest payments are what are getting monetized. And so total liquidity just follows the interest payments. So that chart tells you we've got around $7 or $8 trillion that we need to print just to cover the interest payments over the next 12 months into the end of 2026, when things calm down a little bit for a while. And this is the reason why the Fed are trying to get rates down, or the Treasury are begging the Fed to get rates down because they need to get rates down to the level of GDP growth, which is, let's say right now it's about 3%, 2.5% trend rate. They're going to have to get rates down to that, because if not, that number keeps compounding. Because GDP is the economic activity by which you pay the debts and the interest payments. So what we realized within this is the cyclicality of all of this. And this was an important thing when I suddenly realized that the business cycle had gone from variable lengths, and my job as a macro strategist and an investor was to figure out when the business cycle was going to peak and trough. And it's not an easy game, because some years we had, some periods we had like 7-year business cycles, other time we had 4-year. It was moving around the place, and then suddenly everything changed. It suddenly became perfectly 4-year cyclical, starting in 2008. And it was all to do, I found out after a bit of work, to do with the debt maturity. So 2008, we had a debt jubilee. They forgave all the interest payments and all the debts in all the major economies in the world. And when they did that, they restructured all of their debts. So I'm just going to grab some water. They restructured all of their debts, and they restructured them in the 3 to 5 year sector. So as they did that, they created this debt refinancing cycle where every few years they have to refinance all the debt, which requires liquidity, and liquidity drives the economic system. So it's no magic that the Bitcoin halving happened to be a 4-year cycle. It was just matching the economic cycle. So the NASDAQ, if you look at year-on-year rates of change and stuff, it's all the same cycle. It's the same cycle for every single asset, which I'll show you later. So we had this perfect 4-year cycle. And this is where everybody's scratching their heads right now, is what the hell's going on? Has the cycle finished? That's the big question everyone debates all day. And for me, you can see what's happened here. There used to be this perfect 4-year cycle, and suddenly it's changed. Well, what happened here is we've added an extra year. In 2022, at the beginning of 22, rates were still at 0, and they extended the debt maturity by a year to 5 years. So we've got an extra year in the equation. So all of the debts that need to get rolled in 2026 and not 2025. So that's why we've had less liquidity than we've expected at this point. The banana zone point in the cycle has had less liquidity. I only really found this out over the summer when I redid the maths on all of this and realized, okay, wow, they've actually changed the structure of liquidity here. So when we change it to the new 5.4 year where the debt maturity is, this is what we're going to get. So again, it gives you an idea that we're probably likely to peak out towards the end of 2026 in terms of liquidity, as opposed to this year. So probabilistically speaking, which is how I think about the world, we've got further to go, and we've got the big liquidity burst to come. You can see the changes coming. They're changing things like the SLR, the supplementary leverage ratio, that allows them to sell more treasuries to banks. We're seeing the Fed cutting rates. We're seeing changes in the money market. We're seeing the government ramping up fiscal stimulus. All of this is telling you that the big cycle still remains ahead. And I know most of us are impatient in crypto because we want things to go up quickly, but that's not how the world works. It's all based on the macroeconomy, and you just have to have patience, because we've had this very choppy business cycle because there's been no real liquidity yet. Liquidity has been relatively slow. But what people didn't really realize, and I think we pioneered the work on this, is Bitcoin is a very macro asset. It's very understandable and easy to understand once you put it in a macro framework. It's not magic internet money that just is uncorrelated to anything else. It's actually super correlated. So you get this mega trend, which is the secular adoption trend driven by Metcalfe's law in Bitcoin, and it goes up and down, which we all know. And on a log chart, it doesn't look scary. In the real world, it goes down a lot and then goes up even more. But when you detrend that, it's actually the business cycle. So it is just driven by the business cycle. The reason it doesn't look, you have to detrend it, is because Bitcoin has all of the price spikes to the upside. So the skewness to the upside changes that. But when you detrend it, you've got exactly it. And what the Bitcoin is pricing right now is a gap that is not normal. It's pricing a business cycle that's going to recession, and I'll show you that that's not the case. So we're getting into the zone where things get very interesting, where the alligator jaws start closing. But just to show the importance of the business cycle and why ISM matters, it matters for every asset class. Everything on a year-on-year basis is the business cycle. People don't really understand this stuff. Once you understand this, it makes it much easier to understand how markets move, when they move, what they do. It's even easier when you know that we've got a predictable business cycle based on debt maturity. So if you've got that, you know what drives assets. Some lead, some lag. So crypto and technology lead. They actually follow liquidity. Other things like small caps and cyclical stocks, well, they fit with this. So here's the Russell 2000, which is essentially small caps, basically the same. If we go forwards to crude oil, same. If we go through to industrial metals, the same. Everything, literally everything in the entire investing world is driven by this cycle. Even things like the ETH Bitcoin cross. So think of this as alts. Alts are driven by the business cycle. So with the business cycle currently low, we haven't had alt season. And everyone's like, I can't believe they've robbed us of alt season. It's never going to happen. There's too many tokens. We can't have nice things and all of that bullshit we hear all day. It's not. It's just the economy's stupid, because what happens is when earnings go up, when the business cycle is strong, you have more earnings and you invest those earnings further out the risk curve. It's just really basic stuff. It happens for exactly the same as small caps, exactly the same with junk bonds, credit. They all operate in exactly the same way, and the business cycle has been subdued. Listen to Scott Bessent. He's telling you all day, as is Trump, is we're going to have a banner year next year. Why? Because they're going to jam the market with liquidity, and they're going to jam fiscal stimulus through as well. Yeah, if you think about it, the US is a service-based economy. They're going to get rid of tax on tips. That's a huge boost to people. There's like $1.5 trillion that will flow into the banking system just from that stuff alone, from the big, beautiful bill. Then we've got the changes to the SLR that allows maybe $3 or $4 trillion of credit creation from the banking system. We've got enormous amounts of this stuff lining up. Why? Because they wanted to win the election. You know, the good thing is, for once, we've actually got a macro hedge fund manager running the Treasury. So I know how he thinks. He was a long-term global macro investor subscriber. I've known him for 20 years. And he understands the game, which is jam the business cycle going into the elections. So we've got that. We've got the debt to roll. It's kind of stacking up, and it tells you your beloved, or our beloved, alt season is still to come. Bitcoin dominance, the same thing. It's driven by the same thing. It's much like when the economy's slow, people tend to be in treasuries. When the economy picks up, they go further out the risk curve in different types of credit. It's all the same cycle. So it's a very macro asset. And here's the chart of the ISM versus Bitcoin, and you can see the peaks and troughs correlate well. So are we at a top, which is the thing that people bleat on all day on Twitter, with the top of the cycle? We can't be, because we're not topping in the ISM. In fact, we've not even gone above 50 yet, so we've not had economic expansion. Main Street has been struggling. They need rates to come lower. They need fiscal stimulus, and that's all to come. So probabilistically speaking, the business cycle lies ahead of us, and it should be quite rapid. So when we start looking at forecasting models of the business cycle, here's the interest rate model. That suggests to us that the economy strengthens fast and quite dramatically in the next 6 to 9 months. So that's good for altcoin season. That's good for crypto. That's good for all risk assets. Another way of looking at it is central banks, the number of them who are easing. That leads the business cycle, obviously, because they're cutting interest rates. So that tells us we've got a strong cycle still ahead of us. The one for us that matters the most is our financial conditions index. That's driven by rates, the dollar, and commodity prices. And this chart has been very, very useful in predicting where everything goes. And it tells us in 9 months' time, the ISM should be at 57. And we don't think the financial conditions index is done yet. Another leg lower in the dollar, another leg lower in rates, and what we get is an extension of the cycle out further than 9 months. So, again, this is a very good indicator. But we can add to this by thinking about liquidity in Bitcoin. Why does all this matter? Well, because the correlation of the two things, of total liquidity and Bitcoin, are extremely high. In fact, the correlation is 90%. Statistically, that is absurdly highly correlated. When you look at the NASDAQ, it is even more absurdly highly correlated. It's 97.5% correlated with money printing. So money printing is the story that drives this, and then network adoption is what drives the outperformance. So if you think about the hurdle rate being 8%, everything above that is driven by network adoption of the technology. Liquidity, where are we now? Well, year-on-year liquidity is not very impressive. This kind of slow grind higher has been what we've lived through in crypto from the bottom. It's kind of stop-start. Things don't really get going. Some things get a narrative traction, then fall off again. It's because liquidity is not flowing through the system. We've had broken plumbing, and we've had no need to do it yet because we don't have to roll the debt until 2026. When we look at financial conditions, our lead indicator, and put them against total liquidity, well, we've now got a lead, a 3-month lead, and it tells us liquidity is about to explode. And we know that because Scott Bessent's telling us that. They're telling us they're going to add liquidity to the system. We know that because they have to, because the plumbing in the financial markets is breaking as well. So we've got that to come. And then when we overlay ISM, we've got this perfect dominoes of the economy. We've got our high lead indicator, financial conditions, leads by 9 months. Then we've got total liquidity, where Bitcoin and NASDAQ live. And then we've got the ISM, where oil and commodities and cyclical things all live in. So we can understand how the market works over time and asset allocate accordingly. The other thing is, part of that financial conditions is the dollar. Here's the dollar last time Trump was in versus this time. It's scarily the same. It would suggest that we probably have another leg lower in the dollar, which would give us another leg in financial conditions, which means that the cycle extends to the end of 2026, which is why I keep saying it's a longer cycle than people expect. Global M2 is doing roughly the same thing. We had that chop periods last time around with Trump, and again, we get the accelerated part as we go. So that feels like that's coming as well. But we've had a weird world in crypto in the last 5 months, 4 months, is where we've diverged from everybody and we feel now we can't have nice things, it's all over, everybody hates us, it's a terrible world out there. And it's because of stuff like the global M2 chart. That was a chart I was showing for a long time. I said, listen, it's not going to be perfect, and then it started diverging wildly. What happened here was, because of the lack of liquidity in the system, the Treasury began to increase its general account. There was no offset with a reverse repo, and crypto, being the furthest asset out on the risk curve, got hit. NASDAQ didn't get hit because everybody was underweight NASDAQ going into the last quarter of the year, but crypto got hit. And liquidity is still problematic, which is why the Fed started using the balance sheet again. And that's why we've struggled. It's not been easy because there's not been enough liquidity around in the system. Global M2 against NASDAQ's worked fine. And the reason being, again, is because asset allocators were underweight NASDAQ. It had been a good performer all year, and they've had to chase their benchmarks. So we've seen this kind of stuff. Even though we've had kind of fear and greed in technology stocks extremely on the fear side, people have had to chase the market. They didn't do it in crypto because they're not benchmarked against it. But it's still working. But NASDAQ against Bitcoin hasn't. This alligator jaw has opened up. And the alligator jaws, I think, will close because of when liquidity comes in, crypto is the most liquidity sensitive. Against gold, gold actually leads by 183 days. Gold lives in financial conditions world. And again, we've diverged from the gold chart. Same thing, the alligator jaws, same thing, driven by the same issue, which is there's not enough liquidity in the system to flow all the way out to crypto, and we're all stuck there watching the market flapping around while other people are having a party. And it's slightly irritating, but it is what it is, and patience is the game. We're playing a macro game here. We're not playing, hourly charts. We're playing a game of cycles. We're playing a 5-year cycle, not a 4-year cycle. These things take time, and patience is the important thing if you want to capture the returns. Bitcoin against the 2015-17 cycle has been mapping really well. Alligator jaws, again, same reason. Bitcoin against 2021, alligator jaws, same reason. So we've got this consistency across all of the things to show we've had a dislocation. And the question we ask ourselves as investors is this dislocation persistent or temporary? And from the work that I've done and showed you, it's most likely to be temporary. If not, then suddenly the 90% correlation to global liquidity is gone for no apparent reason. And that doesn't normally happen. Another alligator jaws against a different period. Just all of these things. We see it even with the economic surprises index. We get this excess fear gap that's happened in Bitcoin. If you remember, Bitcoin is pricing in an ISM of 46, which is a recession. Yes, we'll have slow growth from the government shutdown and other stuff. We're highly unlikely to have a recession because all the forward-looking indicators suggest the business cycle is going to get a lot stronger. So we've become pessimistic after the washout in October that it's never going to come back. And I think generally that's going to wrong foot people because of the macro work that we do. Financial conditions, same thing, excess fear gap or alligator jaws. We saw that with the fear and greed index getting down to 10. It was the lowest reading in the history of crypto. And that was after a 30% sell-off. And I keep saying with my don't fuck this up thesis, 30% sell-offs are normal. But yet we just cowered in fear when it happened. It's like, really, guys? We've seen this before. Sorry, just go back to this chart. This is the chart the last time we had the government shutdown. And we're following pretty much that path as well. Again, we're starting to have a slight gap here, but chances are once we get through year-end funding for the banking system and the SLR kicks in and everything else kicks in, then we just start this trajectory higher. And we should just have a strong up year. Obviously, we will have corrections en route. And overall, when we think about this as an asset allocation, crypto becomes the supermassive black hole. It becomes the most powerful asset we've ever had, the greatest performing asset of all time. And everyone thinks they're too late. But remember, we're driven by this debasement of currency. As Lynn Alden says, nothing stops this train. Nothing can stop it until the AI and the robots replace population growth. So it's an ongoing, persistent, secular theme that persistently drives markets, which is why markets endlessly go higher. NASDAQ is one of the few assets that's outperformed this debasement. It's outperformed it by 12.6% a year. So it's been a great asset to own because tomorrow is more digital than today, so technology outperforms. It tends to be network adoption models as we adopt new technologies like we're doing with AI, so it does well. Bitcoin, on the other hand, has outperformed it by 89% a year. So that's a staggering difference in performance. When we look at, and you can't see this table very well, but here's a table from XPAM showing all of the assets, and on the left are in orange, the annualized returns. None of those beat the debasement rate. Owning those assets makes you actually poorer. Only up here is you've got US large caps roughly in line with debasement plus inflation. NASDAQ outperforms. Then you've got 3 crypto there with Solana at the top since it came out at 166% annualized returns. That's the power of this thing. Not only does it avoid debasement, but you can get rich as well if you've got patience. So why bother even owning the NASDAQ when it's down 99.92% versus crypto? Over time, everything underperforms this supermassive black hole because this is a network adoption model on a global scale. So for me, it becomes the greatest macro trade of all time. This is why I care so much about this space, because we can make a lot of money in it. And it's an enabling technology for all sorts of things, including helping people around the world participate in the financial system in ways they couldn't have done. So it's a supermassive black hole that becomes the greatest macro trade of all time. And here's the big trade. This is why I'm in the space from the investment perspective, not from the ideological perspective, which I also share, but from this perspective, the chart's a bit screwy here, but basically we've got about $800 trillion of assets out there in the world. Gold is at 30 trillion, global M2, 80 trillion, and Bitcoin, the whole of digital assets is like 3.5 trillion. Okay, so it's nothing yet. But when you use the trend rate of adoption, i.e. the market cap of crypto overall, it is in a secular log regression channel. And you can forward 2032, 2034, this is a $100 trillion asset. A $100 trillion asset means we're going to create $97 trillion of new wealth, which will be the largest wealth creation in all of economic history in the shortest period of time. To put it this way, it'll create more wealth than all of the Middle East, every Russian billionaire, every US tech billionaire, every finance billionaire, every real estate billionaire on Earth. That's what's here. This is what the game is. Discount me 50%. It's still 47 trillion. So we're only 3% of the way there, or 6% of the way there, if you've halved my forecast. So that's the game. That's why at XPAM we allocate to the world's best hedge funds in the space to capture this trend, this overall trend. That's all we're trying to do, is not fuck up this one trend, which is the greatest macro trade of all time. The final part is what everybody cares about, is the banana zone. When does it happen? And look, that liquidity drain that happened in July onwards has been miserable. But the thing remains the same. We've still not had the last phase. The last phase is the debt refinance, the refi cycle phase. And that is 2026. So yeah, not everything works out perfectly. It's not all clockwork. It doesn't follow M2 tick for tick every time. It won't follow everything that you think it will. But overall, when you zoom out, when you look at the big picture, you come all the way through, the opportunities for outsized returns, even risk-adjusted in this space, are bar none. And it's the best thing that we've ever seen as an asset class. So hopefully that's helped settle an understanding of why we allocate to this space, why we care about this space, and the opportunity set. And then I think we've got Pierre coming on from XPAM now, our Chief Commercial Officer, to talk about how to think about allocating the space. You know, what are the options available? How do you actually capture that trend? So, Pierre, over to you.
Right. Good morning, everybody. I hope you're doing well. So, yeah, Raul just set sort of the stage for why invest in digital assets at all. Why does it deserve an allocation? This is really for institutions to understand the options out there once you understand why it is worth an allocation. So I'm Pierre Henry. I work with Raul every day at XPAM as a partner there, and we help institutional allocators understand where digital assets sit in a multi-asset portfolio. So we have about 30 minutes today, and my goal is to really help you understand what's out there, create a taxonomy for you. And so we'll run through the state of crypto today. I'm going to reinforce some of the messages Raul brought up. We're going to run through portfolio composition, and then the menu of options out there. And hopefully you'll be left realizing that this place, that crypto deserves a spot there. So we love to think about, as Raul said, where we are. We're about 3% of the way through this journey. And actually, there will be, over the next 10 years, more wealth than the internet, cloud, and mobile combined. So it is absolutely one of the key exponential technologies to invest in today. And what we've done at XFAM is we have normalized the growth in crypto users with the internet from a 5 million user base. And what you see from the chart is that from 2016 to 2021, crypto was growing at about 137% every year. And it's about double the rate of the internet. The reason for that is it is building on top of the internet. So it has things the internet never had in its early days, right? Everything from social media to digital virality to larger scale networks, digital broadband, mobile, global mobile usage around the world. And even during the multi-year bear market, it was growing at 43%, which is the same as the internet in its main adoption phase. And basically, where we are today is we're at about 1 billion users, and from the trend rate of growth, we expect to be at 3 to 4 billion by 2030. So this is an unstoppable train. You saw this chart before, but I do want to re-highlight this, which is that crypto dominates the return stacks, and this chart looks at really the start of crypto in 2011 through October 31st of this year. And as you can see, it's not even close. Bitcoin is 36.5 million% growth. Ethereum over 400,000, and Solana, although it's younger, is well over 10,000%. So the key question is, do these things create diversification in a portfolio, efficiency in a portfolio, or is this just sort of a random power law example? And this is something we're going to talk about. And it's very interesting because institutions today regularly express very strong interest in investing into the space, but the allocation doesn't reflect that interest. And if you are a student of financial history and you've seen things like private credit or hedge funds in their early days, emerging markets, it's always the same thing. Allocation lags interest. And basically, nobody does anything until the operational risks and the regulation are taken care of. And what we've seen is crypto is in exactly that spot today. So this is a good forward-looking indicator. It's kind of a really good moment to invest. And so I thought I would go over the typical concerns I hear from institutions about why this space is not worth an investment and how they have been addressed. First is the regulatory uncertainty. And really, as we will go over on the next slide, that has completely changed. There really is comprehensive frameworks around the world now and cooperative governments, policy. Safety of platforms. 2022, of course, there was tons of issues with custody, counterparty exchange risk. And that's all been resolved now. Now we have everything from SOC audited accounts to segregated accounts to institutional grade custody and insurance. And so there is real safety in the platforms. Obviously, the famous volatility of the space, you couldn't go to a risk committee in past years because everyone would say the volatility is too high. But actually, what we've seen over the data over the past few years is that on a risk-adjusted basis, you are paid for your volatility. And in fact, by sizing appropriately, you can deal with the volatility very easily. The last big comment was always, is there value beyond speculation? And we do know today that, and you'll hear about this actually throughout Breakpoint from other practitioners and entrepreneurs, that there are clear fundamental and economic drivers in the space that make a lot of sense. Everything from stable coins to roll-ups to corporate adoption. So I thought I can't go through everything with the 30 minutes, but I wanted to highlight a few of the key things over the last few years. When Ethereum completed in real time the merge, it showed that a major protocol could upgrade without breaking. And basically, it shifted to proof of stake, which created institutional grade yield for the first time. To this day, it's reduced 99% of the energy usage, and it sort of set the precedent for others to follow. Mika came out and created a kind of a full framework in Europe to understand stablecoins, custodians, exchanges, disclosures. So that was a very big deal. The Ripple case was deemed, it was the first time we had judicial guardrails to say when is something a security or not. Obviously, it was deemed to not be a security. Secondary sales were not securities. And this really started to push back on the everything is a security narrative of the SEC. Solana, of course, has been recognized for its unbelievable throughput by leading payment providers as a chosen partner for payments infrastructure. And it's only getting faster and faster every single year. The Trump administration has created a bipartisan innovation agenda, and it's allowed policy and regulation in the US to come forward. And the biggest things lately have been the Genius Act, which provide a clear rules of the road style framework for how stablecoins work, how safe harbor works, and basically when you file for any type of product, what the rules should be in the first place. Same thing with Project Crypto. SEC has moved from an adversarial to a collaborative stance and long yearned for transparent rules of the road around classification of ETFs and filings have been finally approved. So it's really helped the industry at large. And so where we are today is well beyond speculation. We've sort of achieved an industry defined by scale. So we have 46 trillion annual stablecoin transaction volume, 70 million monthly active users. So these are real people. These are unique individuals who are borrowing, lending, swapping, trading on exchanges and creating a real economy in real time. There's now 175 billion in ETPs and institutional wrappers around the world. And according to the surveys that have been conducted here, 70% of the respondents recognize that this is an opportunity with huge convexity, right? There's much more upside than downside. And finally, most have recognized that it does provide a very clear role in portfolio efficiency and diversification. So as Raul had referenced, this thing is so small. We're only $3.5 trillion, $3 trillion depending on the day. And versus the other major asset classes out there, you can see that the white space is truly enormous in front of us. So why do crypto strategies exist, and what's structural about them that create these persistent opportunities? Crypto is payments, money and settlement in one programmable layer, and that creates alpha that doesn't exist anywhere else. You won't find in traditional markets. Everything from block space to staking to MEV, which is our term for extracting profit from the ordering of transactions on a chain. There is extreme volatility, but it's structured. Because markets are 24/7, and you see these big moves in the sigma, you see these standard deviation changes that Raul referenced. In reality, this is the the base material for a market-neutral basis trades, options premia, and strategies are associated with it. So the market structure is developing in real time, and what you'll find is that liquidity is fragmented across venues. And because of that, arbitrage and high-frequency trading can exist in a way that doesn't in mature equity or foreign exchange markets anymore. So we've seen strategies grow around that. Finally, because everything is on-chain and transparent and audited, you can actually do unbelievable quant-style strategies and models that didn't exist in the past. Everything from factor models to wallet cluster analysis to various on-chain metrics. And because with the liquid token market, the majority of returns are being powered by just a handful of projects, you do get this power law dynamic, so it makes a lot of sense for venture models to come into the space, especially on the liquid side. And then finally, as referenced, we have now real institutional grade yield that has come into the space, and everything from neutral income strategies to digital asset treasuries to ETFs with staking built into them have entered the scene. So here's the stuff that I get the most interested in, which is that this is a 5-year look back so that we could include Solana from its inception. And basically, there is a persistent low correlation between crypto and most of the asset classes that institutions care about. And so some of these things like bonds and commodities, the correlation is almost zero. And it's interesting because actually those are the two categories that institutions tend to lack diversification in the most when they do a 60-40 portfolio. And so when you see this type of data on the screen, it makes you really wonder, okay, then the math of a 60-40 portfolio should actually improve dramatically if you add a little bit of crypto. And so we did the math in-house at XPAM. And on this chart, what you're seeing is Bitcoin, Ethereum, and Solana. And what happens to a 60-40 portfolio when you add the various cryptos to it. So the X on the bottom left is the normal 60-40 portfolio, the return on the y-axis, the volatility on the x-axis. And what we see in the dashed lines are the Sharpe ratios associated with each of these. And so the math is very straightforward. If you add 5%, up to 5% of Bitcoin, you are improving the returns without an offset increase in volatility. It's about 1 to 2% in Ethereum, and it's about 3 to 4% in Solana. And so the volatility you think would go up by several percentage points, it tends to be tens of basis points. And this is well within institutional tolerances for volatility. So even adding 1% makes a huge difference. And I think that if institutions do the math, they'll start to realize that advising clients to do this makes a lot of sense. And so we are starting to see Bank of America and other private banks, Morgan Stanley, offer crypto to clients and advise these sorts of percentage ranges, which is really good. But what I also want to focus on is the downside ratios. Everybody wants to use a Sharpe ratio, but the problem with the Sharpe ratio is that you get penalized for all volatility, including upside volatility, which crypto has plenty of. So what I care about is sort of understanding how much return do you get per unit of pain per downside volatility. And so when you look at a Sortino ratio, which is measuring the downside, or a Kalmar, which looks at the max drawdown, what you find is that you're compensated. You get much better returns in crypto than even in equities. And so in bonds, for instance, which tend to make up most of the portfolio of institutions, you get the worst score of all. So despite these big moves up and down on a risk-adjusted basis, you're well compensated. And so although volatility is important to consider, it's really the nature of the volatility that institutions should wonder about. And these charts help set the record straight. So a quick taxonomy of how to think about the strategies. At a high level, we've created 6. There's your sort of directional exposure by owning spot directly or something like an ETF. There's the active component of liquid investing, so kind of active management, working with a hedge fund, because they have all the time professionally to do the research, and they have access to projects earlier than most people. You have the staking, the digital asset treasuries that provide an alternative to spot for mandates for institutions. You have, of course, structured products, things that usually have a defined downside or a certain amount of yield that's consistent, that appeals to risk-sensitive capital. Private markets, so the venture, the growth, both on the equity and the token side. And then market neutral. So these are the uncorrelated returns that extract efficiencies out of the market regardless of market direction. And this is the kind of taxonomy institutions should operate with. And you can actually use the same instruments in TradFi in crypto. So if you look at liquidity trade-offs across these strategies, we can layer that in there now. So the highest liquid stuff would be the tokenized RWAs, or things like T-bills, the perpetuals, the wrappers. And then you get your staking and your separately managed accounts, which are more on a weekly basis. The market neutral guys, the macro hedge funds, these tend to be monthly in nature. Your credit and directional hedge fund strategies tend to be quarterly. And then, of course, you have venture and growth on the illiquid side. And so what we find is that if we use this framework, we can help allocators figure out what their mandate is and then where to express it. And if you are willing to balance liquidity with returns, with a trade-off in liquidity, you can actually create a really interesting view of the world and a curve. And you can express what kind of return you want using this methodology. And so to explain in a little bit more detail, basically on the left side, you have spot liquid tokens, which are, this is an index from the S&P top 10 equally weighted over the last 5 years. And you can see it's coming in at about 18% per year. But as you move along, you start to get much better returns. So you have the market neutral guys kind of hovering above 20%. So these guys will very consistently produce these returns, and that tends to be a defensive position that institutions like. And the fundamental hedge funds, which are the groups we work with very often, they produce by far the highest returns, but they suffer from the full downside volatility of the cycle. So what we do at XPAM is we manage cycle risk. We use the macro framework that Raul walked you through, and we will invest in the directional guys in high liquidity environments. And then as we get into environments where the liquidity contracts, we'll go down to the market neutral side. And what ends up happening is over the course of the full cycle, you capture the full exponential technology trend, but you reduce as much of the downside as possible. And that's how we help our clients get the best returns possible. So this framework is perfect for institutions to map out where they want to be and why. OK, there we go. So what we do say in the end for our clients is that the best strategy is actually to take a barbell approach. And so on the left, you have your sort of blue chip capital preservation. So this is like Bitcoin or Ethereum. And the idea here is you're highly liquid. You can control the risk yourself. You don't have to pay a manager a fee. And in the process, you have a lower volatility. You have a higher market cap project, usually something that makes an investment committee or a family office feel more comfortable. But if you don't have convexity in the portfolio, you're missing out on the secular growth of the space. And so on the right side, you have your smaller cap projects. And this is very much like investing in smaller market cap equities. It's really hard. Token selection is just like that. It's very difficult. And so you do need specialists who spend all of their time doing this. So if you only are owning Bitcoin and Ethereum, you're not getting the full picture. And we find by recommending a 50-50 or 60-40 or 70-30 split, you're actually going to have the best efficiency in your portfolio with your crypto allocation. So this is the language of most of the multi-asset managers. So we tried to translate this onto what they would be used to seeing. So we're going to run through now the menu of options and fit them into one of these buckets: growth, return seeking, illiquid alternatives, defensive, or income and liquidity. So of course, not everyone can hold spot, but when you do, it's by far the purest expression of your belief in this secular technology trend. Obviously, it is clean. It tends to be easily custodied, segregated. You have NAV reporting, which comes very easily. And at the end of the day, you're getting exposed to the full upside and down side of the cycle. So for something like Solana, if you can pick something like that, you'll get an unbelievable CAGR, but you'll get high volatility in the process, but be paid for the volatility. So this fits into the growth bucket. The problem is that most institutions can't hold spot. So they go for the ETFs because they are familiar. They can be traded in a standard brokerage account and effectively still offer the same benefits of liquidity. So that would be the second option. And these days, the staking is being built directly into the ETF. So this is, again, a growth option. Staking, which for those who don't know, is when you essentially delegate your voting power of the units that you hold to a validator who then helps with consensus on a proof of stake network. And so this is the third option for institutions out there. And what we see across all the networks is you get anywhere from 2 to 12% in the staking. In an environment with falling rates, this is particularly exciting and interesting, so it would be an income and growth mandate. And finally, you get your more capital efficient expression of beta, which will come from perpetuals, which are a type of futures contract which roll over. There's no end date, and basis trades. And so it's a way of essentially hedging without changing the underlying portfolio, but you are subject to high volatility, so we put into the return-seeking bucket. Then you get into hedge funds, right? So this is where we live most of the time. These are the guys who do the research and are able to combine narrative with product roadmaps and investment and effectively looking at teams and looking at where distribution works and all the things that might go into understanding an equity but applying into crypto. You do trade that for a higher lockup, and throughout the manager database that we have, you have huge dispersion in performance. So in bear markets, we've seen some of the directional guys fall 80%, but then in the bull markets, they'll be up over 1,000% in a year. So this is more of a return-seeking option. The market neutral guys, as I mentioned, are making money regardless of which way the market moves. They use everything from statistical arbitrage to liquidity provisioning to DeFi activity to market making, and they're able to create a very consistent type of return. So this would be your defensive complement to some of the more liquid directional options. And on credit and lending, this is effectively, because there isn't a mature prime brokerage ecosystem in crypto, you're able to get very high yield premia. And so you're seeing versus TradFi very attractive numbers that are persistent. Effectively, it's characterized mostly by stablecoin lending and over-collateralized positions. So this is in your income bucket as well. And multi-strat is one of the last hedge fund options. This is, of course, probably very familiar for institutions, very flexible. These are guys who will change their approach depending on the macro regime. This is similar to what we do, where they will combine relative value, options, rates, macro overlays, and effectively dynamically move along the risk curve. So you will see that they generally have lower volatility, but in exchange, they give up some of the returns you'll see from the directional guys. Okay, and then I can't be at Breakpoint and not mention the Solana-specific stuff. So this is actually doesn't exist in TradFi. These are funds that take advantage of the high throughput, low latency of Solana, and they effectively are capturing alpha with things that which are unique to blockchains like this. So something like atomic settlement, where you have an interdependent exchange of assets, and you remove settlement risk. You use on-chain order books. Strategies related to that. And so this is sort of growth and return together in one place and exhibits the same volatility as a directional strategy. On the private market side, you have venture, which everyone will be, I think, much more familiar with, both on the equity and the liquid token side. On the equity side, you're obviously participating in power loss. So these are portfolios where a fraction of the investments actually generate the majority of returns. And it is absolutely about access. Managers who get allocations first generally are going to outperform retail and certainly even professional investors. And as the space evolves, this whole liquid alternatives universe, we are seeing more and more on the growth side. So these are your application style, whether it's an analytics company, a two-sided marketplace, a SaaS company. These are the companies that have clearly defined unit economics. They have product market fit. They're starting to scale. They're entering the first challenges that happen with corporate finance, with M&A, with entering new markets, with CapEx. And there's a whole ecosystem growing around this. These guys have faster exits, right? But they tend to have also lower returns. Their loss ratios are lower as well. And so for institutions that want to balance the volatility, they don't want volatility in part of the portfolio. This is where they should be looking. Ecosystem funds are really just specialized, right? So these are things like Multicoin focuses on Solana. They're very famous for that. I'm going to be talking to Tushar later today. And so if you want access to a specific theme that you're trying to monetize, or you want a specific protocol, this is the way to go. And happy to chat with anyone about that afterwards. Finally, we've got the wrappers. I'm trying to move along here with the time we have. Of course, digital asset treasuries are famous. If you can find a management team with high brand equity and high velocity, high liquidity, then they can issue shares accretively, and you get amplified exposure to the underlying, both on the upside and the downside. And actually, for a lot of institutions that can't own spot, this has been the way to go to express a view. Tokenized securities are what they sound like. It's when you offer a fund structure as a token on chain. Basically, these are for accredited investors, and you're going to have all the benefits of blockchain with your normal subscription process. So if anybody's invested in a fund admin before, that whole process goes away. You have instant settlement, you have global distribution, you don't have the same paperwork, and all the compliance is programmable. So this would be, again, in the return-seeking liquidity bucket. Structured yield is probably the most familiar, actually, of all of these for institutions. This is when you have basically a defined downside and a defined upside product. For risk-sensitive capital, this becomes extremely interesting and attractive, especially in sideways markets, because there's a lot of volatility, so you can monetize the options premia very, very well. So that's an income-related strategy. And then to wrap up on the menu of options, you have tokenized RWAs, which are more like money market funds, tokenized treasuries, focus more on yield streams than on absolute returns, I would say. Obviously, low volatility, low returns, but a very nice component to amplify and stabilize the rest of the portfolio. So last couple of slides here, I just thought it would be helpful to run through what's different when you do due diligence in crypto versus TradFi, since that is a question we get all of the time. Custody is the obvious first option. Unlike TradFi, where it's commoditized here, you really have to worry about private keys, the signing process, and the operational risk around that. Counterparty risk. So in TradFi, of course, custodians, exchanges, and fund admins are all separate. Here, they tend to blend together in crypto. So you need to worry much more, of course, about rehypothecation and the venue you're in and exactly where you're storing your money. Tokenomics is completely replacing sort of capital structure analysis, leverage ratios, cash flow analysis. This is much more about the quality of the tokenomics of the project, the distribution, the team, the amount of money being invested. So it's a totally different framework that is unique to crypto. As I mentioned, liquidity is fragmented across all of these venues, and so where you're investing and the timing of the investment matter very, very much. Technology risk is as important as financial due diligence in our world. You have to absolutely have a sense of basically the quality of the protocol, and we see exchange hacks and corrupted tokens have created problems in the past. So this is a huge area of due diligence. Regulatory risk, just understanding tax implications, what the rules of the roads are in various jurisdictions. That's important. Operational controls is pretty much the same as TradFi for us. It's focusing on the quality of the operating team. And actually, most of the hedge funds we analyze don't make the cut because they fail in this category. Risk sizing is super important because the volatility is so high. The mistakes can get amplified very quickly. So arguably, this matters as much as protocol selection. And finally, the team matters in a young industry where you don't have long track records you can audit. So if a team understands distributed systems, cryptography, and has a clear investment process, that becomes a huge focus for us. Okay, so in summary, the main takeaways are that we are on a one-way train to billions of users, and the internet and the growth of the internet is a really useful early model for that. There is a huge gap today between interest and allocation, but this has always been historically across asset classes where the biggest returns have been made. There is a full spectrum of institutional strategies that are out there for institutions to express their view along. And even a small, even 1% allocation in any of the blue chip cryptocurrencies can push out the efficient frontier of a portfolio. All of this is underwritable now across the frameworks we went through. And basically, there are compliance structures today that didn't exist in the past for institutions to make investments in. So kind of a whirlwind, but that's the summary. It's early on, 3% of the way through the journey. We love questions at XFAM. We love to be helpful. So if anyone would like to reach out, my email is pierre@xfam.com, and would be happy to, whether you're a professional or an institution or even retail, direct you to the right place and be helpful. So thank you so much for your time. I think next we have Paolo from our team who's going to be interviewing some of our managers. Thanks.
how to think about allocating this space, why, and the process by which we do it. So we've gone through the macro, we've given the top level of the macro, how you think about this space, where it's going, what are the drivers of the space. We've talked about how you can allocate across the space using the various strategies that are available. So the next part of this is, okay, we've done that. How do we look at managers? How do we find the alphas that the managers have to express these views to get us on this journey from $3 trillion to $100 trillion? How do you capture that? So next up, we've got my partner at XPAM, Paolo, with two of our managers to come and talk to them about how they think about the alpha in the space and the opportunities to get you an idea of how managers think and how it can work in the process to capture this trend. So Paolo.
Come on, guys. Gonna leave me here alone. So hello, everyone. Thank you very much for being here. My name is Paulo Bahia. I'm the head of research at Exponential Age Asset Management. And we're here today to talk about like how to, create outside returns in the digital space, in the liquid digital space. With me here today, I have two old friends. I've known these guys for a long time. And we're going to try to, give you an idea of what we do. In my case, as capital allocators. In my case, I just find the best funds to give money to. And in their case, they find the best tokens, the best investments. They do the research and provide you and everybody else who's invested with the outsized returns. So briefly, we don't have a lot of time. So to my right, I have Justin Bonds. Justin is the founder and CIO of Cyber Capital, perhaps the oldest crypto fund based in Europe. They are based in Amsterdam. He's been doing this since 2016. Prior to that, he was an early Bitcoiner. Next to him is Sam Andrews. Sam is portfolio manager and the director of research at North Island Ventures. It's a firm based in New York City. They run 2 VC funds and 1 liquid fund that Sam is responsible for. Prior to that, he had a very successful blog in Substack, writing research on crypto, and that's how I met him years and years ago. So let's see how we tell this audience how we find outsized returns in the crypto space. So let's start with you, Sam. Can you describe to us like what your investment strategy is? I mentioned you have heavy research and look at what time horizons you look at to invest, what benchmarks to compare your fund to. If I go to North Island website, there I can read that we are entering the golden age of crypto adoption. So how do you factor that golden age of crypto adoption into your investment strategy?
Okay, hey everyone. So what we do, we're thesis-driven investors. That means we do in-depth, independent research to both surface and underwrite investments. What we invest in is public crypto assets. So that means assets like Bitcoin, like Sol, on down to smaller market cap tokens, as well as crypto-linked equities and derivatives. And we think of ourselves as absolute return. Pretty much anywhere we can develop an edge in our research, usually that has to do with some sort of technological transformation, misunderstanding particular, where we can develop a variant view that drives a lot of our thinking. I'd say we're long bias. Given where we are in the development of the industry, having a long bias is important. But we also do manage our risk. Crypto is highly cyclical, and so we'll adjust our exposure to try and blunt the effects of some of that cyclicality. We also overlay some yield strategies on idle cash we may have or ways we can amplify the returns of our underlying positions. And I think maybe to your question of how we generate outsized returns, it really comes from 2 factors. Factor number 1 is asset selection. That means being invested in category leaders. That comes from our in-depth research that we do. That's both kind of top-down thematic. There are various themes, and I can elaborate on them, that we want to be invested in, and bottoms-up. And so bottoms-up assesses which is the best way to express those themes across a variety of different types of assets. And the second way we generate returns is risk management. I think risk management is critically important and probably something that is maybe a little overlooked in crypto. There are real cycles in crypto, in understanding kind of where we are in the cycle and kind of blunting the effects of that is critically important. And that comes from portfolio construction, of understanding how much risk is in the portfolio relative to kind of where we are in that cycle. And then secondly is sizing positions correctly, both in terms of adding when the thesis is being corroborated and cutting when the thesis is being refuted or kind of asset prices are kind of getting ahead of where we think they should be.
Thank you for that. Picking up on the same subject, I'm going to jump to you because, as I mentioned, you've been managing money for outside investors since 2016. Your fund just turned 10 years old. In the crypto space, it's an eternity. So congratulations to you for been doing this. But let me tell you one thing. Your strategy is mostly buy and hold. You do also very strong research, and you have a very buy and hold strategy there. But the crypto market has evolved since you started, in 2016. Today, you can really hedge. You can create a portfolio that's more akin to a traditional hedge fund. Can you tell us about have you evolved your strategy? Because again, if I go to your website, I went perused your websites before we came here today. If you were an initial investor with him on day one, you're up 60x, which is fantastic. But not everybody got there on day one. So people are still getting in. So tell me about how would you manage money to provide outside.
Yeah, I think a lot of it is, as Sam also said, it's research, it's understanding. And there's a lot of opportunity in cryptocurrency that comes also from information asymmetry, where there is the public perception and there is reality. And I think for a large part, for researchers and for investors, it's actually to figure out what reality is. And I think that's a very important aspect, and to actually have conviction in that vision, to actually create a thesis that is a sensible, internally consistent thesis. And obviously that thesis needs to constantly evolve. And I think this is also comes down to the psychology of an investor. We have to be able to change our minds. We have to be able to evolve with the times. You know, when I first got into crypto in 2013, I was a Bitcoiner because I loved Satoshi's writing. I loved what it said in the white paper. That was fantastic because I believe in on-chain scalability. I think that's really a key aspect of money and like actually building utility and building real products. So that's why I also got into crypto, because I can see if we build real products, if we actually affect real change, we can really change the world. And that's also where the most opportunity, I think, lies as well. It's not just about pure speculation. We can actually identify utility. We can identify revenue. And then as we evolve over time, Bitcoin decided to pivot and not scale. So then I moved to Ethereum. And then I was this big Ethereum advocate. And then Ethereum changed its mind, and Ethereum's no longer scaling. They're going the L2 routes, as most of you know here. So then Solana became my new home. And I hope I don't have to move again, but I might have to. And I think that's important. I think it's important to have loyalty to common sense, to have loyalty to reason and logic and to your thesis, to never have loyalty to a three-letter ticker. Because that's tribalism. That's a trap that I think a lot of people fall into crypto, because it's their peer group, it's their community, and then they get tunnel vision. They can't see clearly anymore. That's why it's always important to always look to your competitors. Like I might be a Bitcoin critic, but I spend a lot of time learning about Bitcoin because I have to be sure about that thesis and thorough. And I think to be an investor is to understand. If you understand something, confidence comes from understanding. If you invest in something that you don't understand, it's gambling. And this is what separates the investors from the gamblers and the speculators. It's to have conviction. And this is also why we are long-term buy and hold as well, because it's within that frame that we can actually let that conviction play out. We can tell our investors, we recommend 3 to 5 years because the cycle is unpredictable. I mean, I'm a fundamental analyst, but the reality is that fundamentals can predict very little in the short and medium term. And this is where the long term becomes important. And that's where you need patience, even when drawdowns are massive. Don't let that shake your confidence.
All right, thank you. Let's move on. Let's talk about something very important. Sam, fundamentals. We were talking about here in the green room, and do fundamentals really matter in crypto? Because right now you're seeing a lot of people calling for perhaps you should analyze crypto pretty much akin to what you do in the traditional financial market with the discount cash flow analysis and things like that, or crypto still should be valued on in the growth of network effects at this point.
So in 2 words, it depends. Let me elaborate on that. So it depends where kind of you are on the spectrum, you being an asset. So on one end of the spectrum, we've got meme coins, and their fundamentals do not matter at all, and no one's fooling themselves at that. And somewhere in the middle of the spectrum, we've got infrastructure, L1, L2s, and various other infrastructure providers. And for infrastructure providers, fundamentals matter a little bit. They matter in the form of the trajectory of those fundamentals, particularly things like REV, which is kind of like the fees all paid on the network. But they don't matter as much insofar as like fundamental like valuation multiples. And that's where I think L1s are more valued on a relative value basis. We can kind of elaborate a little bit more on that. And then at the other end of the spectrum are applications. Think of that primarily DeFi applications. And my view is that the further you are away from the L1, the more the application starts to resemble a business. There are real users, there are revenues, there are costs, and their fundamentals matter a lot. Right? That's revenues, that's fees, and also the multiples at which these applications protocols trade at, people also pay very close attention to. Now, part of the continuous debate is like there is a problem with fundamentals in crypto, and I can elaborate on that, which is the fundamentals are very reflexive. That's a primary problem, right? And what we see if SOL price is going up, then the revenues and the kind of KPIs people look at these applications starts going up. Meanwhile, the underlying hasn't really changed much, right? And that reflexivity, think of that as like, that's akin to, say, like Apple's revenue going up just because its stock price is going up, right? And like, that doesn't make sense. And that gets further compounded by airdrops and points farming and things like that. And the second issue we have with fundamentals in crypto is that people extrapolate a lot. So we have nearly like real-time data on how all this stuff is doing, and all of a sudden it hits an inflection point, and people think that's going to like hockey stick to the moon. And the third issue is leverage. People use a lot of leverage in trading in crypto. So those 3 compounding effects, what that results in is token prices generally overshoot on where fundamentals roughly are, and then they massively correct off the back of that. And that's what perpetuates part of this crypto cycle.
So I was going to ask you a different question, but we had dinner last night and we were talking about it. So picking up on the same topic here, you have to invest. You talked about the cycles, the 3 to 5 year cycles, and that's why you buy and hold, and that's the best way to provide outside returns to investors. But you also have to match that with the liquidity terms of your fund. And usually funds don't have 3 to 5 years liquidity terms. So how do you manage that in order to get your investors to buy into this?
I think because it's challenging. I mean, obviously my fund has been heavily invested in the Solana ecosystem over the last few years. And I think what is most important is actually selling an investor on the vision. Because it's actually the vision of the future that I think people are ultimately buying into. Because you're absolutely correct in that if you look at like things like real evaluation, nothing really makes sense. So we have to look at things on a comparative basis. And I think the vision is so grand, as Raul also presented earlier, where like crypto actually has the potential to replace most of finance. And I think after that, potentially also all of money. There's a profound vision here. I mean, this is much larger than I think most people even realize. And going back to my earlier point, like if you know that, if you understand that, that allows you to sleep well at night because you can have confidence in that vision. I think it's very important to impart that on the investors as well, to get them to understand what they're signing up for. You know, we never tell our investors guaranteed return or anything like that. No, it's highly volatile, highly risky. But if you believe in cryptocurrency, if you believe in that long-term vision, then this is the greatest opportunity of a lifetime, especially considering the disconnect as well between a lot of popular narratives and reality. Because that's where the opportunity also lies for investors like us.
It's definitely been a great opportunity of a lifetime for your initial investors. But anyways, picking up on that, Sam, let's talk about drawdowns, because I think one of the most important things for you to provide outside returns as a fund manager, it is to manage drawdowns, because we know crypto can have like 30, 40, 50% drawdowns in a month. We saw it twice this year. We saw it in February. We saw it now in November. So how do you go about it? Because sometimes these days, as I mentioned before, crypto market has evolved. You can hedge. People can move their net exposure back and forth. So how do you manage those drawdowns so that you are able to provide those outside returns?
Yeah, so we try and avoid those drawdowns, right? Listen, like an 80% drawdown is in most cases like a career ender. A CEO of a company whose stock dropped 80%, like the CEO is fired, right? A fund manager who experiences something similar, like they're going to find their way to the door pretty quickly. To put that kind of in context of what forms a lot of my thinking, my kind of very formative kind of investing career prior to crypto was at a hedge fund called Blue Mountain Capital, which was a $22 billion hedge fund, and I started as a credit analyst and kind of schooled in the thinking of Howard Marks of really understanding where you are in cycles, right? And he's written a lot about this kind of stuff. And I think the kind of economic and credit cycle that Howard Marks talks about a lot is actually very relevant in crypto. Right? And we see similar things happen through cycles, and that is the kind of euphoric narrative peaks. We have valuations get out of whack, and every time you have leverage hit new all-time highs. And so those things are actually fairly trackable, and that informs a lot of our thinking on kind of where we are in the cycle. Now, the difference with the kind of credit and economic cycles that Howard Marks alludes to, that he says over his roughly 50-year career he's experienced kind of 5 times, in crypto, it happens much faster. It happens much faster and far more frequently. And that's because of those 3 dynamics I outlined in kind of my prior observation, which was the reflexivity, the extrapolation, and the leverage. So really understanding kind of where you are in that cycle and making sure the risk in the portfolio is commensurate with where we are in that cycle is very important to managing the drawdowns that are unfortunately fairly typical in crypto.
So just for the benefit of the audience, just what do you make of the recent rout in the market? What happened?
So simplistically, what happened is in the kind of spring to summer, you had a run up in asset prices, particularly ETH and SOL, driven primarily by the DATs, right? DATs were buying a huge amount of both assets. At its peak, $2 billion worth of ETH was being bought by the DATs. And that drove price appreciation where like underlying things that were going on chain hadn't actually changed materially. The other thing we observed is as price goes up, leverage tends to go up as well. And so leverage across the system started peaking. And that creates the kindling for some form of market correction. And you can generally observe the kindling, but understanding what causes the spark is very hard to assess. And in this case, the spark was a tweet by Trump on a Friday afternoon around 5 o'clock Eastern Standard that said we're going to put 100% tariffs on China. And that just happened to coincide with a glitch on Binance that caused like massive deleveraging all of a sudden. That's what happened. And as a result of that, market makers and traders generally lost a lot of money and liquidity evaporated. And that's what caused additional volatility in underlying prices. We saw it in Bitcoin, and we saw it across all other alt spectrums. And that's what caused a roughly 50% reduction in the amount of leverage and a 50% drawdown in kind of alt indices. And that's roughly where we are today.
But managing for that kind of drawdown, what happened on October 10th, is very difficult for you guys. It's something that came out of the blue.
Yeah. So no one foresaw the Trump tweet and the Binance glitch, but you could foresee the amount of leverage increasing and just the dramatic price appreciation you had in a very short period in asset prices.
All right, so we have a few more minutes to go. Let's end with a specific question about the specific tokens. Hype. I know we talked about Hype. Hype has stolen the narrative this year. It's been the token that everybody wanted to own. And we're talking about that perhaps Hype's perps have pretty much eaten up on the, let's say, the dominance of Solana's revenues. But you believe that Hype has the upper hand right now, but Solana, and we're here at the Solana Breakpoint, can flip that very soon. Can you explain that and how do you position that in your portfolio?
Absolutely. And this is also where the middle hits the road when we're talking about research and fundamentals. So in particular, Hype has really challenged Solana in terms of revenue. And specifically, it's fair to say that Hype was able to do something that Solana was not, which was a central limit order book, which ended up being immensely popular because of its speed, because of the ability to do cancellation orders. And if we're being really honest with ourselves, Solana is just not capable of doing this today. So this is a real challenge. This is some real competition for Solana, something we need to take very seriously, something that thankfully the Solana community does take very seriously. And the reason why I don't think it will last, per se, is that if you look at Hype as an L1, it doesn't exactly match up to Solana. So therefore, we have this application that lives in isolation, that is therefore not composable with a larger DeFi ecosystem. Now, the good news here is Alpenglow. Alpenglow, by reducing the latency down to around 150 milliseconds, and also at the same time giving the ability to create cancellation orders, that allows us now to actually build a Hype-type perp exchange on Solana. And I think that is huge. And that is actually where we can see Solana taking back that dominance, because we can actually clearly see from like a technological perspective where that's going. Because Hype is very centralized compared to something like Solana. Hype is not particularly capable as an L1. And I think this vision and this thesis, I talked earlier about having a consistent thesis, is very important. I think composability is absolutely critical, because that's what creates the network effects.
So how do you fit that into your portfolio? I know you have a large position in Solana. Did you invest in Hype, but also at the same time, how do you manage that for investors?
Absolutely, yeah. I mean, we have a large position in Solana, but we also have a position in Hype. I mean, we always need to somewhat hedge our bets and our convictions, because the revenue is undeniable, the success is undeniable. So as an investor, we have the ability to diversify and hedge our bets there. Not too much, because conviction is important, right? But in our case, we can clearly understand the timeline, and we can actually, in advance, invest in projects such as, for example, Drift, that will be able to leverage the advantages that Alpenglow actually brings. And this is something to be immensely excited about, because there's not many other blockchains that actually have this capability. One of the few that I'm thinking about is something like Sui, for example, potentially also has this capability and is a little bit ahead of Solana in that regard. But Solana clearly has the lead in terms of these network effects. And I really do believe, if you look at the history of crypto, at least in terms of usage, like Ethereum, in terms of usage and revenue, overtook Bitcoin because it was 10 times better. And Solana overtook Ethereum because I think it was 10 times better. So I think for anything to overtake Solana now, it needs to be 10 times better. And I don't think Hype is that right now. And it's hard to actually identify something that is. And for that reason, we can have a lot of confidence in the thesis. And part of the reason why I'm so happy to be here today and to talk to all of you, because this is the future of finance and money.
All right, with that, our time is up. I thank you, everybody, very much for being here. I hope you enjoyed the conversation. I encourage all of you to perhaps go to their website, North Island Ventures, Cyber Capital, or also grab them. They're going to be walking around here during the day. Thank you very much for being here.
Thank you. Thank you.
Now to venture, and I feel really lucky because we're going to be speaking to Tushar Jain, who is one of the co-founders and managing partners of Multicoin. They're one of the earliest investors in Solana and its ecosystem. They write really brilliant research that I read, so I feel fortunate to be able to have this conversation. And for those who are used to traditional venture, this discussion is really about how venture is different in crypto, especially through the lens of Solana. So with that, could we please welcome Tushar Jain with applause from the audience, please? All right, how you doing?
Doing all right. It's good to be here.
Yeah.
I always love Breakpoint. It's, I think, the best produced conference in crypto.
Yeah.
Do you agree with that, guys? Do you think so? They crush it.
For sure. So, yeah, it's great to talk to you. And I'm just to give you a sense, there are a lot of people out, we're going to be watching this later, who are from traditional institutions, don't have your knowledge base. And so I think just starting from a high level, the best thing we can do is to probably point out some of the biggest differences between traditional venture and the work you're doing at Multicoin when you make investments in the Solana ecosystem.
Yeah, actually, this was one of the first posts we ever wrote. When we started Multicoin in 2017, I wrote this post called Venture Economics with Public Market Liquidity. And I think that's the biggest thing that's different in crypto compared to traditional venture. Because in traditional venture, you put in the investment, it just kind of sits marked at whatever the last round was. And underneath the surface, like, there's all this stuff happening. Right? The company's chances of success are increasing or decreasing. They lost a key person, or they hired someone awesome, or they won this key contract. But you don't have liquidity, and the price is just marked at the same level, despite all of this crazy stuff happening under the surface. And what's exciting about crypto is things go public way earlier in their life cycle. You don't need to be, a multi-billion-dollar company or protocol in order to go public. And what that means is, as an investor, you get to reassess your views. You get to see, how is the market pricing this thesis or this asset, and you can act on it. If the market is underpricing it, you can add more. You don't have to wait for them to raise a new round. If the market is overpricing it, you can actually sell some right now, even if the whole thing hasn't realized yet, because maybe the price is a little bit too high. So I think it's a very different style of investing. It's almost a crossover between venture and public markets.
Yeah.
Because it's not traditional public markets investing, because you're not investing in some of these protocols and they don't have the stability of an Amazon or
That's right.
Right? Like, you're not necessarily doing a big discounted cash flow analysis and understanding all the different business lines and then saying, this is going to grow at 2%, 3%, so on.
Right.
So it's kind of a combination of those two. It's like a venture investing mindset.
Right.
But with the ability to manage your emotions and manage your positions that you need in public markets.
Yeah, so I guess of course there's forecasts, there's management guidance that comes out when you have a bigger stable company and you can see if somebody's hit their numbers or not. You have the scrutiny of a quarterly reporting cycle. So when you have something that's much earlier in its adoption and has more volatility, what are you supposed to do from the standpoint of valuation? What frameworks are you using? What's helpful? What's actually kind of a red herring that takes you the wrong way? How should we think about that?
It's different for different types of assets, right? You have to develop novel valuation frameworks. For example, I gave a presentation in 2022 at the Multicoin Summit. The video is on our website at multicoin.capital on how to value L1s. So how do you value Solana, for example? Right? And I think it's a sum of the parts valuation with 3 components. There is a cash flow portion of it around discounted cash flow of MEV, which is cash flow to the chain, in a sense.
Right, so basically profit from transaction ordering.
Exactly,
okay.
Yeah. And then there's a commodity aspect of people need this in order to pay for transactions. It's almost like the gas concept. Why is oil valuable? Because you can burn it for gas. And then there was kind of this squishy store of value element of people own this because it's non-dilutable by governments, and we're worried about fiat debasement and things like that. And it's kind of a sum of the parts thing, right? But then you look at a DeFi protocol, and that same valuation framework doesn't apply anymore.
Right.
Now you're looking at, okay, what's the cash flow of this protocol, and how do I expect that to change in the future? And things are actually really different in crypto when you think about those types of valuations than in traditional investing, because everything is like open source and everything is permissionless. And so, to give you an idea of how we think about DeFi valuations, what we're really thinking about is how much risk does this protocol manage? One of the best theses that we developed, and also on our blog, is called Protocols Don't Collect Fees, DAOs Manage Risk. And this specifically lays out how we think about DeFi valuations, because what I think you're going to see is a lot of margin compression on DeFi protocols, because it's open source and permissionless, like I mentioned. But there is still a potential for value capture if you manage some risk in the protocol. And for both of these topics, I'm much more eloquent in writing, so check out the actual post. I'm just giving you the super high level right now.
Yeah, well, I guess then maybe another way to get at this, because as you say, you have to change frameworks depending on where something is in terms of size and where it sits, and if it does have a monopoly over something or it is open source. I guess then how should we think about the biggest risks that you are encountering in these protocols? I mean, is it, normally with the old equity world, you just look at the team, you look at if there is the usual 5 forces, the Porter framework, all that stuff. What does that look like here? It feels like there's memetics and narrative, and there's a sense of a timing of when you launch a protocol, and like it's so sensitive to the macros we were hearing from Raul. So do you find that you do have a risk framework that you continually use, or how does that work at Multicoin?
No, nothing is continuous. Like it's just like very much case by case, because these things are so different in how they get valued. Right, valuing a DeFi network is going to be very different than valuing an L1. Is going to be very different than valuing a DPIN type investment like a Helium or something. Is going to be quite different from valuing an infrastructure layer. Whether it's like a company that does like RPC or ZKTLS or any of these other middleware infrastructure products. So I think you have to truly understand each of those specific verticals and then apply the appropriate framework to that vertical. And that's actually what I like from a selfish perspective and as a professional manager love about crypto is, as a passive investor, you can go buy Bitcoin or something and like use the ETF or buy Bitcoin directly. Simple, you don't really need to pay someone to do that. But the opportunities for alpha are significant if you actually understand and deeply live in the world of these different types of protocols. You're coming up with your risk frameworks, you're coming up with your valuation frameworks. And that's not something that like a generalist investor is going to be able to do. You're just looking at too much stuff. You need to be focused, you need to be specialized. Yeah. And I don't think a generalist investor can compete at that level just because they're spread too thin.
Yeah, well, and we were saying earlier about how it's a barbell. You have your highly liquid passive positions that weight one side, and then active management is really something you should outsource because that expertise is totally specific and full-time, as you show at Multicoin. So I think the other big question that a traditional institution would have is really about this concept of like a token cap table versus an equity cap table. So at least from first blush, right, it seems like there's a big conflict. How can you have both? How can you coordinate behavior when value might be going to equity on the one hand, but then again, there's a whole utility side and a liquid token market. Should one collapse? Should one never be used? Should both be used? It's something that I think is a work in progress and is evolving with the space. But you have a seat at the forefront of all of this. And so how have your views changed with regards to that dual structure?
Yeah, this is something I've been thinking a lot about, actually, because there's a lot of historical path dependency to how this works. And the biggest problem this industry had for a long time was Gary Gensler and the SEC and their vindictive approach to anything crypto related. And so what we saw was people having to twist themselves into legal pretzels to be like, this is the utility token, it just does governance, has no claim on anything, and then over here is like the equity that actually does have a claim, and we're going to sell both to venture investors, but then to the public market, we're just going to sell this piece here because like that's what we can do. And it was just convoluted and quite frankly like inefficient and created all these problems. And now I think the world that we're moving towards is actually these things merge. And it's this concept I'm calling equity 2.0. Like, what does equity actually look like in an internet native world? Equity in the pre-internet world, in the printing press world, or the industrial age world, was just ownership. It's just ownership in a company and then some right to elect directors, and that's it. Super simple. But now we have all this programmability that has become available. You can do things like lock up your tokens. You can do things like use them in certain derivatives positions or contracts that weren't previously accessible or possible. You can prove how long you've owned the token. That wasn't possible with equities. Like, I can't prove to you that I've owned Apple shares for 10 years. How do I actually prove that? And so I think with equity 2.0, what we're going to see is this merger of the best practices that we've seen from tokens, which is internationally available, always liquid, always trading, ability to program them, most importantly, so you can do things more sophisticated than just own it, and ability to prove ownership and cryptographically prove certain attributes about your position. I think you're going to take those best practices and you're going to merge them with equity protections of I actually own the cash flows of this thing. I don't just have some vague claim to them, right? I'll give you an example of this. Binance Equity and BNB, right? Like, Binance is one of the most profitable companies on the face of this earth, right? BNB has a tangential, maybe sort of kind of claim to that cash flow. We'll theoretically burn based on kind of sort of the revenue that we make. All right? Really, those two things should be the same. The reason that they're not is regulatory reasons from a path-dependent history perspective. But what I expect we're going to go to, if Binance was started today, BNB would be equity. And it would be a combination of the two things.
So, and maybe to even give another example, that something from the traditional world that's not crypto specific for the institutions. What would this blend, this equity 2.0, look like?
So let me give you a really simple example. This is something I've been thinking about. I imagine everyone's familiar with Costco, the membership shopping store, right? Like, you need a membership. What if the membership was you had to buy one share of Costco every year in order to be a member? That's pretty interesting, actually. Now, what you're doing is you're converting your customers into your shareholders. You're going to end up with more loyal customers because they actually own your shares, and they can prove that they own them. And you're lowering your cost of capital by doing this, because now you have all these people Costco. If there's say 50 million memberships, and they can charge you, they can say you have to buy $100 worth of my shares every year, lock them up for 10 years in order to be a member. That's $5 billion a year of buying demand that they just introduced to their stock, for example, right? That's actually pretty substantial. So that's an example from the traditional world that I think is pretty easy to understand. I think it's going to be more sophisticated than that. I think the companies that implement this are going to be earlier stage companies. It's not going to be Fortune 500 at first, too risky for them. But I do expect in, say 10, 15 years that even the big Fortune 500 companies will be moving towards a equity 2.0 model. Maybe it's you get a discount. You've owned my shares for 5 years, so you get 5% off. Things like that. There's a lot of new design space that opens up with programmability of assets and verifiability of those assets.
Amazing. Well, these sessions are brief, but I think this is one of the most exciting things too. That will change how cap tables and the coordination of behavior with owners change over time. So with that, thank you so much, Tushar. Yeah,
absolutely.
We could all give him a round of applause.
Thank you.
Cool. So I'm actually going to stay on for one more panel fireside chat. So this is about income. So it's really the other side of venture for institutions who might be a bit more conservative. How does yield actually work in this space? How should we think about it versus traditional yield? And specific to Solana, what does that look like? And so the next conversation is with Evgeny, who's one of our managers at XBAM, who's a brilliant hedge fund manager, works with in the Middle East with a big market neutral fund and deals with these questions across DeFi all the time. So with that, welcome, Evgeny. How you doing?
Good. Thank you for the kind introduction.
Yeah, for sure. So again, I think starting at a high level is the best way to do this. What even is yield in crypto, and sort of what is institutional grade yield, especially vis-a-vis Solana, because it feels like across markets and risk engines and chains, everything is different. So that's my first question to you.
Yeah. So the problem with crypto is everything means nothing, and it means everything at the same time, right? So what is yield? Yield could be staking because you're underwriting security. It could be yield from lending, yield from market making or trading or what have you. But at an institutional level, if you're a TradFi allocator, yield is basically whatever you can package into that. So we've been running a market neutral DeFi yield fund for about 5 years now, basically delivering kind of market neutral returns every month. And institutions love that because it gives them an ability to squeeze out some value from the industry, to put it very bluntly, without taking any directional risk. And when it comes to Solana specifically, it's a very interesting chain to be discussing yield on, because there are some chains that are built for slow moving and kind of capital preservation, where like EVM and that sort of thing. And Solana has always been velocity, speculation, and kind of movement rather than static. But you obviously have the staking yield, which has been materially higher than for EVM.
Yeah.
You have lending, so Camino has done an amazing job with that. And then you have yields from JLP and other types of trading, market making operations. And when you combine all of that into a portfolio of yields, which are extremely diversified in the nature of the source of risk and the source of P&L, you can construct a pretty interesting portfolio.
Yeah. And how do you say more about that framework to assess the risk? I mean, it feels like the yield on Solana has always been amazing, right? Especially if there's a falling rate environment, you have a gross yield around 8% usually. And I look at something like Ethereum or Sui or one of these other L1s, and it's much lower. So is the risk higher on Solana, or how do you measure that?
So one interesting thing is we've realized, having built our own kind of DeFi risk management framework, is that risk doesn't always correlate with the return. Quite often you have very low yielding platforms which are basically untouchable from a risk perspective, and something else that is much safer gives you higher yield. But I think it's also important to separate the yield on the underlying crypto asset, so staking for ETH or for Sol, and yields on stablecoins, right? So these are very different beasts.
Yes.
Obviously Solana and some of the other proof of stake, POS chains, they just have had higher inflation for a variety of reasons, which frankly have nothing to do with their riskiness. It's just that's been the economic kind of inflation. And then when it comes to stablecoin yields, which you can then benchmark across all the chains, Solana is actually exactly on par. So we've deployed over $1 billion into kind of stablecoin yield strategies across pretty much every single chain, and hundreds, if not more, probably thousands by now, of protocols. And it's not like we can come to Solana and say, well, it's much riskier, therefore we demand a 10% spread. You're getting the same rates as an EVM, and it's all a function of the underlying protocol. And you can actually argue, due to the conceptual nature and philosophy of how Solana is built, it's actually more secure because it's less open sourced.
And so I guess if you were speaking to an old world institution right now, where should they, knowing their ICs and how they behave and everything, where should they actually spend time? Because I think what you're saying is, there's also these huge drawdowns which happen, and so maybe the yield is great, but if you still have full exposure to the downside, is it even worth it at all? Maybe with the stable coins, it's a better way to go. What would you say to the institution to direct them?
I think the biggest problem with institutions is education or lack thereof, and the career risk problem. right? So if you're an institution, you want to do the thing that is the most acceptable and not go beyond it, because best case scenario, you get a small bonus, worst case scenario, you get fired, right? So people optimize around that. So we've been spending a lot of time with banks and other types of players explaining to them that the typical counter argument we get is we tell them, listen, there's great yield and it's amazing, and like, yeah, but I'm taking crypto risk in exchange for 20% a year, and then I ask them to define what they mean by crypto risk, and they're like, well, Bitcoin going down, or like FTX. And then I explain that DeFi yields are completely different. The source of risk is software, and there is no other investment strategy in the world that pays yield in exchange for taking software risk. So we've been educating people that they can actually build a risk management framework that's very, very similar to fixed income. Where you give out 100 loans, and some of them might default, but the others that don't pay the yield, and then statistically over the course of your portfolio, you will hopefully be okay. And then if people are willing to take direct investments and they're paid to wait through positive carry on staking, that's great. But those who just want high yields, they need to understand there is a risk management framework which is really, really similar, and then you can deliver yields you can't get in TradFi with the risk that, from a mathematical standpoint, is lower than in TradFi.
Right. And so just to be intellectually honest, I mean, some of these L1s, they do experience downtime. They do have issues with oracles. They have issues where there is a stress scenario of some sort, a crunch of liquidity. That's a very different series of considerations versus just creditor risk and counterparty risk and things. So how does that work on Solana with your fund? I mean, is versus what an institution would do normally?
So I would argue that philosophically it's very similar to actual credit or default risk. In the sense that you deploy your capital somewhere, you'll get paid whatever 1% a year, or you will lose everything in one go. And whether you lose everything in one go because of a corporate default or fraud or a hack, frankly, doesn't matter. You still lose everything. So you can construct frameworks around that, but to your point, there are existential points of risk. So whenever you're doing anything in DeFi to earn yield, you're taking the asset risk, stablecoin or SOL, you're taking the platform risk and the chain risk. So some chains have just been horrible. Right? There's been, like Phantom Chain many years ago, basically blew up because the underlying bridge that was backing it was a multisig, and the Chinese police, arrested people who've been running it, and the chain collapsed. So you need to take it into account, because then, well, it's not a chain. So you have these existential risks, and you basically need to do your work and just avoid them and never touch them. Then you have things like Solana, which are obviously incredible. And, we're all here because we love Solana. Right. But the chain has been halted a couple of times.
Right.
And sometimes, good luck getting a transaction through. So you need to kind of model for that in how you allocate risk, because what if, ADL is starting to happen and you need to urgently move your capital? Well, you need to be ready that maybe you will not be able to do that. And then you can only deploy certain types of strategies where the urgency of movement is less relevant or less likely to be required versus, let's say, Ethereum. Right? So you need to design the type of strategy as a function of the type of chain you're using, because you need to be aware of these features and these risks, because this is all software that's being tested in real time, and you're getting paid pretty insane yields, but risk is there, and you need to know what you're doing.
Yeah. For sure. And I guess for most institutions, they're going to approach this looking at staking first, right? They're going to see, okay, ETFs, that's something familiar to me. I can get it in my brokerage. They seem to embed staking. But there's also a timing component to that too, right? I mean, in Solana's case, I think you can unlock within 24, 48 hours. But that's not the case with Ethereum or some of the others out there. And I guess how is this going to change over the next 12 to 18 months? As hopefully for Solana, right, it will be adopted. Everyone will participate in the ETF. People will realize this is a great opportunity, and they'll all come in. Is the yield going to collapse, or what will happen over time? How do you think about that?
Well, so I think the starting point is, if there is a business that can be commoditized away to zero over time, it will happen. So ETFs are raced to the bottom. I remember first reading about BlackRock's ETF with zero fees, 10 years ago, and just being blown away by that. Custodians, their fees are being commoditized, so everyone needs to upsell. Everyone needs to pursue and chase yield. So regulation has been the only blocker, where no one is going to sign off on this until they have a green light from the relevant regulator, which is basically happening now already. So people will go into that, and then these rates should go down, because why should Solana be paying this much over the long term to maintain the security? Probably that number could be materially lower. But ultimately, for these types of institutions, they, if they will not be investing in, let's say, Sol, because they care about yield.
Yeah.
Because, like today, Solana is down 6% because people don't like what the Fed did.
Yeah.
That's your year of yield gone in one morning. So the 99.99% of your return will come from price appreciation or depreciation, not the yield. So if they're investing for the upside, and yield is just a bonus. And if yield goes to zero, they don't care. And if it's an ETF product, they're selling excess, so they don't care either. But as long as they can offer you at least 1%, they'll do it because it allows them to push up their fees from 10 basis points to like 30.
Yeah, and I think there's a whole host of investors, to your point, who will like to look at this as a defensive type of position. So something that's fully exposed to the volatility, who cares, right? And so if you think about the market neutral side of what you guys are doing, that to me is regardless of the direction of the market, you're extracting these inefficiencies. So for an institution, that's very exciting because if the yields fall and they don't want the volatility risk, I feel like that is a durable compounding type of strategy. So maybe you can talk more about how that works in depth. Whether you're on the market making side or something with the arbitrage that you see across liquidity venues, just what RE7 does.
Yeah, and you're exactly right. It's much easier for anyone in the world to go into a market neutral product that just gives you 15-ish%, 20% a year very consistently.
Yeah. Because
you're less likely to get fired if you get into that, and that's what people care about. So structurally, DeFi yield, yield farming, and all those things, everything is very confused. Sometimes you just farm points and you gamble away, you do artificial volumes or whatever. But the real function and the essence is actually very fundamental. So when we were raising this, as I was launching this fund, launching this firm, and raising money 5 years ago, I was able to explain to traditional investors who backed us that we're performing a very structured role that banks do in the real economy. What is the function of a bank? It's to channel liquidity into the economy to make sure the wheels of commerce turn. Well, the function of DeFi liquidity providers as a whole, which includes anyone with a wallet, those who are doing it personally or professionally, doesn't really matter. You are, making sure that the spreads are tight. You're making sure that when someone wants to borrow on Camino or Aave, the cost of that is acceptable. So when you have, I think this year there's been about 2,000 new DeFi platforms that launched.
Wow.
They all need liquidity.
Yeah.
And I can tell you as a fact, there's not new 2,000 DeFi yield funds out there, not even 5 that can deploy capital at scale. So the nature of this activity is not arbitrage seeking, it's not farming points. Obviously, sometimes it's a part of that, but ultimately the core service is there is a supply and demand for capital, and there is a price to be paid for this capital to be rented out to various DeFi platforms for their own specific use cases. So then as a liquidity provider, you have to understand the source of risk you're taking. Are you market making coin A and coin B, and are you going to take impermanent loss or whatever? If you're lending, how is the margin call system being maintained? If you're underwriting insurance risk or derivatives or, you understand the source of financial risk, but ultimately 99% of what we spend our time on is smart contract risk assessment. So a few years ago, we built a framework on DeFi smart contract risk assessment where we follow the same philosophy as credit, where we analyze everything across like 50 different touch points, and we say this is AAA, triple B, triple C, and we construct a portfolio where we want to go to sleep and know that no matter what blows up in the world, we want to wake up to a portfolio that's up for the year.
Yeah.
And when you have 5 years of track delivering that, it makes institutions comfortable talking to you.
That makes sense. And I guess the other thing I would wonder is I would look at the track record of our market neutral funds in 22. Right? And I would say, okay, there are a bunch of guys who, because you say 20% every year, that's fantastic. But there are a bunch of guys who did fantastically well in 22 until November. Sure. And then the whole thing disappeared. And so I guess the question is, what is different now in what you're doing versus then? What are the key technology improvements or ability to deal with counterparty risk, that makes it different today?
It's like the more it changes, the more it stays the same.
Yeah.
Like you have a process and you constantly trying to improve your process, make it better. But at the core, it's still the same thing. So like the reason why we didn't lose money in 22 was basically twofold. One, things like Terra have never passed our DD process.
Yeah.
So we just blacklisted it. We've never put a single cent into Anchor.
Yeah.
So then you try to avoid the bad things.
Yeah.
And then you also acknowledge that sometimes things will happen that you can never foresee. And then you have to make sure that your exposure to them is contained. So for example, we did have some capital on FTX. but the amount was so small
Yeah.
that it didn't matter. So if you're in a position when no matter what blows up, you should be okay anyway, and in the meantime, you're doing the best you can to identify the red flags, everything else is just a derivative of that, and it's just a process, and every day you try to make it better.
Yeah, and I think, especially with Raul's whole discussion about the hurdle rate we all have, globally at 11%, you're not going to find the same safety with that type of ability to meet the hurdle rate outside of what you're doing, unless you want true directional risk.
And it's diversified, because in the real world, you lose money when the economy goes down, or credit blows up. Here, you lose money when software is hacked. So it's also a very good diversifier for those outside of the crypto world.
Yeah, perfect. So we're out of time, but I wanted to just let you know that it's now the lunch break, so everybody, it's available, I think, on all levels, and the next session is at 2:20. So if you could thank Evgeny for his expertise, we're very grateful for the conversation.
Thank you.
Thank you.
Please welcome your MC.
My name is Juliana. I'm from Bitwise Asset Management, a $15 billion crypto specialist asset manager. We're really excited to be partnering with Solana today to talk and help institutions and investors think about the role of crypto and Solana in a portfolio. To kick off the day, we've got Kyle Samani from Managing Director from Multicoin Capital to talk a little bit about the institutional case for Solana and why we feel like it's being set up to be the internet capital markets. Kyle, we'll love to get started.
All righty. Good afternoon, everyone. Thank you for being at Breakpoint 2025. My name is Kyle Samani. I'm a founder and managing partner at Multicoin Capital. Thank you for being here with me this afternoon. As some of the seed investors in Solana, we've had to re-underwrite our investment in Sol as it's gone up in price over the years. Earlier this year, we went through that same process again, and we concluded that Solana is still in the best position to be the dominant smart contract platform. Today, I'd like to talk about what undergirds our conviction. The short answer to that is internet capital markets, but the longer and more nuanced answer that I'm going to talk about over the next 10 minutes is really why we think Solana has the core properties you need to power global scale internet capital markets. Before I start, you should read very fast. Here are some important disclosures for all of you. Cool. All right, so a couple of months ago, I gave a presentation at the All In Summit that laid out kind of the big idea behind internet capital markets. In that presentation, I described internet capital markets as a system in which anyone can trade any asset anywhere in the world 24/7 with just their phone and an internet connection. From an allocator's perspective, we think internet capital markets is really one of the most important ideas happening in the world today, up there with AI. But really, no one has actually articulated, kind of tried to answer the question, well, what are the core properties you need to make a system actually able to support internet capital markets at global scale? And there are a lot of subtle design decisions that need to go into thinking about this, and I want to answer those questions today. So we think there are basically 4 core properties you need in a system that is going to undergird internet capital markets. And those 4 are global liquidity, censorship resistance, credible neutrality, and jurisdictional sovereignty. So let me jump into each of those. First is global liquidity. This is a pretty straightforward concept. Internet capital markets obviously should be able to tap into liquidity anywhere in the world. But there's a little more nuance to think through beyond that. I want to give an example to make that clear. Let's say you live in the US and you want to buy stock A on-chain. And let's say there are 3 different trading venues on-chain. You have something like from the New York Stock Exchange that's on-chain. You have something from the London Stock Exchange that's on-chain. And let's say a permissionless DEX like Drift. And all 3 of those exchanges are trading stock A. If you have the KYC credentials to trade on all 3 of those exchanges, then you should be able to tap into liquidity across all 3 of those venues and not just one. And by tapping into that liquidity, you should then receive the underlying asset back to your wallet instantly. Internet capital markets are global, but the world is regional, and we're going to have different venues on-chain. And we think it's super important to preserve this idea of being global while still recognizing the reality of regional rules, jurisdictions, and KYC. And we think this global foundation Solana provides can actually accomplish that. Next property I want to touch on is censorship resistance. There are obviously always going to be instances in which countries try and block people from doing things on-chain or accessing internet capital markets. And obviously, the more centralized the system is, the easier it is to censor. Decentralized systems are obviously much harder to censor, and crypto has really proven that we can actually have globally censorship-resistant systems. Today, I think it's generally recognized that Bitcoin, Ethereum, and Solana, at the very least, are genuinely censorship-resistant systems. The key property, of course, that makes these systems censorship-resistant is having block producers all over the world in many different jurisdictions and regions. And today, of course, across these different systems, there are thousands of nodes producing blocks across more than 100 countries. Next property I want to touch on is credible neutrality. This is probably the most subtle of these 4 properties and maybe the hardest to appreciate. On the surface, censorship resistance and credible neutrality appear to be fairly correlated, and they are. Maybe the more nuanced way to think about it is that the more censorship resistant a system is, the harder it is for any one actor to weaponize the system against other actors. But the correlation between these properties starts to get a little fuzzier as you get into more nuanced situations. If you consider the Solana network today has about 1,000 block-producing nodes across 48 countries. There are 210 countries in the world, and so that means obviously that not everyone in every country even has local representation there. But even if you did get at least 1 node per country, most of those nodes are going to have a tiny amount of stake. And we think it's fairly unlikely that if you are a regulator in a smaller country, that you're going to look at a system in which you have 0.1% or 0.01% stake and think that's credibly neutral to the citizens of your country and jurisdiction. And so this idea of credible neutrality, it's easy for us to take for granted in some of the major metros, but much harder as you get to smaller environments. And then the fourth property I want to touch on is kind of this new idea that we look at called jurisdictional and application sovereignty. On the surface, this property seems a little bit at odds with the prior three, which are all kind of intrinsically global in nature, but I don't think it has to be. For anyone who's studied the history of financial markets and exchanges, you know that there is not one correct construction for market microstructure. You have taker speed bumps, you can have maker cancel priority, you can have maker rebates, you can have priority liquidations. There's all kinds of mechanics you can play with in different microstructure designs. And if you look across the world at the major trading venues today, across equities, commodities, FX, and others, you see that there's not one uniform standard for that. Well, if you have a single global system, how are you going to reconcile these different microstructure realities against one global system? And so we believe that in order to have internet capital markets, you need to be able to respect the needs of regulators and exchange providers in these jurisdictions. And so the next question is, well, how are you actually going to achieve all of these objectives in one system today? Because as of today, no blockchain in the world does all of the above, but I think the folks at Solana are working on it. We think there are fundamentally two major technologies that are now being worked on that we think unlock all of the above. And those are MCL, multiple concurrent leaders, and application-controlled execution, or ACE. If this is your first breakpoint, MCL was actually introduced by Anatoly 2 years ago, and ACE was actually introduced last year. We think these two core ideas, which are now both under active development from Solana core engineering, are going to be the two things that really facilitate internet capital markets at truly global scale. So let me explain that. Today, almost all major blockchains are single leader systems, whether they're L1s or L2s, EVM, SVM, or something else. And what that means is that at any one moment in time, there is one block producer somewhere in the world that has a monopoly on block production. The premise of multiple concurrent leaders is actually pretty straightforward. It's, of course, the idea of having multiple concurrent people producing blocks at the same time. The reason this is important for things like credible neutrality, in particular, and censorship resistance, is that it allows you to kind of multiply effective stake. If you have a system where you have 100 block producing nodes at the same time, and you have a 0.1% stake in that global network, that would be the equivalent of having 10% stake in a single leader system like Solana is today. And so we think that the ability to have way more concurrent leaders is going to allow there to be more nodes in more places, which is ultimately going to make regulators and application developers in all of these longer tail jurisdictions feel comfortable trusting this global system. The second major technical requirement we think that's going to be key to unlock this vision is application-controlled execution, otherwise known as ACE. On the surface, it would appear that a single integrated system like Solana is really antithetical to this idea. And this is why application-controlled execution is really necessary. ACE will allow developers to specify custom ordering rules, things like maker prioritization, taker speed bumps, maker cancels, priority liquidation, all these different things, all while still being on one global system with one global liquidity pool in the way that Solana is today. ACE really allows regulators and exchange operators, whether you're the London Stock Exchange, the Hong Kong Stock Exchange, or anyone else, to define their own custom rules while still tapping into the benefits of Solana as a global system. And we think this is super underappreciated. To recap, we think internet capital markets are going to require four properties to really get to global scale. And those are, of course, global liquidity, censorship resistance, credible neutrality, and jurisdictional and application-specific sovereignty. We think if you look today at kind of designs of these systems, the only one that's actually going to get you there is Solana. Ethereum, maybe it's credibly neutral. It's definitely censorship resistant. It definitely provides global liquidity. But you look at the L2s, they don't really achieve any of the first three objectives. And we think that this is going to be the path that's going to truly get global buy-in from heterogeneous participants all over the world. Well, we think Solana is really building the most ambitious vision for the future of internet capital markets. And that's why we're so excited about where Solana is and where it's going in the years to come. So thank you all.
Thank you, Kyle. My name is Danny Nelson. I am on the research team at Bitwise Investments. I'm going to be your co-MC for the afternoon. And next up, we've got a debate, actually, featuring our CIO, Matt Hogan. He's going to be talking with Max Resnick, the lead economist at Anza Labs, as well as Ren from Electric Capital about Solana. Is it the one chain to rule them all? We're going to get into that debate. I'll invite them up now. Thank you, and stay tuned for the afternoon.
You can clap. It's all right. All right. All right. Welcome, everybody. This is going to be really exciting. We have 14 minutes and 48 seconds to decide if Solana alone can support all of Wall Street demands. Max, can you give like a 10-second introduction to yourself? We'll get to your opening statement in a second. Just introduce yourself.
Hi, everyone. I'm Max. I work at Anza. We work on the Agave client, building Solana, making it IBRL, making it ready for internet capital markets.
Amazing. Ren, perfect. You look just like your photo. Why don't you introduce yourself?
Hi, I'm Ren. I'm a general partner at Electric Capital. We've been longtime investors in Solana, supporting the ecosystem, Bitwise as well, and excited here to play devil's advocate to Max.
That's right. All right, we're going to run this as a traditional debate. We're going to give 2-minute opening statements, and then I'm going to moderate a discussion. Max, we'll start with you. 2 minutes. Start at 14, you get to 12.
So, can Solana support all of Wall Street's demands today? I'm going to argue yes. But first, what are those demands? I think there's 3 things that they really want. They want the scale to handle all the trades that they process. They want the market structure that will preserve the deep liquidity and tight spreads that they're used to. And they want regulatory clarity about what's kosher and what's not. On scale, we've made tremendous strides thanks to the work of Anza and Firedancer developers over the last 2 years. We actually had 100,000 transactions per second on mainnet, not on testnet, not in a white paper, in production this year. And the only thing that went wrong, we actually fixed it right afterwards. So that's ready today. Market structure, the prop AMMs are evolving in real time. They're providing tighter spreads. They're doing 3 times the volume of Binance on Sol USD right now. It's hyper competitive and it's getting tighter and more liquid every day. On the clarity side, we have NASDAQ listed securities, Class A securities, on chain on Solana today through people like Superstate. So that's already on chain today again. But let's flip it on its head. Is the current Wall Street infrastructure really ready to support what they want to do? It has a lot of problems too. For example, to issue a security on Wall Street, you hire underwriters, they hire counsel who file with regulators. So then you deposit certificates at a central depository, it immobilizes them and credits position to custodians who credit sub-custodians who credit beneficial owners through transfer agents who maintain registers. Okay, that's issuance. Now you want to trade. You don't trade your own assets, you trade somebody else's, so there's counterparty risk. There's clearing houses, they step in to novate and provide margin. None of that's atomic with cash settlement. Okay, that's trading, and then what about settlement? Well, it's all on a T+1 cycle. So those registers that we talked about earlier are always slightly wrong, and you can never know who actually holds your security. On Solana, you issue it on Solana, you trade it on Solana, and you settle it on Solana in T+1 millisecond, not T+1 day.
All right, 100,000 transactions per second, removing all the middlemen. You have the floor, Ren.
Great. Thank you for the opening, Max. I have four main themes I want to touch on today. The first theme is about where Solana is today and not necessarily where Solana is going in the future. In terms of where the network is today, Solana today is not ready to support Wall Street's demands. On throughput alone, the peak message demands dwarf Solana's current TPS budget. There are millions of messages per second on peak load on NASDAQ, trillions of messages a day on NYSE, and that's not even considering all of the dark pools and various ATSs that surround the major exchanges. And even if we strip away the limit orders and keep the transactions to settlements, we're still orders of magnitude away as of December 11th, 2025. Second, the vast majority of Solana programs today have audits done pre-deployment, with security, which makes a security profile challenging for Wall Street to adopt it today. It's really tough for institutions to deposit hundreds of millions of dollars into opaque programs that are sometimes upgraded multiple times a day. Before we talk even about onboarding Wall Street, how about we onboard the digital asset treasuries first? They're the most crypto native public companies and participants in TradFi markets. And if they're not even able to use liquid staking tokens or deposit into Camino, if we can't even onboard them, then let's forget about onboarding the rest of TradFi. My second theme is revolving around legal finality versus cryptographic finality. Legal finality in markets allow for error corrections, busted trades, regulatory interventions. It involves courts, arbitration, and central authorities. And this law is also different depending on the region. Cryptographic finality is something that we're all familiar with. But the tension between these two is a debate for judicial systems around the world in various countries for the decades to come. Third, Solana is fast, but not set up to support the heterogeneity of global markets today. Wall Street is not New York. Wall Street is not Chicago. Wall Street and the traditional financial system is spread throughout the world in hubs like the UAE, Hong Kong, Singapore, Tokyo, Shanghai. And the laws of physics make connecting all of these regional hubs very, very challenging in terms of where the single leader network is today. Those are my
All right, points. I love it. Max, we'll go back to you. What do you say about 1 million transactions per second and trillions per day? Is it really ready?
So I think that's a consequence of a very bad financial market design in traditional finance. That's antiquated. It's based on central limit order books, which we know now are not the best design for markets. We have on-chain a new system, proprietary AMMs, where a single Oracle update does the equivalent of what would be hundreds of transactions on a Wall Street market. And one of the things that they do to make these numbers seem really big is they have these like terrible market structures where they have price time priority. And so when you place an order on the order book, you get priority based on when your order arrived. And so if you arrive late, you have to cancel it and replace it. We don't have to do that. That's a terrible system, and it creates inflated transaction demand. Yeah, I think today we can handle a lot of trades. We're going to have P token early next year. That'll be even more trades. We're going to continue IBRLing. I think you should start onboarding now, and by the time everybody realizes what they've lost, you're going to be way ahead of the competition.
I love it. Max talking about fake volume in TradFi, which is an irony. I guess. What do you say to that? Is Wall Street even the right target? Should we be talking about replacing Wall Street as it is, or should we be talking more about what Max is saying, which is like this alternative system that's better, faster, cheaper?
Yeah. Just a quick counterpoint to Max. Most of the private AMMs today, at least the way they're quoting, they just take Binance's mid and a very weak form of alpha and offer that through an RFQ, effectively an RFQ system.
Maybe the ones in your portfolio, but you know.
Oh, okay. I'm glad I'm in the middle.
I think the allure of the trillions of dollars, both of assets and volumes that are driven through the traditional financial system, are really alluring. But I really think that the opportunity for Solana is doing things that the current system cannot. So there are thousands, if not hundreds of thousands, of small to mid-sized digital cross-border businesses that I think have true struggle access to capital. Access to capital in the US is quite easy for the brightest entrepreneurs, but elsewhere around the world it's more challenging. And I think there's tremendous opportunity for Solana to focus on becoming the place where businesses can go public online.
I love that. Let's see. Let's talk about if we even want one chain to replace Wall Street. I know that's a big debate. In Wall Street, we chop it up into 1 million different pieces. We separate issuance, trading, settlement, clearing. You made the case that that sounded complex. I guess what would be the steelman argument against your point of view? And do we really want it all in one place? Is that too much to put on one ecosystem?
Yeah, I think if you tried to put it on Ethereum, it would fall over and die because they're not ready to go. They don't have the features necessary. They don't have the scale necessary. So I think there's an argument to be made that you should design each little piece in such a way that it does exactly what it's designed to do, and maybe you get a better outcome that way. I think the counter argument to that is when you start hooking them up, that's where all the tension and all the bad stuff happens. And so the modular designs, even though within each component it acts really well and it's designed for that, they're not designed to work together, and that's kind of the issue with it.
Yeah, now you're doing an admirable, honest job of defending ETH at this community. So I want to give you credit for that. And I know you're a big Solana supporter as well. But make the case for this modular design. What's the best response to what Max said in terms of, is that a better structure for replacing Wall Street?
Well, Wall Street today is quite modular. Like each of the respective regions have their own set of jurisdictions. There are a small set of globally important financial institutions, but by and large, the way that the market structure looks like in TradFi, it is quite modular and distributed. I think there are tremendous economic benefits from having the whole stack on one system, but I think the practicalities and the realities that crypto has to be okay with is understanding that although one chain to support them all would be, in theory, economically efficient, I'm sure there are plenty of different regions and countries in the world who would like to have some, like, their own opinion and potentially different choices that are predicated on more regulatory types of reasons and less about pure efficiency.
Yeah. When you close your eyes and imagine the future state, do you imagine it all on one chain, or do you imagine like a 60-30-10? Do you imagine a regional distribution? What do you actually think is going to happen?
I think probably 90% will happen on one chain, but I think that time scale is not a 5 to 10 year horizon. I think it's something that probably our children will grow up with.
There you go. One chain to rule them all eventually. I want to throw that to you. What do you, when you close your eyes and there's not a room listening to you, what do you think the future looks like?
I just see Solana everywhere. Just information flowing in all over the world into this one place. All the trades are happening here. Yeah.
All right. What's the thing that could break that for you?
I think it's us. If we don't ship, if we don't do the work that needs to be done, if we don't pound the pavement and get people on board, and they don't know anything about Solana today. And so even this week, people are at Abu Dhabi Finance Week like, what is Solana? Is that like Avalanche? No. That's not like that. That's Solana. We got to educate people, and we got to keep going and keep pushing on that, and keep pushing on the technical front as well.
Could it go too fast? The chairman of the SEC said a few days ago that all U.S. stocks would be on chain in a couple of years. For context, there's about $680 million of stocks. That's 68 trillion. That's literally 100,000x. If that happens in a few years, will Solana be ready?
I think we're ready today. It's a blockchain. It's permissionless. You can build whatever you want. If it doesn't have the thing that you want today, you can go and build it because it's a blockchain. You can write your own program, and it can do whatever you want.
Do you think we're ready today?
I don't think we're ready today. I think Solana is probably the leading contender for where this all happens, but it's important also to recognize that crypto and Solana is relatively early on in its global adoption, and especially adoption from TradFi. I'm personally still waiting for Fire Dancer. I would love to see multiple concurrent leaders happen next year. I think that it's important for the Solana ecosystem to keep a day one mindset and to understand that although the ecosystem has come a long way, that there's still a lot of work to be done.
Does the MCL idea solve your physics problem?
It does, yeah, to some degree.
Right. Yeah, when are we going to get there?
Come to my talk tomorrow on the dev stage.
Oh, wow. There's some alpha from the debate for people who are taking notes. All right, we have 1 minute and 37 seconds left. I guess I'll go to closing statements. We want to stay on time. What's the strongest 3-sentence pitch you can make for Solana being the one chain to rule them all?
I don't even need 3 sentences, okay? Issued on Solana, traded on Solana, settled on Solana.
All right. That's 3 phrases. That's pretty good. All right. That gives you 1:10. So Max just ceded you a bunch of time. What's the strongest pitch for the other version? For at least until your kids are here, for it being a multi-chain, diversified world?
I think the single strongest reason that I have today is that the real world is really complicated. When you build systems within a digital realm, you can keep everything very elegant and simple. But when you are building software for the real world, the complexities of the real world gets melded into the software in itself, which introduces a lot of complexities. I think these are things that are solvable, but I don't think it's where the network is. I don't believe it's feasible today, but I think Solana has a great shot in the future.
It's a great shot. 24 seconds. If it has such a great shot, if even for our non-Solana voice here, which you played so admirably, when will the market valuation recognize that?
I think the market valuation will start to recognize that when things like fire dancership, when things like multiple concurrent leadership. I think one of the biggest concerns from the market is that Solana has lost its edge. And I still think it has the dog in it, but I think that's something that we'll see over the years to come.
All right, we're going to go to the speech tomorrow, Max, and see if it still has the dog in it. Everybody, give a big round of applause for Ren and Max. Thank you all so much.
Thank you so much, Matt, Ren, and Max. That's such a great debate. What we have next, we're so pleased to have Avi Dunis, the Managing Director of DBS, the largest bank in Southeast Asia, accompanied by Brian Raimondi from Bitwise Asset Management, the Head of Institutional Partnerships. We're so excited to have them because they're going to start having a conversation about how institutions are getting more comfortable with Solana. And as a frequent question we often get is, are institutions coming? When are they coming? And we think they're here. We're just really excited to see this conversation, and thank you so much for being here.
Thanks, Juliana. Is this thing working? Yep, there we go.
Hello.
So yes, the institutions are here. Is that anything else? Are we all set?
It's done.
Appreciate everybody coming out. Very excited to be chatting with you all today. I'm Brian Raimondi, as Juliana said. I head up institutional partnerships at Bitwise. We work very closely with the Solana team. Very excited to be chatting here with my friend Avi today. Avi, please take a moment to introduce yourself.
Hi, I'm Avi. I'm here from Singapore. DBS is Southeast Asia's largest bank. We're the third largest private bank in Asia, and we're the second most profitable bank in the world. The 21st largest bank globally. And we've been doing this since 2020. So very excited to talk a bit more about what we've been doing and how it's been going for us.
Absolutely. So I guess we would start with what's it been like to be working within a large global bank, one of the largest banks across Asia, in digital assets over the past 5 years. We've had some highs and some lows as an industry, and
yes.
you all have stuck it through and seen an incredible amount of success. So maybe just walk us through that journey a little bit.
Yeah, we started talking about it in 2018. The reason we started talking about it was threefold. The first one was because we thought tokenization was going to kick off much faster than it has. Secondly, we saw demand from our private banking customers who wanted to buy into crypto, but they wanted to do it through a safe platform for the amounts that they were looking to place. And thirdly, we are a very data-driven bank, so we saw outflows to the exchanges, and we wanted to bring that back in-house. And that's how our discussion started on building our own exchange. We built our own custody first, which launched in the middle of, in August of 2020, and then the exchange at the end of 2020. And we started very small with Bitcoin, ETH, Bitcoin Cash, and XRP. And we built from there. We launched structured notes and options in 2024. We tokenized those in 2025, and we distribute them through real-world asset licensed players within Singapore now, but we're looking to expand that. That's what we do on the trading side. On the banking side, we've also been supporting the ecosystem since 2020. Singapore came out with a PSA license, and we started providing services to those that were licensed in Singapore, and now we bank most of the big players within the digital asset ecosystem that have presence in Asia. And then on the innovation side, first project we did was 2016. It was called Project Ubin on payments. And from there, we built out commercially viable use cases. And that's why I said we're the second most profitable bank in the world. We focus on use cases which are commercially viable, demand from our clients, and something that we can really scale. So that we started with Ubin, and now we've got tokenized deposits, purpose-bound money. When you go to Singapore and you get your payments done via our Payla app, the rewards are blockchain-based. We just announced with JP Morgan that we will look at the framework for interoperability between tokenized deposits, us and them, and we do many more initiatives. We also work on tokenization of financial markets. So as I said, we tokenized our notes on public chain, but we're looking to tokenize many more projects, again with a focus on scale and on demand, not so much on supply one by one, really looking at where the demand is. Maybe one more announcement we did recently is that we announced that we will partner with Franklin Templeton and Ripple to allow RLUSD and SG Benji, the Singapore version of Benji, to be traded on the exchange, but also look at how we can do repos with that, how we can use it as collateral for trading, and so on. So those are a few of the things that we've done over the past years.
So Bitwise has a slide that shows institutional adoption across all the banks globally, and there's little box ticks for each one that have, as new products come online, we have to create new categories consistently for AV and DBS. So a testament to all the work you guys do in the space.
I didn't even answer your question of the industry, and now I realize I saw everything that we do. And then you said, how was it?
It was perfect.
I started in this role on the 1st of November 2022, which wasn't a great time. Nothing going on that day. Something else happened a week later. Yeah. So it was very interesting. But what I think was very interesting about it was, while it was obviously not fantastic to happen, that's the least to say, it also gave some sort of a reset. And we can work with a lot more partners to look at how can we reshape the way things are run. And we, during the quiet time in 2023, 2024, we could really work out what does the next level of digital assets look like. And we did that very diligently behind the scenes. And I'm very proud of those that we worked with and how far they've come since that time. So we weren't resting on our laurels. We were just it was just not as publicized back then as it is right now.
Bear markets are for building, after all.
And we did the same thing.
Yeah. Excellent. So over the past 2 years, things have been a little bit more front and center in terms of institutional adoption. This term that, running institutional at Bitwise for 5 years, you go to panels like this, you hear these talks, and institutional adoption gets thrown around like hopium, for lack of a better term. Wasn't really there. Today, it's tangible. You could feel it sort of everywhere you go. It's in the headlines, whether it's sovereign adoption right here in the UAE, wirehouses adopting products from asset managers like Bitwise, corporate participation, which we're talking about here today as well. Kind of the list goes on. So enter Solana, and it does feel like with the inception of the ETF, read ticker BSOL. Everybody, if you want to pull that one up at some point today. We are shameless plug. We're really starting to see Solana's moment just kind of come to the forefront. So how is DBS approaching that? How are you thinking about that? 3-part question, and our clients are asking about that.
So institutions coming in, you're right. In 2022, when people said we have mostly institutional clients, my question was who? Because I'm part of the financial institutions group, and I was like, the vast majority of the ones that we service are not actively participating because we speak to them. So who is it then? And it was most of the time we're digital asset native institutional investors. Fast forward, when you looked at the ETF inflows in Bitcoin to begin with, we looked at the makeup of the investors, and you could really see that already more than half of those were traditional institutional players. You could at the same time see more questions. So for example, when we started launching our notes, you could see a lot more demand from private banks, from more the traditional side.
Hedge funds.
Yes, but not limited to hedge funds. Mm-hmm. And maybe I'll speak a bit more about that. You could really see the more traditional side come in with interest into what is the asset class, how can we deal with it, And the ETFs were a big point in that. And fast forward to now, 10th of October was not a great day. But what you could see was a difference between those that had ETFs versus those that didn't. The difference was quite remarkable. Sorry,
No problem.
in terms of drops.
Yeah, October 10th, I would agree. It's a little dry in the dry desert there. No problem at all. Yeah. It's yeah. Take your time. She gets very emotional when we talk about institutional adoption.
I'm sorry. No, it's okay. This water is fine, but something went into my throat. This really sounds like I'm very emotional.
October 10th. Yeah.
So the ETFs really helped to stabilize it because the outflows from the ETFs weren't as big. Wow.
Stable hands.
Stable hands. And you can see that now with some of the other coins coming in as well, where you will see the same trends come in. My God, something went into my throat.
No doubt. One thing I would add, just in terms of what we're seeing at Bitwise, and I think there's been a marked difference in sort of like the crypto Twitter sphere versus the institutional adoption, the wirehouses continuing to work on their IDD, their ODD. Like we've seen like 4 approvals from large US/global banks in the past 3 weeks that do not care if the price of Bitcoin goes down 15%. Like this is something, like they've made a decision, they're here, they're not going anywhere. And it's sort of like they're gung-ho in a way. Charles Schwab is investing, Franklin Templeton obviously leaning in via your partnership. It's nonstop right now. It's kind of all we can do to keep up with it. And it's not impacted by a small hiccup in the market.
Yeah,
I agree.
You could really see the difference. Also the volumes on CME, open interest on CME overtook at one point in 2024. So you could really see the difference coming in. And so you see it now as well. And on your question on client demand, yes, on the exchange we service a private bank, institutional investors, as well as B2B2C. With the B2B2C, what you could see was there was a lot more demand for Solana, for example.
Mm-hmm.
It was actually the first one that came up as one of the coins that they wanted to see more of, and that people wanted to be more active in. And the way we think about it, I'll say later, because I know there's a question on that.
We didn't plan anything. Actually, I had a set of questions that I wanted to ask Avi, and we were on the way over here in a car, and she just completely ripped them all out. So just going off the cuff here. One thing I think it's interesting to talk about, family offices have really led the way from an institutional standpoint. I think, whether it's here in Abu Dhabi, whether it's in Singapore, whether it's in the U.S., they've been great at sort of accelerating the I think the education and ultimately the adoption. If I'm a family office, I'm not yet, I hope to be at some point, who already owns Bitcoin and, dare I say, Ethereum, why am I going to think about adding Solana? How does that differentiate my portfolio versus just upsizing my existing allocations and having to learn about this new chain that's just come on to sort of financialization rails?
We can talk about family offices, and we can talk about then the longer tail of the private bank, right? So the way that I'll first talk about how they've been investing. So what we could really see in 23, 24 was people were accumulating.
Mm-hmm.
So people were accumulating. Trading was far less. They were holding and seeing what was happening. This year, you can see a lot more trading happening. And the way we discuss it, indeed, many start with Bitcoin. And then there is a lot more interest in what are the alternative altcoins that they could look at. And then you look at market cap, you look at activity, look at the whole ecosystem, and we do a lot of education on that. There are webinars on a quarterly basis, but also when there's any questions, people can just come in. So how would you allocate? As we spoke about, the way we would describe it is Bitcoin is Bitcoin, it's its own category, but then you've got Ethereum, Solana, and you can basically think about it as Apple versus Microsoft, or just two different technologies, but both being able to serve a wide need. And I mean, in crypto, like we have to think a bit more long term.
Yes.
So the way the team is building it and trying to build out the Solana ecosystem is encouraging.
That's great. How do we feel about, I guess we have a minute and a half left here, so we can go straight to the lightning round.
Okay.
If Solana were a traditional asset, what would it be?
Like I said, Microsoft or Apple,
That's,
right? You choose the one that you want to be.
Yeah, no doubt. Maybe quickly, what's the sentiment specifically from Asian clients right now? I feel like they're always a little bit ahead of the curve.
I think they're still very active, still very much looking at it. And what you see, interestingly, is that clients, it's a lot of clients that traditionally didn't make their money in digital assets. So in the past, you might have had people who are very familiar in crypto and they keep doing it, or they have a self-interest. But now you see it as part of the allocation of the portfolio, just another alternative asset.
Yeah, as it should be.
Yeah.
What do you tell a skeptical CIO, whether it's crypto, Solana, digital assets in general? And if you have 20 seconds.
Well, we were joking now. I said, you have to do your own research, of course. But many people ask, when is it a good time to come in? And I think any time is good when you think long term. So that's what I usually say.
Dollar cost average is
dollar
our
cost
go-to.
average.
Yeah, when in doubt, zoom out.
Yeah.
Awesome. Thanks, Avi. Thanks, everybody.
Testing. Thank you. We got coming up next, we got Shanti Leon, a VP of Institutional Partnerships at Bitwise, and Cosmo Jiang from Pantera. They're going to be talking to us about the DAT trade. It's an evolving ecosystem. There's a lot of opportunities out there. There's also some things you got to watch out for. And so they're going to be bringing us up to speed on what is happening in the DAT world. Give it up for Shanti and Cosmo.
Good afternoon, everyone. My name is Shanti Leon. I am VP of Institutional Partnerships at Bitwise Asset Management. This session will focus on the proliferation of digital asset treasuries across capital markets this year. And joining us is an expert on the space, or maybe the expert, Cosmo Jiang, General Partner and Portfolio Manager at Pantera Capital. Welcome, Cosmo. Thrilled to have you here.
Hi, thank you. Nice to see everyone. Nice to talk to you, Shanti.
Great. So, Cosmo, a lot happened this year with digital asset treasuries. If you could give us a quick overview of the DAT landscape today, and then the role that Pantera is playing.
Yeah, maybe it's helpful if I rewind a little bit. This space has grown very quickly, and some might say has deflated very quickly too. If I rewind back to even a little bit earlier this year, we've done a lot of work into MicroStrategy to understand why it had traded at premium for so long. It just seemed anathema to everything I understood as a fundamental value investor. But as we really dug in and re-underwrote it, we realized that, wow, these can be very sustainable business models if executed correctly. And by the way, maybe it actually makes sense to do it with an asset outside of Bitcoin. And so when we were approached by a really exciting management team in March that they wanted to start the first US, we were calling them MicroStrategy copycats at the time, MicroStrategy copycat here in the US, focused on Solana. We got very excited and ended up investing, anchoring, bringing to life what was the first MicroStrategy copycat here in the US. Next week we were approached by Tether and SoftBank about their Bitcoin DAT, which ended up becoming 21 partners, which we also ended up anchoring and being the largest investor in. At the time, I thought those would be the only two MicroStrategy copycats that ever existed. And lo and behold, everyone saw the strong performance of those two stocks, and it became very, very crowded space very quickly. So now there are over 80 DATs that are live. There's been over $20 billion of capital raised in aggregate, excluding MicroStrategy. There are over $30 billion of market cap, and so it's become a really big space. At Pantera, we were fortunate, humbled to be the team that really helped jumpstart this whole trend. Sometimes I feel that with some bated breath because obviously it's caused some losses for some people as well. But we feel pretty excited about some of these becoming really big outcomes for some people.
Great. Yeah, I saw an amazing tweet by your CEO and founder, Dan Moorhead, supporting the Solana ecosystem and saying we're skating where the puck's going. So it was great to see the buy-in from your whole firm. In terms of the best capital market mechanisms or investment strategies that a DAT can use to generate accretive yield, how do you guys think about that? How do you advise the DATs that you work with?
Yeah, if we go back to what a DAT actually is, the whole goal of a public company is to maximize shareholder value. A DAT chooses to maximize shareholder value by maximizing accumulation of tokens per share. So in the case of a Solana DAT, such as our Solana DAT, a Solana company, HSDT, we're very focused on how do we maximize the number of tokens per share, and in that case, Solana per share. There are a few ways to do that. In a lot of ways, these businesses are actually, and now these business models have always existed. They just used to be called financial services companies. Banks, insurance companies, they are also balance sheet-based businesses whose goal is to maximize book value per share. They happen to denominate in dollars, and we happen to denominate in SOL. So we're like a Solana-based financial services company that's trying to maximize book value per share. How you do that? It's sort of the tried and true methods that have been true since the dawn of capitalism, which is there's a combination of financial engineering they can do on the liability side of the balance sheet, and then there's a combination of yield generation that you can do on the asset side of the balance sheet. And so we're on the liability side or on the financial engineering side, you can go raise equity in an accretive way. If you trade above book value, you can go raise debt. You can go sell warrants in order to monetize your volatility, or sell preferreds to monetize your future value creation. And so there are all these ways that you can generate yield as defined as increasing accretive to book value per share or Solana per share. On the asset side of the balance sheet, on the organic side, you can look at, especially with something like Solana, the simplest thing is to just go stake your Solana. So we are one of the largest stakers of Solana companies, one of the largest stakers of Solana. And we try to support the validator ecosystem by diversifying across a set of validators and really in search of a balance of maximizing yield while also keeping in mind what the best outcomes are for Solana as an ecosystem. Other ways are deploying into DeFi. There's going to be some exciting announcements about that over this course of this conference that we have, as well as potentially interacting with CeFi and doing lending of Solana. So all those are really interesting things. I'd say the most important thing beyond the balance sheet is probably the number one job of a DAT, if our goal is maximizing shareholder value by maximizing tokens per share, is also maximizing the value of the token. Right? If Solana doesn't have value, or if we don't believe Solana has value, then this whole thing doesn't make sense. And so we strongly believe that Solana is the most exciting L1 with the highest upside, highest risk-adjusted upside. And so we feel like Solana company's job is to be the IR function effectively for Solana, to tell mainstream investors, to deliver that message to a whole new broad set of people, which is what we're out here doing.
You guys have been an amazing partner to the Solana ecosystem. You touched on the DATs using staking as a mechanism to generate yield. How do you see the competitive landscape between ETPs now available in the US versus a DAT that incorporates staking?
Definitely. I'm often asked by allocators in my discussion with the allocators, like, why do I buy a DAT when I can go buy a passive ETF such as the Bitwise Sol ETF, which is Plug, one of the highest performing Solana ETF by volume. It's pretty clear to me that ETFs are passive and DATs are active. Many people can choose active management to get a different type of exposure to the underlying. It's not going to be one-to-one correlated to the underlying like a passive ETF is. So if you buy a passive ETF, you know what you're going to get. You get 1 Solana per share, or the equivalent of 1 Solana per dollar you put in, and that doesn't change over time, excluding some minor fees that you pay every year. With an active manager, such as a DAT, what you get is a management team that's really focused on all the different ways, all the levers you can pull, both on the capital market side and on the asset yield generation side, in order to maximize Solana per share. And so you can do more than just staking. And that's not to say though that just like not every active manager beats the passive ETF, not every DAT is going to beat the ETF, and that would be par for the course for capitalism. And what I would fully expect is most DATs do not outperform ETFs, just like many active managers do not outperform the index. But high-performing DATs, high-performing active managers absolutely have a right to win and can win.
Great. You touched on maybe not every DAT making it to the finish line outside maybe the core Solana DATs. So when you think about the top operational or financial red flags, what should an institution or an investor look out for?
There are a few things that I'd lay out. First is certainly are management incentives in the right place, and so understanding what the management team is really focused on. What are their incentives? What are their KPIs? As Pantera, as the asset manager for Solana company, we're very focused on maximizing the amount of Solana that the company owns. But we're also the largest shareholder in Solana company, so we're also very focused on maximizing value per share as a shareholder. And so that incentive alignment we think is really important. Second thing that you really should look for is the management team and their service providers' experience. A DAT is, in many ways, I come from the traditional finance world. I operated in private equity and long-short equity for most of my career. And so many of these capital markets, financial engineering tools are very simple or nature to me. And I'd say that's candidly not true for many crypto natives. These tools have been tried and proven in the traditional finance world, and so knowing how to approach bankers, how to approach the sell side, how to approach potential investors, delivering them the message and the product they need is very important, and not everyone really knows that message. So looking at their experience. On the asset management side, it's really important to find a management team that's really focused on risk-adjusted return. There are many ways to maximize your return. So these DATs, many of them will stretch along the risk curve and become effectively actively managed hedge funds. Not to say that's necessarily a right or wrong thing, but you as an investor have to choose whether or not that's actually what you want. Whether you want to underwrite that this management team, by doing very, very black box or sophisticated strategies, whether that's something that you approve of and you're willing to trust them with. And so there's varying things. I'd say the last thing is just and maybe the most important thing is their ability to get in front of mainstream audiences. The whole point of a DAT is, and as much as I love everyone that I work with and I love everyone in this crowd, the whole point of a DAT is not to market to crypto natives, right? The whole point of a DAT is to deliver the story to a new set of investors, in particular the large pool of capital that exists in the equity markets from traditional retail investors. And so and traditional retail investors and traditional long-only institutions. And so seeing that there's a strong marketing game marketing and distribution game trying to tackle those new investors and not necessarily focused on crypto natives is pretty important.
So what are you seeing from institutions when you have conversations? Who's coming into this space? Who's investing?
So I think it starts with, if you look at MicroStrategy's top 10 holders, it includes some of the largest funds in the world. Right? Capital Group is the largest mutual fund in the US. If anyone has a 401k, you probably don't know, but you're actually invested in a capital fund, most likely. And they're a top 10 holder of MicroStrategy. If you look at, Norges, the Norwegian Sovereign Wealth Fund is a top 10 holder of MicroStrategy. And so those are the types of investors that are circling these opportunities. These DATs do need to get to a scale where it becomes relevant for large long-onlys and for large institutions. And so, that's a few billion market cap range. But if you can generate the momentum to get there and start building, seeding the ground and having the conversations with them, which we're having with many long-onlys and other institutions to start educating them, eventually when you get to that scale, they'll be there. And then when they allocate, they actually do allocate in size.
Makes sense. Okay, so on a look-forward basis, how are you thinking about DATs in the broader capital markets in 5 years, 10 years?
Yeah. I love that question because almost always my conversations with people are like, what's happening to DATs this week? But I'd say, look, we just went through a phase of what I would call the genesis phase of DATs. We just saw the creation of a whole new industry. You have to realize the creation of something only happens once. And so, back in April, there was all this white space. I had a whiteboard that wrote down all the DATs that I thought made sense, like 1 to 2 scaled ones for each of the large cap assets, a few other assets that I thought were interesting. Clearly, a lot of entrepreneurs saw that same opportunity and more than one or two tackled all those opportunities, as you would expect with any set of startups. Now we're at a phase where, well, all that white space, if I go back to that whiteboard, I've checked off everything. They all exist. Not to say that there won't be more, but the obvious white space is gone. And now the moats, the barriers to entry are much higher. It's going to be much harder to have a real reason to launch a de novo DAT. And so now that we're past this genesis phase, we're in the what I would call the consolidation execution phase, which is pretty much most of history. And the public markets are really amazing. That's where most value creation happens, is in the public equity markets. And so we're in the part where these DATs will now need to figure out whether they are going to compete and become one of the leaders. If they are the leaders, they'll be in a position to potentially consolidate the space, and either through acquisitions or other partnerships. So I think we're going to see a lot of consolidation. I think we're going to see the separation of winners and losers. All that is healthy because eventually the capital will consolidate into one or two leaders that can really drive the importantly Solana forward.
Great. Thank you, Cosmo. Absolute masterclass on the DAT space. I just want to quickly plug a blockchain letter that Cosmo had written. It's on the Pantera website. So informative. I learned a lot. I think you all will enjoy it. And to just quickly end on a personal note, what is a quote that you live by?
I always think back, is because I keep a daily trade journal of my thoughts, my mood, just like how I'm thinking about the day and the things we're doing. And at the top of my trade journal, I have a few things that I reread every day, like my mantras. One of the things is always be long-term greedy. It was something that my PM at Hitchwood Capital taught me when I was a really young investor. And the idea being, you shouldn't be optimizing for short-term gains, shouldn't be optimizing for short-term wins. Really always try to be long-term greedy.
Excellent. Thank you, Cosmo. Appreciate it.
What a line. Be long-term greedy. And you know what? One part of being long-term greedy is understanding what you're investing in. Now, at Bitwise, one of the big questions we get is, how do I think about these assets? They're not like stocks. I can't model them. I can't evaluate them as I would equities. How do we do it? And so our next speaker, John Ma from Artemis, he's going to give us a little bit closer to understanding that. So give it up for John. He'll be bringing us up to speed.
Hey everyone, we're going to talk about how do we model Solana, how should we value Solana. The talk is what Wall Street wants. What are the metrics that actually matter for Solana, for valuing Solana? So a quick background on us. So Artemis, we are building Bloomberg CapIQ for those from TradFi, CapIQ for digital finance. I sold my soul and worked in TradFi. I was a venture capitalist back in 2014, investing in software companies. And then most recently, I was at a hedge fund investing in fintech, crypto, and software. And today, I'm really proud to say, Artemis, we back the largest asset managers in the world. Our customers are like Fidelity, T. Rowe, Van Eck, Franklin Templeton. And I'm about to share with you a really big problem, which is Solana trades like oil and gas. It trades like a commodity. Solana trades like based off of supply and demand, based off of flows, unlike a high-growth technology asset, which is why I got into crypto. I wanted to invest in the next big high-growth technology business. Solana doesn't trade like NVIDIA, where when data center revenue goes up, NVIDIA stock price goes up. And I literally did this at my last company. I worked in venture. I was like, OK, what are the key metrics that matter for software and technology businesses? Let's commoditize it. Let's turn it into a product. And our customers were Sequoia, Benchmark, Tiger Global, Altimeter, et cetera. And that's the mission behind Artemis. What's the rule of 40? What's the ARR equivalent for blockchains? Like, how the heck do we value these layer 1s, these L2s, and these protocols? And our team comes from BlackRock, Citadel, Ribbit, et cetera. So here's the key learning that we realized over the last 4 years. TVL, developer activity, daily active addresses, transactions, do not matter to Wall Street. It does not matter for evaluation. We tried that. We had market cap to TVL. We had market cap to daily active addresses. That was one of the core metrics that we made comparable. They don't move markets. It just doesn't matter. So today I'm going to propose what we can do to solve that problem. So Solana doesn't trade like oil and gas and trades like a high-growth technology asset. So taking a step back, like what actually works in crypto today? BNB is one of the top performing tokens this year. Revenue was up 3x, price market cap was up roughly 3x. Hyperliquid. Everyone loves Hyperliquid. Hyperliquid revenue was up roughly 2.5x, and price was up 2x earlier this fall. And in the equities market, everyone loves Robinhood. Robinhood revenue's up like 50% year on year, and stock price is ripping. And in 2025, like the 3 tokens that are positive that actually had a positive return, they're Hyperliquid, Tron, and BNB, and they're all doing 100+ million of revenue, buybacks, value accrual to token holders. So yes, while Solana is #1 in users, #1 in transactions, #1 in developer growth, #1 in application revenue, so the revenue that applications built on top of Solana get, #1 in trading volume across all the different chains, #1 in new tokens that are being launched. And yes, Solana is super resilient. There's been no downtime in the last over 22 months. Solana has the highest actual transaction per second. These developer user metrics don't matter. Like Wall Street, buy side, sell side analysts, they don't care. Like it doesn't actually affect Solana's valuation. So here's a proposal of what we think solves this problem. We should position Solana as a marketplace between users that bring capital and financial applications. A marketplace just like Uber's a marketplace for riders and drivers. Riders measured as monthly consumers. The GMV equivalent for drivers is gross bookings for Uber. Just like Airbnb is a marketplace for hosts and guests, we measure GMV as gross bookings and guests as nights booked. Solana is a marketplace for financial applications that developers build and users that bring capital, institutions like BlackRock or a Phantom wallet user. And the core metric that matters is global transfer volume, the GMV equivalent for Solana. That's why we call Solana Internet Capital Markets. Solana is a marketplace for capital, and these metrics look pretty good. If you compare them to like an Uber and Airbnb, these public companies, like these are all pretty solid metrics. And the best part of having this like trading volume, transfer volume as the core GMV metric that matters for Solana as an ecosystem is you could break it down into trading volume, so like perp dex, spot dex volume. You could have it broken down by payment volume with the Cash App, with the Western Union deal. You can actually model these things out over time based off of, hey, like Solana signed Western Union, signed Cash App, it's going to bring this amount of TPV. Or you can break it out into like other volume, RWA volume, DPIN volume, et cetera. And one of the challenges I got on Twitter from Mert, actually, was how do we model Solana to $1,000 per token? So with this marketplace framework, it's actually not crazy. If we assume Solana gets 5% of the entire tokenization market in 2030, which is BCG forecasts basically 9 trillion of assets, we'll move on chain in 2030. If Solana captures 5% of that, that's 450 billion of AUM that moves on chain. And if we assume a single dollar that is on Solana moves roughly 60 times, we call it the velocity multiple. For reference today, Tron does about 90 times. So a given dollar of stablecoin on Tron, it moves around 90 times in a given year. You get 27 trillion of this GMV metric of transfer volume. And roughly, if you take the 2024 take rate for Solana, so that's like fees spent, Jito tips, et cetera, that's 27 billion of revenue, and you can model out incentives, OpEx, other pieces, and you can get to 20 billion of net income with a 50 times price to earnings multiple. You can get to $1 trillion market cap and a $1,000 token. This is what Wall Street wants. This is what all the investment banks we work with, all the buy-side funds, all the asset managers that talk to us want. They want a simple model, a simple framework of, hey, AUM, let's track the amount of capital that's on the chain. Transfer volume, where is it coming from? Is it payments? Is it trading? Is it from RWAs? And what is the take rate? What is the ultimate revenue? This is what Wall Street wants. And a lot of the asset managers, a lot of our customers, we share this model, and it's highly resonant. A lot of them come to us and they're like, we just want like a free cash flow, like an earnings, a revenue number that we can write a report on and convince additional hedge funds and asset managers to buy Sol. And so this model is highly resonant with Wall Street. I think there's basically 2 paths forward for Solana. Solana can continue to trade based off flows, like oil and gas as a commodity, or Solana can trade like a high-growth technology business like Robinhood, which trades on earnings, trades on 74 times earnings. At Artemis, we strongly believe the world is shifting towards fundamentals. We stand for fundamentals, and we work with some of the most prominent chains and protocols to help describe what are the metrics that matter to Wall Street, to the biggest asset managers, to the biggest liquid token funds. If this model resonated with you, that's the QR code. Feel free to rip it apart, flame me on Twitter. And if this general methodology of like fundamentals matter, here's how you should value blockchains resonates, we'd love to chat. Thanks so much.
Great session on metrics. I think this whole room can get a lot of value out of that. Our next session is a little bit about staking. It's a really important key feature it's included in a few Solana ETFs that launched in the US this year. We've got Mert Mumtaz, CEO of Helios, Hong Kim, CTO and co-founder of Bitwise Asset Management, and Ali Nadel from Bitwise as well. We're really excited to have a little bit of a conversation on what institutional staking looks like and how it's actually being applied for BSOL, which is Bitwise's Solana ETF. Thank you so much. Ali, Mert, Hong, welcome.
How does this work? Okay.
Hi, everyone. Thank you for joining us today. My name is Ali Nadel, and I'm an Associate Director of Business Development on the on-chain solutions team at Bitwise Asset Management. And with me today, we have Hong Kim, CTO and co-founder of Bitwise Asset Management, along with Mert Mumtaz, who is the CEO and co-founder of Helios. Thanks for joining us, Hong and Mert. So this audience is likely quite interested in learning about how staking has entered into ETFs. So let's start by diving right in and learning about the partnership between Bitwise and Helios on staking for the product that we launched back in October called BSOL, which is the Bitwise Solana staking ETF, trading and listed on the New York Stock Exchange, trading under the ticker BSOL. So Hong, if we could start with you and learn a little bit about how you and Mert put your heads together to form the staking partnership, that would be wonderful.
Amazing, yeah. Great to be here. And yeah, when the US ETF launch moment is a pretty important moment because US is ultimately the largest capital market in the traditional financial world, and also the spot ETF ends up becoming the most liquid product, as we've seen from IBIT and Ethe, et cetera, where so it has a pretty important role that it plays, and once it grows and gains liquidity, then it becomes this huge thing. And so we wanted to be thoughtful about how we engage with staking. And staking isn't just a little bit different from custody. It isn't just something that sits statically. It engages with the network in a meaningful way. So how a large amount of stake that is tied to a product engages with the network can have a lot of influence and distortions at times. So we were looking for a partner that can help us navigate that. And there are a lot of staking providers that can say that they have good performance and uptime and all these things. But staking in a proof-of-stake network is not just about that. It's about the small decisions that think about whether the network becomes more useful and easier for app developers. It is about decentralization as well. And so no better partner than Helios and Mert here to help us really understand and navigate all of those decisions. And so that was maybe that kind of, there's the obvious things, like Helios is the largest validator and been doing it and great performance and all these things. But maybe the kind of less obvious thing is that it was important to us to have a partner that we can feel can guide us there. Yeah.
Yeah, and Mert, would love to hear from you on what's unique about Helios' staking, and what does the setup look like for BSOL specifically?
Sure. In terms of what's unique, well, we are one of the only teams. I mean, there's quite a few. I don't want to gas too much, but I would say, first of all, we're extremely network aligned. And what I mean by that is it's very easy to make certain short-term decisions to, let's say, boost yield by like, let's say 0.5%, but increasing the risk of, let's say, being front run or the network going down by like 20% or something. But since we actually have another business, and our core business is not Validator, it's actually running infrastructure, of which validators are a single part of, we also run by far the most number of nodes on the network, right? We also run RPC nodes, thousands of RPC nodes, which are actually just validator staking nodes, except without voting, which means we've seen basically every possible variation of anything that can go wrong on all different regions in the world. And so when you have institutional money and all eyes are on you, you can actually feel safe that, okay, these guys have done this before, they have done it for 3 years, and they've been battle tested, right? Like we've been, not us, but like Solana itself has been attacked. Blockchains are relatively adversarial networks, and we've been kind of there on the front lines, navigating, okay, how do we get around this, et cetera. And also like the other thing is the stakers themselves, the holders of BSOL, get really the best possible economics because we don't need to make money ourselves on the stake from Bitwise's validator, right? Our business is helping developers, right? It's making the network faster so that people can actually build the future of internet capital markets, right? Perps, DEXs, spot trading, borrow, lend, in the fastest possible way on decentralized rails. And then every decision that we make is tailored to help towards that, because our goal is to just get people to build on Solana. And so this is like a really interesting partnership where like you can literally buy a stock that stakes with Bitwise's validator run by us, but then since we use that to make the network faster, buying the thing can literally help developers build faster applications.
I think that's a really important point from my perspective. Like compared to, let's say, like a network on Ethereum, Solana, the applications really take advantage of the extra, like last 1% of performance to compete and deliver the next kind of marginal amount of more liquidity or marginal amount of scale to their users. So whether the nodes are actually supporting that to the maximum extent does matter. And so the running of the node is not as kind of like you just download the thing, you run it, and there's really not much difference between whether this validator has more stake or that validator has more stake. The impact on the network, the users, the application that can be built, there's a lot of networks where that really, the relationship doesn't matter as much. But on Solana, the application landscape is changing all the time. The protocol spec is improving. The scale is so it really does have a big impact, and that is a big part of it for us because ultimately we want the ecosystem, the developers, the users of Solana, the whole community to feel that the increasing stake weight that comes from this product, this regulated product existing, isn't something that deteriorates the market structure or the ecosystem, but rather plays a role in making it more stable and making it more supportive. And yeah, so that's the thing that's really important for us.
Mm-hmm.
Great. So before BSOL launched in the US, we had staking and then we had ETFs. But since the launch of BSOL, we now have staking included in ETFs. So curious if you guys can share a little bit about the challenges you faced in getting staking approved and working properly in a regulated ETF product.
What do you think? What did your team complain the most about?
Well, we did all the hard work of waiting for the Bitwise team to figure it out. We just our job is really the technical side of things, right? So ETFs will have specific reporting requirements, so we need to get quite high quality data, check the accuracy, make sure that the granularity of the data, but also Solana is kind of hard to read and make sense of, right? And for an institutional product like this, if the data is, if there's even the slightest kind of error in the little detail, that ends up kind of maybe misleading investors. But since we're a data infrastructure company, we really take that seriously. So, but I would say that was that's something we take super seriously, and so that was a unique challenge for us because most of our customers aren't, the first staking ETF for Solana. But I'm sure you guys had a much different story there.
No, I think reporting is definitely one of the ones, because if you think about an ETF, it has a daily reconciliation and striking of NAV and such. So the 4 p.m. Eastern to the 4 p.m. Eastern has to be exact. And what was exactly the staking rewards that were accumulated in that time? And then it's not just we have a view, we need to send that to our fund administrators, the custodian, and our auditors all have to reconcile and audit that on a daily schedule. And so those are the kind of additional requirements of a regulated product that in some ways is that amount of oversight and like multi-party reconciliation on a daily basis is a time onerous and onerous about making a product like this work. But at the same time, it's really also a thing that drives a lot of confidence in these products as well. Like you can know when the NAV moves up this much on a daily basis, like that is actually what happened. And so yeah, that's definitely one of the elements. And then after that, it was really like working with the SEC on getting them comfortable with how Solana staking works and stuff like that. Yeah.
Great. So Hong, as the audience likely has institutional investors, how does Bitwise go about explaining how Solana staking works to institutions?
Yeah, that's a good question. I think enough people have heard about proof of stake that they understand what roughly it is or the kind of the role that it plays. I think actually explaining the product to like large banks and platforms, the main thing that we had to deal with is how Solana staking is different from, for example, like Ethereum or so, where a lot of the questions are around like illiquidity and whether the exit queue is going to be a month, and does this mean that the product is going to have a lot of gotchas for investors because once you stake, the assets are tied there, and we tell them each epoch is 2 days, and it doesn't really work like that. And then also there's a lot of concern around slashing and then like loss of investor funds as a result of that, and then we walk them through how that's not the case in Solana. So there's more of those types of conversations that I think we're having. I've been having those conversations maybe like twice a week since we launched the product with various institutions to just help them understand. So, but that's the role that Bitwise plays, is that like it might be obvious to the people that are in this room and living it and breathing it on a daily basis, but for the people that are just hearing it for the first time, they have no idea. So working with their priors, wherever they are, trying to get them closer to what the actual reality is a big part of what we do.
Great. Well, we're getting close on time here, so one final question for you both. Now that we have Solana staking ETFs, what is the next milestone for Solana?
In the kind of like capital markets,
or so you mean for Solana as an ecosystem in general?
Yeah.
Yeah. Well, I would say really the job's not going to be finished until you can trade any market at any time from your pocket on the internet with nothing but the internet connection. Right. We just for folks who went to the other stage, Ellipsis just announced a perp stacks. Right. This is like one of the areas where Solana was kind of behind in. Kalshi announced that they're tokenizing prediction markets on Solana, and we also already have this new initiative of listing new assets on Solana super fast. So for example, Monad was a day one listing on Solana. So you take, spot listings, perps, prediction markets, the long tail of assets, but then also institutional things, right? So like tokenized stocks with super state or X stocks, which, they're kind of different products, but the idea is that they're stocks. You add things like, you can redeem natural gold on Solana and even uranium soon, right? So you take all these different things, and basically what you have is like the internet's market. You have the Amazon of markets, and you can trade anything you want with just opening up your phone and having an internet connection, not financial advice, and 24/7 around the world. And that's really the end game, right? And then the devil is just in the details of, okay, what are the changes that you need to make to enable this, right? Like how do you actually remove friction for new folks? How do you make sure that the market structure is such that it's not extracted to retail, right? Like how do you make sure they don't get front run? And we have all these different boring, nerdy things like multiple concurrent proposers, but fundamentally it comes down to the 4 letters that we always say, which is IBRL: increase bandwidth, reduce latency, right? Once you make the network as fast as possible, like a giant, basically science fiction finance computer, and you have all of the market's liquidity concentrated in one place on the internet, I think that really allows for basically the evolution of capitalism in a sense.
Great. Anything to quickly add there, Hong?
Yeah, I'd reinforce that maybe the perspective that I have is a little bit more of like TradFi and BSO being now like fully, basically Solana is that's kind of Solana's IPO moment. Like you can trade Solana on the New York Stock Exchange now and also in a staked wrapper. Excited about the tokenization part that Mert talked about because that enables then it to travel the other direction. And then now you can have lending markets on literally the same ticker, same asset, where you can maybe get a loan on your staked Solana position at Goldman Sachs at your prime, or on a lending protocol on Solana and in DeFi. So those two worlds merging on literally the same type of instrument is I think, the liquidity is coming together, and really the next stage of Solana, where it's not an isolated market, but it is actually just integrated into the whole.
Excellent. Well, this has been such a great talk. Thank you all for joining us. If anyone has any questions, everyone should have a card on their seats with my Telegram information. So feel free to reach out, ask any questions, and let's give it up for both Hong and Mert. Thank you.
Thank you.
All right.
Thank you so much for such a great part one. We're going to take a 15-minute break. We'll be back here at 3:55 for a little bit more. It sounds like everyone's excited for either the break or to come back. So we'll see you guys soon.
Please welcome your MC.
Hello. Welcome back from the break. Once again, I am Danny Nelson on the Bitwise research team. We have a jam-packed afternoon talking through Solana's institutional story. Lots of guests, lots of speakers walking us from everything through DATs, modeling Solana. Now we're going to have Cash Danda from, he is the cat herder of Jupiter, and he's going to be joining me on stage to talk about Solana's super app moment. So Cash, welcome to the stage. All right, so Cash, welcome up, and we're going to get things started today. I want to talk about where Jupiter is in its story and like how this is appealing to the institutional investor. Take that word however you will, but tell me about it.
Yeah, I think we're working with institutions in a few different factors, right? So we think about those who are first capital allocators and looking to deploy on-chain in a various number of kind of products. A lot of them are looking at the tokenized money market funds or how they can use stablecoins and so forth. The second way is those who are looking for yield, and so Jupiter Lend, our borrow lend protocol, has been popular in that regard, along with JupSol, which is our industry-leading LST. But the one that's, I think, the most exciting is actually those who are doing product integrations, right? So not just the capital, but those who have their own clientele, their own audience that they want to start to offer trading and other opportunities to. And there we're seeing the Jupiter APIs just get adopted left, right, and center.
Now, you say that it's a super app, but don't you have a risk of spreading yourself out too thin? Like, how can you make sure that you're not just doing a lot of things, but maybe not any one of them too well?
Yeah, it is indeed a risk. I think the way that we solve for it is in organizational design. So at Jupiter, we really try to embrace this idea of an ecosystem of founders, right? Where we have, we've grown largely by M&A so far rather than natural hiring. I think we've acquired about 8 companies, just announced that we acquired RainFi earlier today. And we take these companies, they've been working together for years, very tight-knit, very strong CEOs, and then make them the product lead for whatever they're working on. So, Guam from Sonar Watch is crushing it on portfolio, right? 3 million users per quarter and so forth. Quinton and the team from RainFi are going to be working on OfferBook, our new peer-to-peer lending software, and so on. So really, it's about ensuring that the right people are there who are used to working autonomously. I sometimes compare this to like early America, where we have very strong states' rights at Jupiter, when the states are the products, and there's a thin federal layer at the top that helps ensure that things kind of are communicated effectively and coordinated and so on. It's not easy. There's definitely difficulties, as we know, but it is the best way we know to ship product faster than anyone else can.
So today we had a big piece of news coming out of Jupiter with the hiring of a new president from KKR. Tell us a little bit about that.
Yeah, so his name is Zhao Zhao. I hope I pronounced that correctly, Zhao Zhao. I apologize if I didn't. Yeah, I was hoping you would say it instead of me, but we call him XX internally. And indeed, he was leading digital asset strategy at KKR, which is a $700 billion private equity fund for something like the last 5 years. Before that, Boston Consulting Group. And he is, I think, really emblematic of what we're starting to see in crypto, where 2 or 3 years ago, the real goal was how do we get the best devs from Web2, fintech startups, SF area, et cetera, to come on chain and start to build applications. That has been largely successful, as we've seen from a number of the great companies on Solana now. The next step is how do we get people that can speak multiple languages and bring that depth of expertise in terms of what the problems that need to be solved are by a new set of users. I would say Jupiter, I hope this is not contentious to say, we've done very well with retail audiences, right? We're among the most used protocols in all of crypto. And now we're starting to kind of transition and start to grow into this new audience. And so he will be essential for that. And I think that he will not be the last kind of major hire that's making the jump. It seems that a lot of people at these kind of like larger TradFi institutions, they can see the writing on the wall. Right? They know that the future of finance is going to be built with on-chain rails, and they want to be deep in the action rather than kind of further aside on the periphery.
Now, when you're scaling up and moving from that simply retail audience to the big money, the big traders, the things that you need to pay attention to change, and I think the lessons that we take from TradFi change too. Like, we're rebuilding financial systems here. That doesn't mean that everything that exists in the TradFi world is bad or is good. It means there's probably opportunities to learn from that. So I'd love to hear your thoughts on on what we can take away from the TradFi world, what Jupiter needs to do as well.
Yeah, I've been fairly consistent in this idea that on crypto Twitter, there's a lot of talk of like DeFi will replace TradFi entirely, or some antagonistic kind of relationship. And I think that is good for getting engagement on Twitter, and probably not descriptive of what the future is going to be. It's not DeFi versus TradFi. It's going to be DeFi plus TradFi in this kind of unified finance approach. And so at Jupiter, we have a lot to learn in terms of we're very good at this kind of B2C model of finding people, getting them to stay really sticky because the product suite is so great, like Jupiter Mobile and many of these others. And now we need to kind of focus more on the hand-to-hand combat with some of the bigger guys, right? The advantage of trying to move into this new audience, let's say large-scale credit funds for Jupiter Lend, is that there's a short list of, call it 50 funds around the world that really matter there. And you can just make the list and start to go after it, but you need to build this kind of, business development muscle, the storytelling muscle that's a little bit different than the broad go-to-market strokes that are required for Jupiter's success so far. And again, that's where Xiao in particular comes in, but the rest of the team is also kind of upskilling and learning here. I think the other thing that we can learn from TradFi, so to speak, is how to tell the story really concisely. I mean, this is another kind of difficulty with Jupiter, if I'm being very honest. We have 12 revenue-generating products across web, mobile, APIs, all these different things, and it's hard to get like a summary 3 or 4 line statement. I was listening to, I think it was Matt Hogan on a podcast, and he's like, the average. Yeah, he's great. He made a great point that like, hey, a lot of these financial advisors, they're spending 300 minutes a week on portfolio construction, and crypto is something like 1% of their portfolio. So you're getting 3 minutes a week that they're thinking about crypto, which means you cannot have a 10-page long kind of thesis on the inner workings of RFQ systems and so forth. And instead, you have to get really refined in how you tell that story in a way that's intelligible to this kind of new audience.
At Bitwise, when we're dealing with how to talk about these things, you only have a certain amount of time to really get big ideas across, and the challenge is making things legible, making things understandable to the broadest audience without losing the meaning inside of it. One place that I'm really looking toward is what's happening in the U.S. around DeFi technology, like smart contracts and automated market makers. We see the SEC now basically encouraging builders not only to not have to worry about getting sued, but scale up what they're doing and try to integrate these into traditional financial ecosystems. I'm wondering, is Jupiter looking toward that world, and how?
Yes, absolutely. So we have the benefit of owning most of the kind of organic trading flows on Solana and having just the widest distribution. And in particular, we have something called Jupiter Verified, which we actually just launched earlier today, but it's based on the strict list that we've maintained for a long time. Anyone who is issuing an asset on chain or coming on chain for the first time, understandably is concerned about the possibility of scams and imposter tokens and so forth. So we end up being a first stop just to ensure that the asset is verified correctly, the data is correct, and so on and so forth. And then that allows us to kind of open up the conversation for how do we get them integrated into our RFQ solution, for example, which is a way of ensuring that market makers can sell directly with no slippage and no gas costs to retail users. That's what's being used by a lot of the tokenized equities folks because they need to either have KYC or something else. So on the trading side, I think we end up being great partners there, and certainly on the yield side, again, that becomes really useful. I think our new peer-to-peer lending protocol, which we're calling Offerbook and which will go live in Q1, will be really popular here because it allows any asset that comes on from any asset issuer or any institution to instantly find yield-bearing opportunities.
Who's Jupiter's biggest challenger right now? Like, what is the biggest challenge that Jupiter faces in scaling and making its mission succeed?
Oh, I mean, there's no shortage of challenges, actually. So can I have like 3 challenges instead of 1?
2.
Yeah, deal. So I think the first one is cross-product synergy, right? Again, the benefit of this kind of ecosystem of founders approach is we have really fast shipping teams at each product. There's more that we can do to kind of bring these together. Mobile is like a good example recently where the mobile wallet has added in a bunch of great trading features from the terminal experience online. But there's a lot more that we can do there to make sure the products reinforce each other. And then the second one is around storytelling. As I said, I think it is hard to tell a concise story when you are this kind of sprawling conglomerate of different companies. I think we're getting better at it, but there's still some ways to go.
Yeah. With storytelling, like the language that you use, how do you make sure that all that is synced across the organization when you have that really thin, like federal layer at the top?
It's something that we're getting better at now, and a big shout out to the product comms team who's kind of been put in place and is helping to kind of review things across the entire board. But honestly, the main thing we need is like a choir book that we can all sing from, right? So we're singing the same hymn, not just about what the products are and what they do, but really what the end vision of Jupyter is, what the value we're trying to create for users are, and how that value might be slightly different for the institutional audience.
Because really, this isn't just a story about Jupyter. This is like how all of DeFi comports itself.
Correct. Yeah.
Cool. Great. Well, thank you, Cash. We'll wrap it up there. I appreciate your time today, and everyone check out Jupyter.
Yeah, appreciate it. Thanks, everybody.
Thank you, Danny and Kosh. A recent Charles Schwab study came out this year, said that there's growing significant interest in crypto ETFs. The study said that 45% of ETF investors are considering buying a crypto ETF. So we're really excited to have Matt Hogan, our CIO, to join us on stage because we have lots of data to show us that a lot of retail investors, institutional investors prefer to buy Solana and crypto assets in an ETF wrapper. So let's have Matt take it away.
How's everyone going? Yeah, Matt Hogan, Chief Investment Officer at Bitwise. For those of you who don't know me, I've been at Bitwise for 8 years, since almost the very beginning. But before that, I spent 15 years in the ETF industry. I was the CEO of ETF.com. So I want to give you a little talk, not about BSOL, not about our ETF, although I'd love to do that, but just about why ETFs matter. Y'all know about Bitwise, so I'll skip that over. This is what I'm going to talk about, why ETFs matter, how they work, what to expect, and how we talk to institutions about Solana in 8 minutes and 52 seconds. I wanted to start here. Everyone in crypto feels really good about the size of this industry. We're a $3.1 trillion industry from a market cap perspective. The first reason ETFs matter is that actually we're like a tiny planet in a broader solar system. That's the size of the equity and fixed income markets, massively larger. That's why this question of when the institutions are coming matters so much, because even a little bit of capital from this $260 trillion investment market going into our little $3.1 trillion market would have a big effect. And of course, Solana is like a moon on the planet crypto, right, amidst this broader solar system. So it is a really big deal. The second reason ETFs matter is this is a chart of ETF assets. I know this looks like a crypto chart. It's up only, but this is a chart of ETF assets in 2003. They're the fastest growing financial product in the world. ETFs added more AUM last year than the entire size of the crypto market. So ETFs really do matter. This is how the largest institutions work. The reason they do it is because they're easy. I know a lot of people wonder, why do institutions use ETFs when they could just own the asset natively? This is a study we do. We ask thousands of investors every year, how do they want to invest in crypto? These are the largest institutions, family offices, financial advisors in the world. We've done it for 8 years. Every single year, it's ETFs at about a 70% rate. This is just what they want. It's what they know. And so it's how they want to invest. Again, you may wonder why. Financial institutions and financial professionals don't spend all of their time studying the markets. This is from a study that looked at how financial advisors spend their day. They work about 55 hours a week. They spend 5 hours of that on investment management. A lot of people think of institutions, particularly financial advisors, spending all day studying the markets. They spend 10% of their time studying the markets. Their average allocation to crypto might be 1% of their portfolio. That means each week they spend 3 minutes studying and thinking about the crypto market. That is actually how the numbers knit out. So why do they like ETFs? Because they know them, they trust them, they make it easy, and in 3 minutes they can buy it. The last one is that ETFs are just a great tool. This is a fun fact about ETFs, which is not true in any other area of the market, which is that you or my father can literally buy the same ETF as the Harvard Management Company or leading sovereign wealth funds around the world. That's pretty cool. That's true in crypto. We can buy the same Bitcoin, we can buy the same Solana as the largest institutions in the world, but it's not true in most of the investing world where we don't get access to it. So it's easy, it's a high quality product, it solves all of the use cases, etc. All right, how do ETFs work? Someone asked me to do this because not everyone understands how ETFs work. I'll give you the 1-minute version of a talk I gave 1,000 times, which is about 45 minutes long. ETFs are relatively simple. So an ETF like BSOL will trade on the NASDAQ or the New York Stock Exchange at a value. Let's say it holds $25 of Solana for every share. And it should trade at $25. And usually it does. But if a bunch of people want to buy BSOL, it will trade up to $25.01. And there'll be this slight arbitrage. When that happens, institutional market makers create more shares of Solana by sending us cash. What do we do with that cash? We take it and we buy Solana, usually from institutional market makers. We put it in cold storage and we stake it. We sell shares of that ETF to these institutions at $25, and they sell them in the market at $25 and a penny. That brings the price back down to $25 so that the price always equals the amount of Solana that we have in the fund. That's been working in ETF land for 30 years, and it works more or less perfectly. All right, what to expect from ETFs going forward? Why will they shape the returns of Solana? In part, why would they contribute to those returns? I thought I would start with this. These are the cumulative inflows into Bitcoin ETFs. Bitcoin's launched in January of 2024. Most people know this story by now, but there have been 9,000 ETF launches in US history, and the number one ETF launch of all time, out of all 9,000, was the Bitcoin ETF. And not by a small factor. It pulled in $36 billion in assets in its first year. Number 2 on the list, which is the NASDAQ 100, many people know the ticker QQQ. Number 2 on the list did $6 billion. So it was the most important ETF launch of all time, not by a little, but by a factor of 6, which is pretty phenomenal. We've had steady monthly flows, not exclusively monthly inflows. Every few months, there are monthly outflows, but mostly monthly inflows to the tune of $4 or $5, $6 billion a year. And this is why it has an impact. If you look since the Bitcoin ETF launched, and you look at the amount of Bitcoin that was produced by the network produced 360,000 Bitcoin, and ETFs bought 700,000 Bitcoin. I'm a CIO, so I do complex math. 700,000 is more than 360,000, and so the price of Bitcoin has doubled since the ETF launched. It can be as simple as that. I don't like to show many Ethereum slides, but it makes the point. I'm getting to Solana. The same thing is true with Ethereum ETFs. Here are the monthly flows, much lower than Bitcoin, but still significant. Here is the supply of ETH since Ethereum ETFs launched versus the amount of ETH that ETFs have bought, and the price is up as well. Here is Solana. You can see it's following a similar pattern. You'll see that the chart has sort of 2 phases. There was an initial Solana ETF, which wasn't in a traditional structure. Bitwise launched BSOL on October 28th, and you see it's been significantly rising ever since. These are the daily flows. You can see that we're getting something like $40 or $50 million of flows into our Solana ETF on an average day. Not every day. Some days there have been very little flows. There have been no days of outflows, but 30 or 40 $million. This next slide didn't turn out, doesn't cover, it covers actually that whole period. So I want to put it in context. Since those first ETFs launched, before Bitwise came onto the scene, we haven't quite caught up with the amount of new Solana being produced. But if you look since we launched, it's something like 3 or 4x. So right now, the Bitwise Solana ETF is buying 3 or 4x the amount of new Solana coming into the market, and more demand than supply tends to lead to higher prices. This is the last slide I'm going to show on ETFs because this is the most important slide. This is actually a slide of gold ETF inflows. And what I want you to take away from this chart, when the gold ETFs launched in 2004, they were the second biggest ETF launch of all time, right? Sort of the early version of tokenized gold. Everyone was very excited. They did $3 billion of flows in year 1. But look what happened in year 2, year 3, year 4, year 5, year 6, actually out to year 16. The flows continued to go up. And this is what's going to happen in ETF land. I would ask all of you to think, the first time you bought Solana, have you bought any since?
Or did you put it all in the very first time you invested? The same thing is happening in ETFs. So the flows that I just showed, where Solana and Bitcoin ETFs are buying more than 100% of the supply, that is going to continue and, in fact, accelerate over time as we open up these new markets. I have 30 seconds left. I'll just close with this. Bitwise is just one small piece of the puzzle, but a fun thing to say is we do 15,000 meetings with institutional investors every year. And I can tell you that often Solana comes up. We don't have much time to make the case for Solana. As I mentioned, the average person spends 3 minutes on crypto. But generally speaking, I think there's a very easy case to be made to these institutions. You can say that Solana gives you 2 bets at once, and this is why it's, I think, the most exciting opportunity in crypto right now. It gives you exposure to the growth of stablecoins, tokenization, DeFi, and other aspects. That's an enormously attractive growth, right? The SEC chair said the amount of AUM in tokenized stocks could 100,000x in the next few years. That's an enormous bet. And then you also get this second bet, which is that Solana is going to take an increasing share of that market. If you get both of those bets right, it's not 1 + 1 = 2. It's 2 × 2 = 4, or 3 × 3 = 9. It's exponential growth. And I think that makes Solana the most exciting opportunity in crypto at these current prices. And we love telling institutional investors about it. That's it for me. Thanks, everybody.
All right, so we are returning to the topic of how to understand this space from an investment standpoint. There's so many issues in weeding through all the data, all the numbers, all the things that are going on in crypto. With Solana, let's just focus on Solana. Like, how do you make sense of this world? And so our next speaker, Dan Smith, he's the head of data for Blockworks. He's going to be talking about a new product that Blockworks is working on with Solana. It's called Lightspeed, an investor relations hub. So give it up for Dan talking about this.
Hello, everyone. Hope everyone's doing well. Incredible day one of Breakpoint, and it's truly an honor to be here speaking and unveiling the rollout of Lightspeed. So Lightspeed is the industry's first investor relations platform built and designed for Solana investors. As the industry grows and matures, so do the participants within it, and therefore the way we need to communicate with those investors. The new wave of participants is really coming with a background and expectations around how they expect companies to be communicating with them, whether that's in the consistency at which that happens or the cadence, and the access to information around the financial health of the business or the core KPIs and how they're tracking their growth towards those goals. And the Solana Foundation wanted to deliver on exactly that in a differentiated and unique way, and in a very powerful way with the rollout of Lightspeed, which will help enable that communication. I think to answer the question of why now, I think it's very important to set some context around the evolution of the crypto industry. And I think it kind of rolls into 3 distinct phases, where the first of which being the sort of the bootstrapping phase. I think this is sort of hallmarked by the 2017 ICO era. This was like very retail-driven, a ton of fun. Anybody who remembers it had a great time. Anonymous founders, white papers in a dream. And while this was a ton of fun, it was largely uninvestable to institutional capital or serious capital in any capacity. And the transition into the scaling phase, or phase 2, really occurred in 2019, 2020, when venture capital started funding these new and exciting ideas of the prospect of building on a globally distributed system and putting software on that enabled developers to get instant distribution to everybody in the world with nothing more than a smartphone and an internet connection. And that's kind of the dream that a lot of us came to love. And we really started to see exchanges and custody solutions start to professionalize and evolve and enable that serious capital to get involved. And as those early waves of projects started to see some levels of success and start to test product market fit, we start to see the evolution to phase 3, which is where we're at today, where these businesses are generating real revenue and doing so profitably. And we're now starting to see the next leg of mainstream integration start to happen, where it's every day, especially today, we've heard a whole onslaught of several announcements around banks and large fintechs coming and building products on chain. And so where the marginal flows are no longer being driven by retail, but rather institutional investors that have these expectations of how to be communicated with when it comes to investor relations. It's now funds and pensions and asset managers and asset issuers. And so that is what Lightspeed sets out to deliver. And so not only for Solana and Sol, the asset, but also for the broader ecosystem. But focusing on the first piece there, we're covering the financials of the Solana ecosystem, right? And so understanding how network revenue is generated. What is the composition of that? How is it growing? What are the growth drivers there and available to the ecosystem? The on-chain activity. What is driving transaction activity in TPS? What do those transactions consist of? How would you categorize them? Stable coins, how are they growing? What types of stable coins are on chain? Where are they being used? DEXs and DEX aggregators. RWAs and lending is where we're building towards as well. So getting this sector by sector view and understanding of what is happening on chain. And not only for Solana, but also Sol, the asset. So the core drivers of the supply chain and staking rates are very important to understanding the asset itself, and that data will be available here as well. But zooming out beyond just Sol and Solana the chain, there's a broader ecosystem of applications being built on chain. So we'll have full data coverage of Solana and Sol tokenomics, as well as multi-product DeFi protocols like Jupiter, or DePIN networks like GeoNet and Helium, or the top Solana prop AMMs like SolFi and Humidify, as well as traditional DEXs like Radium and Orca. All of this data coming into one spot so investors have this full understanding of not only what's happening on chain, but within the broader ecosystem. And as these things grow and mature, so will the data coverage that we supply. So really, what I'm personally excited about is building out coverage of lending markets and vaults and liquid staking and RWAs. And we're rolling out our stablecoins view tomorrow Eastern time. I'm all messed up on which time zone I'm in. And not only will that data exist and be available to all the investors within this platform, but it will be importantly contextualized within reports and recent news coverage. So the best way to stay on top of what is happening on Solana is a Blockworks Research monthly note, which will now be available within this platform to help people understand the key growth drivers, the core KPIs, and the important upcoming network level changes that will impact those figures. And additionally, quarterly reports for Solana native protocols will also be available within the platform. So when these teams are now doing a better job of communicating to that investor group at that regular cadence, such as Radium and Helium, that will now be available within this platform, which puts everything, the data and the contextualization, in one spot for investors to fully understand the Solana ecosystem. So the product launches in Q1, and we're really focused on serving this for liquid token funds, institutional capital managers, or asset managers, asset issuers, and large individual token holders. And so we encourage you to apply. So head over to lightspeed.vip to apply today. Thank you.
Great. So we are going to take a step back. We're going to take a step back now. We've been talking so much about data. Let's talk about what's happening on Solana. And one area that's really important is tokenization. Now, in the last year, tokenization has grown 322% across all of crypto. Now, Solana is only a small part of that story, but it's a growing one. And here to talk to us now about that is Graham Ferguson. He is the head of ecosystem at Securities, a really important tokenization firm. And he'll give us a look into what's happening with Solana and tokenization. So, Graham, welcome to the stage.
All right. Hey, everybody. Thanks for being here. I was thinking back to my first Breakpoint back in 2022. It's so exciting to see how much this conference has grown, and really appreciate the folks at Bitwise and, of course, Solana for having me. So, two of my favorite topics, tokenization and Solana. By way of introduction, my name is Graham Ferguson. I am the head of ecosystem at Securities. I work daily with protocols, centralized exchanges, decentralized exchanges, and other distribution venues to figure out the best way of ascribing utility and value to tokenized securities. That's what we focus on at Securities. It's in our name, it's in our DNA. And I really believe at Securities that we have the opportunity to really help institutions come on chain. I sit firsthand in a role that sees this happening on a daily basis, and very excited to share some of the latest that we've been working on. So let's start with a definition. You probably have heard of this thing called tokenization. Tokenization is the process of converting financial assets into digital tokens on a blockchain. Now, why is tokenization important? Several reasons. I'll give a couple here. But number one, fast settlement, right? So in traditional finance, assets typically take days, oftentimes, to settle. Tokenization speeds up this process dramatically, depending on the asset, of course. But this is one big advantage. Number two, broad distribution. Crypto has done a tremendous job of distributing all sorts of different assets to the corners of the earth. This is something that has caught the attention of folks in traditional finance, and another advantage of tokenization. Number three, programmable compliance. Compliance is baked into the asset itself, right? So it happens in real time, it's automatic, it's programmatic. And number four, perhaps my favorite of the advantages is the opportunity to have a brand new design space for financial products. And so I live in New York City. A lot of my friends work in traditional finance. This is something that is very interesting to them, taking the best of what we know and love in DeFi and merging it with traditional finance. So a bit about Securitize. To give you just a quick overview, we were founded in 2017 by our founder, Carlos Domingo. Over the next several years, we launched several tokenized funds, some of which you may have heard of. We currently have the largest tokenized asset in BIDL, the largest tokenized venture fund in BCAP, the largest tokenized private credit fund in ACRED, and the largest tokenized stock in total. And as of last week, these numbers are about a week old from when I submitted this deck, but we've tokenized a total of $3.5 billion in AUM, which is what we have today. So moving forward, we also work with the biggest names in the space. We work with BlackRock, we work with Hamilton Lane, Van Eck, Apollo, KKR. And anecdotally, I mean, we have tons of interest on the supply side. Now more than ever are we seeing asset managers, issuers interested in tokenizing all sorts of assets. It's just incumbent on us to figure out, all right, what is the best way to distribute these, and how do we ascribe utility for these assets on chain. Tokenization today, just to kind of give a bit of an overview, and these data points are pulled from our friends over at rwa.xyz. We have 36 billion in on-chain RWAs. That's across various different asset classes, over 500,000 holders, 250 individual issuers. And I just pulled a few clippings from some recent news articles over the last year. As I mentioned, now more than ever, we're seeing tremendous interest from institutions in tokenizing assets and moving money on chain. So I'll give you a minute here to take a look at Solana versus the world when it comes to RWAs. Just take a look at this and sort of see what you observe. I'll direct you to. Well, I guess the slide didn't quite line up, but look at the middle stats, because the good in that, if you look at that, approximately 20% of all on-chain RWA holders are on Solana. The less good is that only 3% of all on-chain capital in RWA sits on Solana. So what does this mean? Well, it means that Solana has excelled at what it does best, which is attracting retail, building retail products. We see backed X stocks. We see Galaxy's tokenized stock, BIDL as a backing asset for stablecoins on Solana. But what does this mean in terms of opportunity, right? The opportunity is to bring institutions on chain. We need to give institutional participants a reason, a financial incentive to move capital on chain, and that's by building products that do just this, that are possible on Solana. So how do we do this? Utility. That's a gross oversimplification of how this works, but as I mentioned, a large part of my responsibility is figuring out how do we drive utility to these assets on chain. As I mentioned, investors need a financial incentive to do this, right? And in my work at Securitize, I have found over the last several months that this really does seem to be a coordination problem. There's a lot of different moving pieces, a lot of parts that need to come together to make this process work, and I'll explain why. So take the example of RWAs as collateral in DeFi, where an individual or an investor will post collateral in the form of an RWA. They will take out a stablecoin that's been lent against it, and then either post that stablecoin to loop the product, or they'll find some stablecoin yield elsewhere. But in order to build this type of product, you have to coordinate with the lending market. The RWA, the asset issuer, has to be comfortable with tokenizing an asset. An oracle to provide price feeds. You need a curator to manage risk. You need a stablecoin to serve as that initial pool of liquidity that people can borrow against. You need a blockchain like Solana to participate and be that underlying infrastructure. And you also need KYC and AML protections. So a lot of different moving pieces, right? So with that, excited to share that we did recently go live with a native RWA market on Solana with our friends at Loopscale in partnership with Apollo and, of course, the great folks at the Solana Foundation. So I'll explain exactly the coordination effort that took place to make this happen. Loopscale was the lending protocol. Apollo is the RWA. Pith served as our price feed. Paxos USDG, the global dollar network, as that pool of stablecoin liquidity. And of course, Solana as the underlying infrastructure, and Securities provided the KYC and AML services that we do to make this happen. You can see there's a screenshot from the experience on Loopscale, but really, really excited for this. We believe that this is the first of many products of its kind. We're currently iterating on it, taking in plenty of user feedback from the experience. But this is a giant step forward, we believe, in offering institutional grade type products natively on Solana. And so why is this a big deal? Like I said, it's native, right? So ACRED represents a share directly of the Apollo Diversified Credit Fund, right? So it's not a wrap token. You're not dealing with some sort of counterparty risk with an entity that you may not know or be able to trust. Apollo is the counterparty. And then it's also custom. I have to give a shout out to our friends, the founders, Mary and Luke at BridgeSplit. They did a wonderful job of working with us to figure out how to reconfigure their protocol to fit the needs of Securitize's obligations as both a registered transfer agent and broker-dealer. So looking ahead, I love slides like this because, well, there's a lot of big numbers, and the chart is going up and to the right. But even the most conservative of these has $2 trillion in RWAs tokenized by the year 2030. So if you remember on one of the previous slides, I mentioned we've tokenized in total $36 billion today. $2 trillion, if my math is correct, is around a 50x, right? And that's conservative. In crypto, we don't yet understand, I believe, exactly how big the market is for tokenization. As I said, there's tons of institutions that are showing interest in these products on a daily basis, and the market is growing tremendously, and we believe that it's going to continue growing exponentially into the future. So with that, please reach out to me if you fall into one of these buckets. We love working with protocols, as I said. If you're interested in figuring out how to get RWAs plugged into your flows, if you want to offer RWA markets, I would love to chat with you. If you're an asset issuer looking to tokenize something, we love creative ideas when it comes to the issuer side of things. If you're a stablecoin, if you're interested in exploring using some of Securitize assets as the backing for your stablecoin, please reach out. And then also, if you're interested in being the cash leg of some of these RWA trades, there's a tremendous opportunity there to participate and be an innovator in these markets. And then, of course, if you're an investor as well, interested in learning about how these products work, how we're building institutional grade products on chain, I would love to hear from you. So with that, here's my contact information. A pleasure to see you all, and thank you very much.
Thank you so much, Graham. The next section, we earlier in the first part of the day, we had another allocator, the largest bank in Southeast Asia. We didn't want to leave the continent of Europe alone either. So we're bringing on Roman Gonzalez Torres from ANG Bank, a very large bank in Europe that's already integrating Solana into their investment portfolios. And of course, Fabio Mussolini from Bitwise, who's going to be having a little bit of the conversation around how they're starting to get Solana conversations within the investment committees and how they're thinking about fund managers as they kind of think about onboarding it into their companies. Let's welcome Fabio and Roman onto the stage.
Thanks, Dave. Thank you. Hey guys, good afternoon. Very nice to meet you. Let me just drop this water here. So very nice to be here, big honor. Let me just start, before I start questioning Roman here, by raising your hand. How many of you have either a private banker or a financial advisor? 1? No takers? 2? How many else? Oh, yeah, I thought so. I thought so. And that's why? And why? Because you guys are the tip of the spear. Many times during this day, this morning and this afternoon, we spoke about institutional adoptions, right? And what I wanted to bring you today with Roman, if you guys will, is a perspective from the front lines. What does it mean to have institutional adoptions across cryptos and specifically on the Solana proper? And today we have with us Roman, who is actually one of the pioneers in this respect. So maybe, Roman, how about we start with like a bit of an introduction about yourself and about your work at AYG?
Thank you, Fabio. It seems that we have many of future clients over here, and not many of them are quite advised. So yeah, I work in a bank. I am the crypto guy inside the bank, almost to be fired a couple of times, as you can imagine. So I spend half of my day trying to convince really serious institutional investors, not convince, just to explain what is really crypto and why they should allocate at least 2 to 3% in their allocation, in the asset allocation. And the other part of the day, I spent trying to convince our compliance team that I am not here to blow up the bank. So yeah, in fact, there is a funny story about this, Fabio, I want to tell you about, because there was one of the guys, one of our compliance officers, this was the one that was in charge to review all the presentations about our crypto product and make sure that we were really compliant with regulators. And after weeks of all this work, he came to me like, OK, Roman, after doing this due diligence, how can I invest in crypto? So he finally invested. So the beauty about this is the people that really are digging in, that are doing the due diligence, are finally investing in crypto. So yeah, we finally launched this Cryptomonedas fund. It's a crypto hedge fund based in Madrid, Spain, in 2023. It's the first daily liquid fund in Europe. It's 100% regulated by the Spanish authority. And we are investing up to 100% in crypto using European physically backed ETPs.
Love it. Thank you, Roman. Very nice. Actually, I really planned to ask you how the idea for Cryptomonedas came along, because Cryptomoneda is actually the first fund of its kind in the whole of Spanish-speaking investment space, which is amazing. Can you tell us a little bit more how the conversation was within the bank in order to get into this pioneering position? Because it's quite interesting. On one hand, it's more like, okay, how can we make sure that the investor journey is safe, right? And we're compliant with regulation. And on the other hand, it's like, let's be innovative. Let's try to be ahead of the competition and launch something new and include crypto into our offering. How was that? What did you have to balance within the different, let's say, interests?
Yeah, so the journey was about educating people. So first of all, there were client demand. Okay, so young clients, they wanted exposure, so they were explaining their dads about crypto, and they trying to convince them. That's quite interesting. Older clients were about, okay, maybe it's good to diversify a little bit. And all our private bankers and advisors were more about, okay, I need a product, a serious one, where I can really offer this new asset class to my clients without sweating. A product where what I can really defend into investment committee. So that's the reason we started thinking about creating this fund. Yes, to make a really proper regulated product, a serious one to invest in crypto for the long term.
Got you. Absolutely. And then you mentioned specifically crypto ETPs, which it's quite interesting. Like, can you tell us a little bit more? Why did you decide to build your investment structure using these vehicles? Like, what's so special about them? What makes them specifically fit to your use case?
Yeah, I've been in crypto 10 plus years, and sometimes I'm really well criticized in the, let's say, only crypto atmosphere. Like, okay, why ETPs? Let's try to do all kind of transaction and so on. I've done that, And I still am doing that in Ethereum and Solana and all the layers. And I have to say that for the first 1,000 USD, it's OK. Maybe a couple of thousand, it's OK. But when you try to invest more than 10,000, 100K into the space, you should go safe. I am a computer engineer, and even myself, sometimes I'm kind of like, I could mess it up with the keys, with the ledger, with everything. You know, it's like operational risk, a lot of kind of phishing attempts. So it's so secure, an ETF and in the States or ETP in Europe to get involved in crypto that we really think that's the institutional and serious way for people to invest for the long-term, serious amounts of capital.
Got you. Absolutely. And actually, to your point, just the feeling of safety is so fundamental for, in the end, the people who are the beneficial owners and then your funds, right? They have to benefit from that type of custodial securities, custodial safety. So very important point. Let me ask you a little bit. So you talked to us about how the cryptomonedas idea kind of came to be, what you had to, let's say, negotiate in terms of internal stakeholders, let's say, in your strategy. Tell us a little bit about your work, your strategy specifically, if you can. I don't want to reveal any family secrets, just what you feel like sharing with us.
Yeah, Fabio, the strategy is simple. I mean, this space is going to give you 40% annualized returns for the next 10 years, in my opinion. So it's kind of just stay focused, diversify, be really blockchain agnostic, although, you know, we are here for Solana today. But, I mean, you have to take into account that there are several major ones, and you should allocate to them properly. So, for example, what we call the FAT protocols, Bitcoin, Ether, and Sol, those ones, you know, they are huge in comparison with the other ones. With that, it means I like to compare it to mobile smartphones, operating systems. There are Android, there is iOS, and nothing more. Even Microsoft tried it with Windows Phone. You know anybody with Windows Phone here? Nobody. So, I mean, same is happening with these protocols. I mean, when you have in the smart contract protocols landscape protocols like Ethereum or Solana, the cost of penetration of new protocols is so high that you should allocate properly. That's the reason we have higher percentage and higher allocation in our fund to Bitcoin, Ether, and Sol, and fewer percentages to other protocols that, yeah, maybe they could go on a lot, they could grow a lot, but the probability to fall apart in a 4 or 5 year period, it's pretty high.
Got you. Absolutely, yeah. And I love also the idea that you're sharing with us, the idea of giving market access to the investor, right? Like the real benefit being you're in the space, you're investing in the space. Doesn't necessarily specifically accrue to one asset. But since we're here, since we're at Solana Breakpoint, let me ask you something more about Solana. What did you get? So first of all, are you a strategic investor in the fund? You just mentioned it, but how did you get to take that decision, and how's it gone for your investment journey so far?
Yeah, so Solana, I think I'm the first one that is telling you this here. Solana fell apart more than 97% in the last bear market in 2022. So, I mean, the resilience that Solana saw us really surprised. The recovery of Solana, of the protocol, was pretty high, in my opinion. There are few coins that, if you measure the price action in terms of Bitcoin, for example, there are few ones that recover so fast as Solana did. So that's the reason we had a 4% allocation at the beginning of the fund. And later on, we saw a really increase in fundamentals in the network. So a lot of developer activity, a lot of application, real blockchain application growing on the protocol. So that's the reason we really dig into our due diligence. We really dig into the protocol, you know, all the boring due diligence stuff. And we finally decide to allocate up to 10% into Solana. So that's our allocation during this, drop in the alt. There is no alt season. You know that, and that's the reason we are.
But you're also the first to say it today.
Yeah, but we are overweighting now Solana because in terms of market dominance, I think it's around 3 point something. But I mean, we have triple amount of weight in the protocol. So our current allocation is 10% in the fund.
Oh, perfect. Got you. So it's interesting because you're overweighting Solana even despite what the metrics
yeah,
tell you.
Even 10% maybe could seem pretty low, for a Solana ecosystem network event. I have to tell you that it's a lot in terms of market dominance.
Absolutely, thank you. And let me just follow up, still on a question about Solana, because I know that you follow this quite specifically. What are the drivers that you see going onwards for that are of interest to you as an asset allocator for the Solana ecosystem that would make you say, oh, actually, that's somewhere that I really want to be in. That's somewhere that excites me, and I want to participate into that, making sure that my investors participate into that.
Yeah, our coin invested decision is pretty boring. I mean, you don't have to be the most coolest new protocol or new crypto. You only have to survive a morning meeting risk committee in the morning. I mean, so yeah, I mean, not funny stuff. We look for really key fundamentals. We are looking for real cryptocurrencies, so permissionless is really important for us. Decentralization, sometimes they argue that Solana isn't decentralized enough. I would tell them that even a Solana financial ecosystem is better than the current financial traditional rails. So talking about that, we saw a really huge explosion in stablecoin wars. As you know, more than 300 billion are running now in stablecoins around the world, and it's growing a lot in networks like Solana. So, I mean, when you are running a stablecoin and you are moving USDC, USDT around the world, you already have a counterparty risk into Circle or Tether. So, I mean, maybe it's not really worried about the level of decentralization of Solana. It's more about how Solana is really fast, how Solana is allowing you to move dollars as the speed of light, and it's converting dollars into programmable money. So I think that's pretty interesting in terms of which crypto we want to have in our portfolio.
Absolutely. Thank you very much. And a very last thing, very last minute. I opened by asking a specific question about our industry, right? Our industry is like any other industry, has a top and a bottom, and has a distribution functions. And I think what excites me about it is that very many times you have to educate people. It's still in a point, at least in my country, but I suppose in Spain it's similar as well. Together with, and specifically in your case, you finally have something to offer your guys in order to get out there and respond to client demand. What do you guys do in terms of education towards your network, towards your private bankers, and towards the broader activity in order to spread the word?
Yeah, it's a lot of meetings with people trying to explain what is crypto, how they should get involved, and how they really should have that 1.5–2% structural positioning in crypto, because this is an asset class that decorrelates. So sometimes it's difficult because it's seen as a lottery or something like that from outside, but it's not. I mean, this is going to give you 40% annualized returns, and that's going to renew your capital by 30 times. So it's not about if, it's about how much to allocate. So at least 1%, in my opinion.
Amazing. Thank you very much. Thanks, Roman.
Thank you all.
So we are getting late in the day here, but we're going to keep it exciting. There are so many ways to get yourself invested in the Solana ecosystem. There's buying SOL directly. as a token. There's buying ETFs. There's DATs. There's hedge funds. There's venture funds. All sorts of different ways. And there's other ways to invest your money. Now we're going to bring up Joe Egan from Anagram. He's the co-founder of Anagram. He's going to be talking about permanent capital vehicles, a different kind of way to invest in this ecosystem that you're about to learn from. So Joe, welcome to the stage.
Thank you. Hello, everyone. I was just informed that this is actually the longest talk at Breakpoint this year, and so I decided to make it the most boring 20 minutes of your day and talk to you about permanent capital. But hopefully we've put enough memes and hot takes in here to keep you entertained a little bit. And to start with, LPs make you dumb. So I am Joe Egan, the co-founder of Anagram. We are a permanent capital crypto holding company. We build products in the crypto ecosystem. We incubate products, and we also invest directly off our balance sheet into crypto projects, portfolio companies, and tokens. When we started Anagram, we wanted to think natively and from first principles about how to allocate capital in the crypto space. And we'll get more into why I think permanent capital is so important, particularly in the crypto ecosystem, but really all across the board. Before we do that, though, it might be worth a few minutes on just capital in general. So capital I think of in three broad buckets. There is financial capital, human capital, and physical capital. We take these resources and we deploy them and hope to create some amount of value. Historically and in traditional finance, we've done this in silos and then generate hopefully some sort of financial return off of that capital. But as we think about investing this capital, LPs have done a number of different things to actually make the allocation of that capital, in my view, dumber. There's really four things that I think go into this. There's the investment program and the limitations that are put upon that. There's the time or term of investment that LPs put upon any of the funds that they invest in. There's the concept of return on investment relative to fees generated on those investments. And then there's also capital allocation and how we think about actually allocating that capital across each of those three different buckets I just mentioned. To start with, let's talk about investment program, or how funds think about building out their alpha strategy, or what they can actually invest in. If you think about a fund, there's really three overlapping constituents that need to be considered. First and foremost, your expertise, or the CIO's expertise. What is the market opportunity then that they want to extract with that expertise? So maybe I'm a crypto portfolio management and a manager in a liquid fund, and I'm going to invest into the crypto market where I see prices to be down. At the same time, there's investor demand. What do investors actually want? And then you have that overlap. In this picture here, you can see it's actually quite small. As you add more constituents to this, that surface area actually reduces quite significantly. And so it reduces your ability as the investment manager to deploy capital fully across your area of expertise. And so if you eliminate the LPs from this model, you have a far bigger area of alpha to generate in the market. What's interesting about this is not only is the LP limiting your ability to allocate capital according to your area of expertise, but they are also limiting it to the area that they know best. Typically, LPs like to invest in things that they know and understand, which is somewhat ironic given that they're also generally paying you, the portfolio manager, fees for allocating capital in that space. And since they don't understand usually the most complex part of your strategy, they're going to limit you to the part that they best know and understand, thereby limiting you from the most alpha-driven part of your actual strategy. And so by limiting that LP, you're growing it, but you're also growing it to the area that least people know and understand, and therefore where you can generate the most alpha. So in addition to the investment program expansion that you get by eliminating the LP from your model, you also have the impact of time, right? So if you think about a traditional venture fund, that's a 10-year vehicle. That can either expand your time, maybe you hold an asset too long, or compress your time. Maybe you don't invest in certain things because you think it will be outside of that investment program. But even more interestingly, if you think about liquid funds or hedge funds, you have funds that are open to any sort of redemption windows. Let's call it a month or 3 months. So now, when an LP wants their capital back, you are a forced seller of assets. And one great example of this would be, let's say, FTX collapses, for example, and everyone gets scared because they don't know what's actually happening in Solana, the ecosystem, and Solana, the asset. You now have a bunch of forced selling at the worst possible time, and at a time when most investors should actually be allocating more capital to the space. That would have been your best opportunity for investment in the liquid markets in crypto over the past 5 years. And so by having LPs that are capable of taking capital back when they want it, as opposed to when you think it should be returned to them, you are also limiting your ability to make excess returns in those moments of pure opportunity. Onto return on investment relative to fees. I think one thing that is interesting about funds is that because of the fee structure, typically something like 2 and 20, there's an incentivization for asset growth over returns. The dynamic actually exists as carry is charged on absolute dollars raised as opposed to absolute return generated on a percentage basis. So to best highlight how this actually works to, I think, the detriment of underlying investors, here's a quick example. In Fund A, you've got $100 million with 100% return, therefore $100 million, and a carry of $20 million. The fees on management are $2 million. And then we relate that to Fund B, a far smaller fund with a far higher return. This fund returns 10,000%, also generating $100 million and a $20 million carry. This $20,000 management fee is obviously substantially less as well. So here we have a business model where the portfolio manager is actually incentivized to have higher assets and a lower return profile relative to a higher ROI where you actually make less money. And then finally, capital allocation. Capital allocation has typically been bucketed into these 2 buckets. Financial capital is allocated by funds. Corporate capital is allocated to humans to then go and build things. This has been fine in the world of Web 2, where typically these capital barriers have been siloed. Funds have invested in things, corporations have built things. But going forward, I think it really fails to be successful in the crypto markets where building and investing come hand in hand. And that gets us to crypto itself. Crypto is really the first unique asset class in the past, I don't even know, probably since equities. And so we have this very unique asset class. It is interoperable and composable. It is open source. You can build things on top of other things, and you can do this at your leisure in a totally permissionless environment. And yet we have taken the same exact business models for allocating capital in the crypto space that we have always done in the past. We have funds for financial capital and corporations for human capital. And instead, I think we should be doing this in a more entangled way. So in addition to each of the buckets that we just described, investment program, time, ROI and fees, and capital allocation, each of these buckets gets more exaggerated in the crypto space. In the crypto space, if you think about the investment program, fewer people really know anything about it, right? It is more technical, it's a low-level technology. And so it is even harder to understand for those LPs, and they constrict that investment program even more. Similarly, if you think about time, on a time scale, there's a tokenization. Investors see liquidity. They want that capital back as quickly as possible, thereby incentivizing you to be a seller of that asset as opposed to a long-term benefactor of the ecosystem and a holder of that asset. Similarly, on ROI, as funds have grown, so too have the valuations at which people are willing to invest in, thereby reducing the long-term ROI to an even greater degree in crypto, I believe, than in other spaces. And then finally, capital allocation, where this really comes to a head. We are still today limiting the ability for investing in and building in the crypto ecosystem in one coordinated effort. So maybe just to give a few quick examples of where I've seen this come to bear on the market. In 2017, when we were allocating capital into the liquid crypto markets, most investors told us that they would not invest with us because crypto did not have custody solutions. And in fact, that was true. We were using ledgers and other internal methodologies, but because we custodied our own assets, LPs didn't invest with us and missed what I believe to be probably the greatest investment returns of our lifetime. Similarly, if we think about things like monthly returns, or quarterly returns and the reporting of those returns, and then lay on top of that the volatility of a crypto asset. As investors see those returns, managers begin to manage to those returns, and instead of going for it and buying more of the asset at the right time, either they become the foreseller we just discussed, or they end up managing to the return instead of the long-term value of the asset and the long-term value of the ecosystem. Where this really flips on its head, though, is in the inability for the capital allocation to work together, where humans can build things and also invest in things side by side. So if you think about the crypto ecosystem, if you have built Solana, you should also invest in Drift or Jupiter or any of the millions of projects that are here that all warrant investment. At the same time, if you have built a lending protocol on Solana, it also would make sense to then buy, as a founder, Solana and put it into a lending pool, or to invest in a tranching mechanism that would sit on top of that lending protocol. In this way, the more you invest into the space, the more value you create for the things that you have built, and the more that you build in the space, the investments that you make can interoperate with the underlying assets on your balance sheet. To maybe put this into more specific examples about how we think about this at Anagram, we have Anagram staking services. We launched Anagram staking services as a validator for a balance sheet position that we have in Solana. We had a big enough Solana position that we wanted to validate ourselves as opposed to paying out external commissions. As we began running this, we also decided more recently to invest and lead the investment of a pre-seed round for Rakurai, who's also here today, and I encourage everyone to reach out. Rakurai is an efficient scheduler who came to market, and we became their first customer. We use Rakurai today in Anagram staking services, and we have, on any given day, typically the most performant validator in the Solana ecosystem. I welcome you all, by the way, to delegate to our validator. Reach out if you have any questions, but stake.anagram.xyz, shameless plug. We do have the most performant validator and also one of the largest validators in the network. In this way, our validator has benefited Rakurai. We became their first customer. Rakurai has benefited us. We now run the highest performing validator in the network. And all of that then also benefits Solana, the ecosystem, and Solana, the asset. Solana, the asset, will hopefully go up in price as block space becomes more efficiently packed. And Solana, the ecosystem, has all of the benefits of not just our validator and Rakurai, but more efficient block space as well. There's many such examples where we have done this on our balance sheet. There's also a few other projects that are speaking here today and tomorrow. We spun out a project called Glider. Glider is an efficient portfolio management tool where it has fully abstracted all chains so that you can create portfolios, trading, lending, whatever you want, using AI tools in a very sleek and unique UI. Glider was not yet ready to incorporate Solana because they did not have the appropriate tooling and wallet infrastructure to do so. After realizing that this issue was abundant with Glider, we decided to then build Swig wallet infrastructure that is now its own company as well, where there's things like roles, permissions, paymaster, all for use in the Solana ecosystem. And Glider is now incorporating that technology and able to fully abstract Solana's chain into its technology. So every time that we make an investment or build a company at Anagram, we want to solve for three things. We want that project to be valuable itself. In this example, we want Anagram staking services to be a valuable enterprise in and of itself. We also want it to benefit our portfolio, in this case, Rakurai. And in Rakurai's case, we want Rakurai, something we have built and invested, to also be valuable to our balance sheet. And at the same time, we want to be valuable back to the ecosystem and be owners and holders of those underlying ecosystems. In this case, Solana. By running a validator, by running the most performant validator, and by working on these two things together, we think we not just benefit Solana the ecosystem, but selfishly Solana the asset price that we continue to hold on our balance sheet. So if we think about permanent capital versus funds, we think that by having a permanent capital vehicle where we sold equity in our business as opposed to raised capital from LPs, we have a model where we can do what we want with that capital when we want and for whatever term we want. This allows us to continue to make the investments that we want. We can make venture bets, which we do. We can make liquid bets, which we do. We can have an EIR program where we have entrepreneurs coming to our house and work with us for 12 months. We help them think through the idea maze, what kind of company they might want to build. We also have a build program where we are consistently hiring engineers to come and build new projects like the Validator, like Glider, like Swig, like Breeze, like so many other projects that are soon to launch after that. We have this enormous arsenal of skills and tools in-house where we can now combine all of these assets together that all mutually benefit one another for compounding value, not just for ourselves, but for the ecosystem. And so anyone out there today, or anyone out there on the internet that's watching, we welcome anyone to please reach out to Anagram. We have permanent capital to deploy to you, whether you are a founder, an engineer, a CEO, whoever you might be in the ecosystem. We're always looking for more partners anywhere in the world and look forward to speaking to all of you very soon. Thanks very much, and LPs make you dumb.
Thank you so much. The next session we're going to be talking about is a frequent question we get from investors, from institutional investors all the time, which is we hear a lot about DePIN, we hear a lot about what's a real world use case that we're seeing that gets very tangible. So we're really excited to have Ariel Seidman and from founder and CEO of HiveMapper join us. As of this month, we have 70,000 plus HiveMapper contributors that are really mapping the world real time, which we're so excited about. And I'm Danny Nansen, research analyst from Bitwise, one more time, to kind of have this really great conversation around what is HiveMapper doing and how is it really changing DePIN and the real world application of HiveMapper. Welcome up, Danny and Ariel.
Welcome to the stage. So I want to get things off right away with an interesting comparison. So I was just with my cousin. He is a community manager for Waze. Well, what he does is he brings people together in different parts of the world and encourages them through like little gifts and little trips, hotel stays to help Waze map the world, see where stoplights are, see all this. And Waze is one of the biggest mapping companies in the world. They have a community. They're bootstrapping a community to get this information. Now, my question for you to start off, how does a token make this better?
Yeah. Well, token works in terms of incentivizing people to buy our camera. And so just really quickly, well, thank you for having me. Appreciate it. You buy this camera from us, and it looks and smells like a dash cam, right? So like any dash cam, you go to an Uber, Lyft car. I'm sure you guys all seen them. But what that dash cam is doing, in addition to providing like safety and all that type of stuff, is actually mapping the world. So it has eyes, in other words, the cameras, and it has AI intelligence that is doing many of the similar things that people in Waze do behind a computer, right? So okay, like how many lanes are on this road? That speed limit sign over there, that's 25 miles an hour. There's a no turn restriction over here. You're not allowed to make left between 4 and 6 p.m. 2 out of the 3 lanes have road construction right now. All that type of stuff is actually being mapped and on the device level, and then we're just uploading the bits and parts. The big problem with Waze, I love Waze. I think when I was at Yahoo Maps, I was running it for a while. It was like, look, like I could compare myself to Google Maps, but fundamentally, like both of those products got people from point A to point B, right? And so people were like, how are you better than Google Maps, whatever? I'd make up a bunch of crap. In retrospect, they were fundamentally the same product, right? Then Waze came around. I'd already left at that point, like 2010, 2012. And all of a sudden, Google Maps and Yahoo, for that matter, like felt incredibly stale, right? Like that was like a wow moment for me, right? It was like, okay, you just, I mean, you guys all use Waze now, but like at the time, like it just felt like that product was so much more interesting, so much fresher, so much more useful. Our belief is that with vision, in other words, cameras at the edge, combined with AI, obviously, that's a kind of another leapfrog, right? Because fundamentally, what's happening with Waze? So Waze is basically asking a human to interpret what they see, and the number, and then you punch it in while you're driving 65 miles an hour down the road. You're like, okay, there's a cop here, you know. And so, but the other aspect of it is, in addition to being unsafe, is that it's only asking you for a very small sliver of things, right? But with cameras and AI, like you're interpreting and understanding all those things, right? And so kind of a longer answer to your question, but I appreciate that your cousin is still doing that. I didn't realize that people are still doing that. Waze got bought by Google, for those of you guys don't know.
Yeah. So another question on this topic. DePIN, decentralized physical infrastructure, this idea that you can create like actual, you could put hardware out into the world and have network effects and do amazing things with crypto incentives. Is it living up to the hype?
Okay, there's two parts of that answer. One is, in terms of markets, probably not. Okay. Right? Let's be really honest. In terms of crypto, let me sharpen that actually. If you go to like whatever CoinMarketCap and you look up like our token or like all the other majors, right, in the DePIN category, Helium, Geodnet, I think the answer to that is probably no, right? But in terms of actually delivering value, like to customers, like yes, 100%, right? So Lyft is our customer, Volkswagen is our customer, Here Technologies, which is owned by BMW, Audi, et cetera, is our customer, NBC is our customer, Ricoh is our customer. I mean, the list goes on, right? And so they're all delivering tremendous value to their products and services through our data. Helium, which I know those guys very well, I think they have like 2 million people using their network in some form or fashion, right? Hundreds of thousands of mobile subscribers. So like for a startup, that's incredible, right? But in terms of the crypto markets, like they're like golf clap is basically what you get, right? And so I do think that's a fundamental issue right now that we're facing in the DePIN category, and it's a real problem.
Help us understand, what is the role that the blockchain actually plays in delivering this? Like why, not just why Solana, like what are the attributes of Solana, but why is it necessary to have this sort of really valuable infrastructure? Like it makes sense to have people go out to the world and collect this data. It's useful, it just works. But where do blockchains come into play and why are they necessary?
Well, there's a couple. One is the incentive mechanism, which I think is important, right? We talked about that a little bit. The other one is coordination, right? So like we need to be able to coordinate a lot of people in a lot of different parts of the world, and it needs to be trustworthy. So we actually started off not paying people with our crypto token. We just started paying people cash. Okay, so this is like 2019 timeframe, and it was working. Okay, to be clear, but we said a couple of things. One is like people would start to like point their camera up at the sky, and then we wouldn't pay them, right? And we'd be like, we're not mapping the sky, we're mapping the road, you know? And they'd be like, I'm gonna report you to the Better Business Bureau, you guys suck, whatever, all this type of crap, right? And then the other thing is we wanted to basically pay people very quickly, right? So these people in the Philippines would be like, can you just pay us in crypto, right? So that was another like kind of interesting. Anyways, long story short is like there's the crypto incentive, which we think is pretty strong, and it can be really important. The other part is trust, right? Like by putting all of the rewards and the consumption on the blockchain, we no longer became the bad guy, right? That was like not a totally, I kind of understood that at a superficial level, but there's a lot of depth there that I think is important. And so, now people look at it and be like, okay, if I'm driving in this region, how much could I make? Okay, boom, boom, boom. It's all out there. It's all out there, right? Like how much consumption is coming in. So really the people who are driving are our salespeople. And there's a lot more trust in the system because people don't point the finger. I mean, people still yell at me for a lot of stuff. If you go on, Twitter, like that's always fun. But like that's fine. That's part of the job.
Are they ever making a good point?
Yeah, for sure. Yeah. I mean, look, like I'm probably more frustrated about what they're frustrated about, right? Is the reality, right? So like if there's a bug in the product, like that pains me more than them. Like I hate that crap. And so, But yeah, there's some that is obviously like more personal in nature, but that's just the internet in general. So it's like, if you don't want to do that, don't go on the internet, don't go to a Twitter account, you know?
Yeah. Jump back for a second. You mentioned something really interesting, which is that it sounds like you almost backed into crypto. You were building a solution and then realized that the thing you were building would just work better on crypto rails. So dig a little deeper on that.
And look, when we were doing it by cash, like we maybe had like 1% of the global road network mapped. Now we've mapped 36%. So it is like definitively worked, you know, like there's 1,000%. Now I will say the following though, which is, so we've mapped 36% of the global road network, which is great, amazing. A lot of our customers are like, we need more coverage, like a lot more coverage, right? And we need, you know, coverage in Brazil. We don't have a lot of coverage in Brazil, right? We want coverage in Vietnam or, you know, whatever, all these different countries. And so the thing that I think is important now is, look, you'll always have like the crypto incentivized folks, right? This gets to another part of your question, I think. You always have the crypto incentivized folks. But the reality is like, even if our token price was like $1 right now, which is not, like there is not enough crypto, the population or the audience that we would be talking to around the crypto incentives is not big enough to satisfy the kind of coverage that we need, right? Like if the crypto industry was like 10x, then I think yes, we could, and our token was $1, then there's enough of an audience that we can talk to and basically be like, here's a camera, you install it, you earn these tokens, blah blah, right? Like it's all very straightforward. But the reality is that the crypto industry is not that big yet. And so what we're now thinking about is, okay, what are the products and the technologies which will take this camera and get into a lot more devices, regardless of whether or not there's a crypto token attached to it, right? And so like commercial fleets is very interesting to us, right? Commercial fleets, if you're a trucking company, your delivery company, whatever it is, you may have noticed there's like a little dash cam in there. What are they doing? They're monitoring that driver to say like, okay, which of those drivers are driving like an idiot, right? Because that's a big liability for me, right? Like insurance-wise, you know, God forbid they kill somebody driving like an idiot. And they just want to know where their drivers are. Like, hey, did you hit that route at that customer at that right time, all that type of stuff, right? That's very valuable information for them. And so we have customers that are basically pay us to be, you know, we provide them a service, right? All that type of stuff that I just mentioned. But in addition to that, they're also mapping. But they don't know about the crypto token. Like, they don't care about it. I mean, some of them do, but like the vast majority that you say crypto token, they're like, what's up? You know, like, I don't care, you take it. And there's some other stuff that we'll probably announce in 2026 along the same lines of getting more coverage in a method that doesn't rely only on the crypto token.
So that's really interesting. I haven't actually thought about that before. This fact that the crypto tokens and incentive programs aren't going far enough. Like it works for some areas. It works for, what is it, 36%?
36% of the global road network.
6% of the global road network, but I don't know. There's some backwater road, deep in Patagonia that just isn't getting mapped because no one who's in on crypto lives anywhere close to there.
Exactly. Yeah. So if the entire, like, kind of going back to that point, is like the entire industry was 10x, bigger, then yeah, there's some little small town in France or Brazil where we don't have coverage yet that somebody heard about us through this conference or some another kind of crypto audience, but that person doesn't exist, right, in some of these small towns. So my whole big thing is like, the crypto industry needs to get bigger, a lot bigger. And my view is, and this may be a little bit controversial sitting this at a Solana conference, is like, I don't think the way we're going to get there is with more casinos, right? Like, I think we need more products that are going to touch more users in the real world. I mean, look, why is it that like, products like ChatGPT and Claude and all, Gemini and whatever it is, they're growing so quickly in the AI world is because they're fundamentally useful products, right? And so people are just using them because they're useful products. I mean, you guys all use them. And so if there was just more useful things, the crypto industry would very quickly get a lot bigger.
How do we find more useful things?
That's the magic question. I don't know. I mean, I have some ideas. I think part of it's a structural problem and part of it's a cultural problem, right? There's a structural problem, which is, look, if you create a casino, you can make a lot of money very quickly, right? And I think we all know that. Where some of these other products, they take longer to evolve and grow. I mean, SpaceX started in 2002, right? I mean, it will probably go public next year, be worth whatever, 1 trillion or 1.5 trillion, massive. But that was, what, 23 years, 24 years? Long time. Like, crypto world, like, they move, like, within weeks, like, oh, that's hot, you know? Very, very different than like that world, which is a little bit more patient with their capital, with like the idea and stuff like that. So I think that's a cultural problem. That's a structural problem. In terms of culture, look, I think you just need more people, right? Basically saying like, we want real products and services. Like, great, there's a casino. Like, I have no issue with the casino. Sometimes I go to Vegas and I'll do blackjack or whatever it is. I got no problem with that. That's cool. But like, that can't be a big chunk of like what crypto is today. And you know, I would argue you have stable coins, which are real. Like, one of my brothers is very crypto skeptical. He works at Shopify, and you know, I think they'll do something around. Hopefully that doesn't like break any like news. That'd be really bad if like that's not public. But anyways, yeah, shit. Like I said, I was like, oh crap, someone's gonna come after me now. Anyways, I hope they do something around stablecoins. So that's real, right? Like even my brother, who's like a pretty big crypto skeptic, is like, oh, this stuff makes sense, right? And then you have a bunch of stuff in DeepEd. And then you have exchanges, right? And then you have companies like Bitwise, stuff like that. So there are real products and services, but like a big chunk of it is, you know, some version of a casino.
So to go into where products really are useful, I think that DeepIn stands out because it is that moment where you see something useful being created. In the case of HiveMapper, it's mapping software, or not mapping software, mapping data. Yeah. In the case of Helium, it's a better cell coverage. How do you, like, when you look at DeepIn, how does it stack up in the crypto world for you?
I mean, in terms of like enlarging the pie, which I think is the most important thing that we all have to be focused on, I think it is one, you know, other than stablecoins, the thing that is enlarging the pie, right? Because, like I was saying before, is like people who are coming in using Helium or people using HiveMapper data and these commercial fleets, et cetera, they don't care about crypto. Like, they're just trying to buy a product, a better service, whatever it is. The fact that it's running on crypto rails is like besides the point, right? And so that to me is like fundamentally interesting in terms of enlarging the overall market. So, you know, this conference 5 years from now is, I don't know how many people are here, that, you know, it's 5,000, 6,000 people, that there's 50,000 people, right? And I think the way to get there is focusing, you know, all of our energies as much as possible on real products and services.
So what's next for HiveMapper?
Look, I think this coverage thing is real, like this coverage challenge that we have. I mean, you know, I think we're all very proud of the fact that we've hit 36% of the global road network. We love that. And yet, we need more, okay? So let me talk about this a little bit more. Some of our biggest customers are saying to us, like, this is great, but like you got to be like 80%, 90%, right? In terms of like coverage per se. There's another aspect of it is like freshness, right? So like, let's take the metro area of Los Angeles, which is about 100,000 road kilometers. So it's quite a large area in terms of road kilometers. People like to drive there. So in order for us to provide a map that is fundamentally fresher than Waze, that requires probably like daily active cameras, about 5,000, right? We have a lot in LA. I think it's about maybe 800 or 900 that are there, maybe a little bit more, but it's not, you know, 4,000 or 5,000, right? And so at 4,000 or 5,000, like you can provide every layer of the map, right? Like literally, like an accident happens, we'll see it very quickly, right? Road construction pops up somewhere, we'll see it very quickly, right? Like all of a sudden, like our vision of like a real-time map, right? Like Waze, but with cameras that can see and understand everything, that starts to happen for a region like LA at like 4,000 or 5,000 cameras, right? So like that's the other aspect of it, and so that's why we're kind of thinking in terms of like growing our coverage. Like token incentives is a critical part of it, but there has to be and statements to that now.
And then a final question: a year from now, where do you think HiveMapper is going to be? Like number-wise, is it going to be 50%? And then just in terms of the community, where is it going to be in a year?
Yeah, I hope we're closer to 50% by this time next year. I would say one other thing. I think that what I think you'll start to see next year is like bigger, you know, call them Web 2, big tech, whatever you want to, whatever you know name you want to put on that. I think they're going to start to like integrate into some of these systems because I do think that they see the value of these decentralized networks, And even for a company like Google, it's very expensive.
All right, well, thank you for that. And we will be taking a short break. We will be taking a short break, but don't go anywhere because we're going to be closing out with Anatoly himself in a very short amount of time. So we will see you shortly. Thank you for sticking around. We are going to be closing out the content at this stage today with a talk with Hong Kim, our CTO at Bitwise. He is our tech expert and, of course, the man himself, Anatoly Yakovenko. He's the man who needs no introduction, but I will give one anyway. He is the guy who really helped start the Solana network, not alone, of course, but he continues to be someone who, despite Mert's attempts, has a full head of hair, we'll call it that, and he's going to be here today to talk about Solana's next chapter. So, Hong and Toli, welcome to the stage.
All right. Great to see everyone, and thank you for being with us, Toli. I know after the jet lag, it's a long day, so try to keep it fast and fun, and yeah, hopefully engage with the audience as well. The title of, or the subject here is around like how do people in this room probably are all familiar with Solana as it is today, and there's a lot of things being worked on. But what does like the next 2 orders of magnitude look like? Like what would that future of where we get to 1 billion users, or maybe all of Wall Street is using Solana, like what would that look like, and what needs to happen from where we are now to get there, from your view?
You know, how do we get the next 1 billion users? That's always a super fun question. and we can imagine a bit or do some wishful thinking. I think I'm still, I think, maybe forever stuck in the 0 to 1 kind of startup mode, and a lot of the advice that I've seen that's like maybe helpful, or at least the stuff that's worked, is things that classical kind of Paul Graham essays. And the main thing is to not die. It's actually just, I think that the core thing that we need to do is to survive. That means continue building products that people need and continue getting to PMF. And a lot of the stuff is kind of the day-to-day grunt work that all these amazing companies and all these folks do in the ecosystem, and that is as like kind of as silly as the 2 robot fighting. Like that is a really fun, entertaining project that is maybe onboards the next 20 users and the next 200 users, but in aggregate, you need thousands of those to continue to keep doing and onboarding users and doing fresh stuff and keep building. I think the obvious stuff that's happening in the world right now is stable coins. I think that's pretty straightforward. Everyone expects, $1 to $10 trillion worth of stable coins to be on chain sometime relatively soon. And that is such a staggering amount of digital dollars that I can't wrap my head around it, and it's hard to even explain how it's going to transform finance, because we've had 100 to 250 billion worth of stablecoins without any kind of regulator support.
Yeah.
And that's been massively, massive PMF, massive amount, very big companies, massive amounts of value have already been created. What that looks like in the 10x phase is just really hard for me to fully grasp.
In some ways, the financial scale is harder to think about than engineering. And engineering scale, like a spec, you can think of what is it. But in terms of what the financial...
Exactly. I mean, those are just bits, right? I can tell you how many, how much silicon we need and how many network cards we need to handle this many messages per second. But when you're dealing with securing and guaranteeing the settlement of $10 trillion worth of stuff in real time all around the world all the time, I think that those numbers become very significant.
Also how the world will look like when the internet is the largest holder of US Treasuries, and it's not China and Japan, it's literally people in this room, the applications, the users. When that user base and the internet citizens are have the largest holding of dollars, the world can be very different in a meaningful way, and it's harder to understand kind of the second, third order effect of that. But it's an incredibly exciting proposition.
And a lot of very subtle things change that we already start to see. So I think Silicon Valley and Wall Street kind of have had these monopolies over the last 20, 30 years where you had to effectively raise in Silicon Valley because that's where all the funds were. That's where Berkeley and Stanford continually generate founders. Absolutely. And then after you hit PMF and you build this amazing company, then you IPO on Wall Street.
Yeah.
This was kind of the typical life cycle of every startup and every investment.
These days, they don't even IPO.
Yeah, and a massive change. Everyone kept talking about what is the next city or the next area in the world that could create their own Silicon Valley. And none of those really succeeded or got any traction, except for the internet itself with crypto. So the next Silicon Valley kind of became the internet itself. And the next Wall Street became the internet.
Yeah.
So that cycle just massively changed and accelerated as we got to 250 billion worth of stablecoins on chain on the internet. And as you said, that is you think of that as a nation state that's holding I think the 6th or 7th largest amount of treasury of T-bills, and that's soon going to be number one. And whether the world's assets like ETFs and tradable stocks, Apple and et cetera, are going to get tokenized, or simply because new companies and new ways to capture value are all occurring on the internet in this new economy, just occur faster and iterate faster. Eventually, everything of value will shift towards this new paradigm. So, you have 500 trillion worth of stuff in the world. Most of that right now is not tokenized. Only like 0.1% of it is tokenized. That's going to shift as well.
Yeah, that's amazing. I mean, I was also not born in the U.S. I founded a company in the U.S., but I was born in South Korea, and came to the U.S. because that was where I could have the highest ambitions and the largest economic opportunities. And that kind of geographical constraint and needing to be at a place to be connected to the largest network of opportunities and economic liquidity was always true until maybe just now. Yeah. And yes, all the RWAs can come onto Solana, but I think as like engineers, as like founders, what's maybe even more exciting is that like what that enables is that maybe then the internet and Solana like networks can be the place where actually the most ambitious founders and businesses can be built.
Yeah, absolutely. I think there's some irony to that. The New York office for Solana has expanded as this is happening, because in some ways you still have these, like, people still like hanging out and like being next to each other. And even though we say that like maybe you don't IPO on Wall Street, you IPO on chain now, a lot of the humans are still in New York.
Yeah, absolutely. Our New York office is also the largest office. We started in San Francisco. Hunter and I were both. Yeah. Yeah, but I think the mental model of like this internet and the on-chain economy kind of replacing or being a substitute is probably wrong in the sense that I think Wall Street will actually grow more as a result of like stablecoins, as a result of the internet markets vision coming online. That's because they're very much have a exponential relationship to each other.
Yeah, you can. You could think of it adversarially as maybe this is competing with Wall Street, and somehow business is moving away from Wall Street to with these internet-based economies. The other side of that coin is that the reason why that's happening is because this is software, and the software is eating the world, and it's able to do that because the properties like cryptography and like replication and verifiability eliminate failures. So they eliminate faults. So now you can automatically go deploy and take on risk and do all these things at scale. And you would think for a second maybe, oh, this is now competitive with Wall Street and it's replacing it, when in fact that you're just really scaling Wall Street faster. Because a lot of the best finance is in Wall Street, and you want access to that. This is ironically like you're not replacing the dollar dominance with this new economy. You're actually expanding it. We're not talking about trillions of some other stable coin. You are talking about trillions of the digital dollar as the main stable coin, simply because of the kind of the practical facts in the world is that people want digital dollars. That's the dominant world currency, and creating stable coins is the faster, best version of that API. It's just really optimizing and expanding what's already there and what people want.
Yeah, absolutely. And in some ways, the properties that public blockchains and cryptography bring, like strong property rights, are actually very well aligned with free market capitalism, and in some ways what Wall Street very much wants. It's geographically restricted or constrained the US to some extent because the only way that we could export strong property rights was the legal system. But in some ways now we have another mechanism, which is cryptography and blockchains. And the two of them aren't actually what they want. And it isn't really that much in conflict. In some ways, they're very much complementary and it could make each other even stronger.
Yeah, absolutely. And I think one observation that I've seen over the last couple of years is that, we're blessed to be guests in Abu Dhabi, and we've heard folks talk about the amount of work that they put in to make it friendly to crypto, and that make a regulatory regime that is friendly for crypto and building this kind of new finance. And what has clicked to me is that when this is happening, folks are creating regulation that is compatible with public permissionless blockchains.
Wow.
That they're not creating a new set of regulation where we have to change the protocols to comply with them. Is that
I see.
We have permissionless networks, and they are adjusting the regulatory environment to where there is less friction for permissionless networks to operate there. So slowly but surely, each one of these new jurisdictions that onboards, they are expanding this kind of global interface that is all just one giant permissionless network.
Yeah, and can build on the primitives of private keys and ownership tied to that. In some ways, in the US, the world that Bitwise operates in, a lot of the regulatory conversations is always, as you said, about like how do you fit the old regulations to work for the new primitives. But in some ways, if you can assume the new primitives and start from there, it can even be much more stronger.
Yeah, if everyone effectively adjusts their local regulation to be friendly to public permissionless blockchains, that becomes a single common source of truth for the entire world.
Yeah, and that can ultimately, like what I've always felt in Korea, and the reason I felt compelled to move to the US is ultimately you want to work in the largest market. Like, in a similar way that you want to live in the largest city, because the most amount of weirdness and random connections and users create that spark, and then also the largest opportunity. And they've all been siloed in their own legal jurisdictions. They had to have the same political philosophy or something to be able to trade with each other or have strong guarantees. And yeah, maybe the systems like we're building here can be a layer below all of that unites it.
Yeah, absolutely. And like you saw the same thing happen with content, entertainment, social networks, where at least maybe the regulators didn't think about creating friction there. It just kind of happened out of the growth of the internet. You had this, the ability for Facebook to build a network that could serve 4 or 5 billion users all at the same time, allowed that company to grow and to that massive scale. This is much harder to do in finance simply because every local jurisdiction has their own regulation. But as all these things update and say, we're compatible with public permissionless chains, all of a sudden you have that opportunity in finance.
And what do you think Solana plays in that vision?
I think there's a lot of been tons of discussion on crypto Twitter about value capture. Do L1s have a moat? Can tokens capture value? Like true decentralized tokens, can those capture value? I think that the entire aggregate of the crypto market cap is going to continue to grow. And I think eventually it has to be split by revenue and value capture. And I think L1, specifically proof of stake networks, have very clear ways to capture value and to deliver and to provide value. And I think those are going to dominate and take the largest share of that split. I think it's going to be that transition is going to be a knife fight and painful. And I'm competitive. Solana's competitive. I think we have the competitive ethos to win the whole thing. So we'll see what happens. But my goal for Solana, and I think everyone's goal that's here, is that we play, if not the largest part in the world of that, the largest one we can.
And play to win.
Yeah, exactly.
All right. I think that's time for us. Thank you, everyone. Thank you, Tole.
Thank you, guys.
Great. Well, thank you all for joining us today. That's it for programming. Get out there, go to your happy hours. But remember, keep Bitwise in mind. We are helping bridge Wall Street and crypto with SMAs, with ETFs, and also with the research team, which is the #1 part of the organization, myself and Matt Hogan, the rest of the team. So stay tuned. We'll have more research to come on the Solana ecosystem. And thanks for coming today.